Members, I welcome you all for this first session of the second day of first module RETA, Revisiting the Income Tax Act 1961. I have privilege in introducing today's speaker, CAE Chaitanya. May I call upon CA Vijay Singh sir to come on to the desk and then welcome the speaker with the floor. Thank you, sir. I have privilege in introducing today's speaker. E. Chaitanya is a chartered accountant. He is a postgraduate in commerce from Sri Venkateswara University, Tirupati. He has qualified as chartered accountant in January 2005. Qualified Information Systems Audit course from ICAI with third rank, all India third rank. Completed the certification course of ICAI on international taxation. Completed bachelor's degree in law in the year 2020. Presently, he is pursuing master's degree in international taxation from NAL SAR University, Hyderabad. He has varied experience in statutory audits, internal audits, and tax audits. He has been representing before various income tax authorities and has also been actively involved in the preparation and presentation of appeals before CIT appeals and ITAT, Hyderabad. He has written articles on direct taxation for Chartered Accountants Study Circle, Chennai, International Fiscal Association, Chennai chapter. He specializes in direct taxes with keen interest on international taxation. He hails from family of Chartered Accountants. With this brief introduction, I present before you CAE Chaitanya sir. Okay.
Good evening, everyone. At the outset, I am thankful to the Bangalore branch of SARC for inviting me here. I am not a native of the state. I have come only to deliver this address. So, it is in fact, I have attended number of seminars at Bangalore branch. It was on the learning side. For the first time, I am delivering my content here. So I thank the Bangalore branch for giving me this opportunity. And I also thank them for the opportunity to make me study Section 9 once again. Section 9 has always been the core center of litigation as far as any international tax issue is concerned. So wherever there was a reference, we only used to go to that point, read that particular section, and then go back and refer few case laws and we used to decide. But now that they have asked us to speak on Section 9, it had given me an opportunity to go back and read the section in total. Entire day's session is on Section 9. There are two speakers. Apart from me, there is one more speaker. He would be dealing with the initial part of Section 9, which is from 9.1 to Section 9.1 to 9.12. The rest I would be covering in my course of action. And if need be, I would be here to clarify if there are any doubts as far as Section 9 is concerned. The scope of my lecture today is Section 912 and 913. They are 912 and 913 deal with salaries, 914 deals with dividend. And those two I would be covering at the fag end of my session along with 918 because they are all little in scope. The key part of Section 91, which is interest, royalty and FTS, would be covered to certain extent during the course of my presentation. The primary part dealing with business connection and its interplay with the other aspects, including significant economic presence or the PE, would be dealt with by Prasanna, who would be coming and giving his lecture in the evening session. Now, if I were to go to section 9, the first and the foremost part, I believe I am on the second day, so ideally you would have already covered 4 and 5. So you would know the course better. 5 is one section which grants the taxing rate. It's more of a charging section along with section 4. 5 gives you the scope of the total income. What has to be included in the total income, what should be excluded in the total income would be dealt with by section 5. Section 5 has been classified according to the residential status. A resident gets taxed in one particular manner, non-resident gets taxed in one particular manner. The scope of the total income for a resident is different from the scope of total income for a non-resident. If I have to go straight to section 5.2, it states that for a non-resident, what is received in India, what is deemed to be received in India, what is accrued in India, what is deemed to be accrued in India. Only 4 categories are taxed. Whereas for a resident, if I have to put it in a very colloquial way, I would say the entire global income, wherever it is earned, would be taxed in India. So for a resident, locale of income, place of earning the income has got no relevance. Wherever it is earned, it is always taxed. But for a non-resident, the income must accrue or arise in India, or the income must be, there must be an accrual point in India. So there is a restriction of the place for a non-resident in India. I mean, there is a restriction on the place of earning of the income. So, in order to ensure that more income comes into the ambit of taxation, they have introduced section 9, which talks about deemed to accrue or arise in India. The moment they have used the word deemed, it would mean that ideally that income never really accrued in India. It is only through this deeming fiction that the income is being brought into the statute book. I mean, the income is being brought into the scope of the total income of the non-resident. So, what does deeming fiction do? Let us take a very small example. Assume I have a house in Bangalore. I intend to rent it out. There is one guy who is willing to take this rent, but he sits in, say, Russia or US. He says, I'll pay you the trip, you come to Russia, get the agreement signed, go back. What would be the place of accrual of that rental income for me? How do you decide where is that rental income getting accrued? The house is in Bangalore, I am making it out to a non-resident who is sitting in some other country. Where is the place of accrual of that income? What is the point of accrual of that income? Is it the completion of the month? Or is it every month a due date that is specified? Where does the income from that building originate? The income from that building originates not from the place of the building, it originates from the agreement that is made for the purpose of letting it out. Similarly, in the case of royalty, you enter into an agreement. In the case of FTS, you enter into a contract for letting out the services. So everything has got a contract, and that would be the point of origin of income. So if that particular contract is outside India, there is every possibility that the income is also outside India. The source of income is also outside India. So in order to curb all these ways of revenue leakage, they have brought in section 9, which states that these particular incomes, irrespective of their category or irrespective of their actual source, they are always deemed to accrue or arise in India. So due to this deeming fiction, the place of accrual is, irrespective of its original nature, it is not deemed to be located within India. That is the purpose of section 9. Now, is it applicable only to residents, or is it applicable only to non-residents, or is it applicable to both residents and non-residents? Why should we study section 9? As I said in my opening speech, whether it is applicable to residents or not would only be a very, very mute question to be discussed here, because for a resident, anyway, the scope of total income under section 5(1) is capable of covering incomes which are accruing outside India also. So even if it is accruing outside India, by virtue of section 5(1), it would anyway be within his taxable total income. It is only relevant for non-residents, but there is no restriction in section 9 that it would not apply to residents. So section 9, I've given you few case laws over there. Section 9 is equally applicable to residents as it is applicable to non-residents. But for non-residents, the impact is greater. And for residents, the impact is only academic because it is anyway getting covered in section 5(1). So that is how section 9 has its purpose, and as I said earlier, it is the epicenter of every case of litigation as far as international taxation is concerned. So having discussed section 9, we will now see what are the topics that we are dealing with in section 9(1). As I said earlier, I have left out the business connection, permanent establishment and all those initial concepts to my friend who will take it up from 6 to 8. So if you look at section 9, especially clauses dealing with 915, 916 and 917, which are basically interest, royalty and fees for technical services. For these three categories, there are some common features involved. What are the common features? If it is paid by government, it is always deemed to accrue or arise in India. If it is paid by a resident, it is generally treated to be deemed to accrue or arise in India. The only exception is that if it is for the purpose of a business which is carried on outside India, or if it is for the purpose of earning or making any income outside India, only in those two circumstances, even though if it is paid by a resident, that interest or royalty or FTS is not deemed to be accrued or arising in India. Otherwise, generally payments by residents to non-residents would have the impact of deeming that income to accrue or arise in India. When it comes to non-residents, the scenario is quite reverse. Payment by one non-resident to another non-resident would be deemed to accrue or arise in India only in two circumstances. Those two circumstances are: one, there is a business carried on by such non-resident in India, the payer non-resident in India, or the payment is for the purpose of making or earning income in India. Only under these two circumstances, the payment by the non-resident is treated as deemed to accrue or arise in India. Otherwise, all payments by one non-resident to another non-resident would normally not be treated as deemed to accrue or arise in India. This is the common feature that is available across 915, 916 and 917, interest, royalty and FTS. Apart from that, there is one more common feature, which is explanation to section 9. This explanation sits at the bottom of section 9, and it says that for the purpose of clause 5, clause 6 and clause 7, interest, royalty and FTS, they say that it will be included in the total income irrespective of whether non-resident has a residence or a place of business in India and whether the non-resident has rendered services in India. Irrespective of whether the non-resident has rendered services in India or not, this particular charge would continue to apply. That is the sum and substance of this explanation. If you look at the background of this explanation, earlier there was a decision by the Supreme Court in Ishikawa-jima wherein they were dealing with the case of offshore supplies. In those circumstances, or payments made for fees for technical services, in those circumstances, Supreme Court remarked during the course of the judgment that not only do the services are paid outside India, they are also not rendered in India. Since they are not rendered in India, they are not utilized for the business, and therefore it was treated as if those payments are not liable to tax in India. Now, in order to nullify the decision of the Supreme Court in Ishikawa-jima, they have brought in this explanation where they say that irrespective of whether the services are rendered in India or not, any payment by a resident to a non-resident on account of either interest or royalty or FTS, they are deemed to be accrued or arising in India. I can understand a case where, for example, I have sought opinion from a lawyer, or I have sought some advisory from one of the person who is located outside India for the purpose of my business, which is within India. He renders me some advice and I pay him his consultation fee. It is treated as fees for technical services. I understand I have to deduct TDS. I fully agree. Because whatever he has given has been not only been rendered outside India, but it has been utilized in India. The service has been consumed in India. To that extent, I agree. What happens to a case where I go outside India, where I travel outside India, I go to a foreign land, there I take the help of a consultant for some advice, I consume that service there, I come back to India, I make a payment. Should that be taxable in India? If you look at the explanation per se, the non-resident did not travel to India, the non-resident did not render any service in India, the non-resident is sitting at his home place. Whatever was the advice or the consultation that I took from that non-resident, I have consumed it only outside India. I have not utilized it in the course of my business in India. Then will this explanation come into play? You can always invoke the second limb of the particular section, which says that if it is utilized for a business outside India, then it is anyway not taxable, it is not deemed to occur in India. To that extent, I have the confidence. But if it is utilized for a business in India, although it is not consumed in India, then there is every possibility for the non-resident to claim that I have not come to your place, I have not entered your land, I've sat in my own country, now you are asking me to pay tax in a country in which I have not done anything. You have transacted with me. It is more of a transaction by an Indian with a non-resident. There is nothing that I have travelled, I have come to your place. So ideally for him, he would not say that the payment is taxable in India. So this is where the scope of extraterritorial jurisdiction and all those things come into play. But nevertheless, this is a point which is not very free from doubt. There are adequate ambiguities involved for invoking this explanation. And unfortunately, this explanation has not been tested adequate number of times. Wherever there is a payment from India, courts or for that matter taxmen have simply said that because of this explanation, every payment by a resident to a non-resident is liable to tax, whether he has got a PE or not, whether he has rendered the service in India or not. The only reason people were able to get away from this explanation was because they had invoked the provisions of the treaty, barring that this explanation would generally apply for all payments made from India to any non-resident. Now, having discussed the common features of section 9, especially interest, royalty and FTS, we will now go and deal with each particular aspect of the item, like interest. What is meant by interest? How do we deal with it? Then we will see what is royalty, and then we will again see what is FTS also. Interest. What is meant by interest? The word interest has neither been defined in the DTAA nor defined in section 9. It is only defined in section 2 plus 28A, which talks about the word interest in one particular fashion. It says interest means interest payable in any manner in respect of any monies borrowed or debts incurred. Debts could involve deposit or claim or any other similar right or obligation. And it also includes service fee or any charges in respect of that monies borrowed or debt incurred, or in respect of a credit facility which has not been utilized. So from this definition, we can only infer that the word interest, within its definition, it will only encompass payment towards monies borrowed. So the pre-existence of a debt is of paramount importance when you are paying an interest. Just because the payment is titled as interest doesn't mean that every payment is interest. The word interest would have its significance only if there is a pre-existing debt. Pre-existing debt is fundamental for payment of interest. Why I am stressing on this point, I will explain to you when I take up few instances of what is considered as interest and what is not considered as interest. But nevertheless, pre-existence of a debt is of paramount importance when you are making a payment towards interest. The second aspect this definition covers is that it covers other charges like service charges, processing charges, all other charges within the scope of interest. See, this is very, very important because this is the same interest definition which is available in section 194A, which is normally used while deducting TDS, especially in the case of residents also. Where residents borrow money from institutions other than banks. If I were to give simple examples, if they borrow money from private lending institutions, then in those circumstances they will have to deduct TDS when they make payments to such private lending institutions. Simple examples could involve cases where they borrow money from certain financial houses where which are even backed by banks. But in those circumstances, if they are not banks or financial institutions as mentioned in section 194A, then they would not enjoy the benefit of non-deduction. If you were to make an interest payment to a bank, 194A specifically says interest payment is not required to be subjected to TDS. But if I were to make the same interest payment to an individual or to private lending institutions, then I am supposed to deduct TDS under section 194A. Now, the question here is, should the TDS deduction be restricted only to interest? The answer is no, because the word interest covers not only the interest component, it covers even the processing charges. It covers even the other charges which are levied by the institution or by the lender. So, taking that, even if you have not utilized the credit facility, you have simply paid the processing charges, got the loan sanctioned, but this sanctioned loan remains unutilized, that processing charge would be treated as interest for the purpose of section 2 plus 28A. Now, this is the definition which is available under the Income Tax Act. This same definition there is nothing defined in section 9 to say that interest means this. They only use the word interest in section 915. Now, what does that interest mean? Now, if you go to section 2 says unless the context otherwise requires, all the definitions given in this section 2 are generally applicable. So, taking interest definition from section 2 and clubbing it with section 9, we would get to feel that interest means the interest as defined in section 2 plus 28 here. If I were to go to a specific treaty, the definition given in the treaty need not be the same as the definition given under the Income Tax Act. Definition under the treaty could be much lower in scope, or it could be different also, but it need not be the same as the definition given in section 2 plus 28A. So, having understood the meaning of the word interest, if you look at the case laws that are applicable, on interest, various scenarios, we'll just see what they are trying to say. Reimbursement of guarantee charges. There is a parent company, there is a subsidiary. Parent has given a guarantee to the subsidiary. Now, the subsidiary is repaying the guarantee charges that the parent has given. For example, if the parent has given a guarantee on behalf of the subsidiary and the bank charges the parent 1% of the loan or 0.5% of the loan, the subsidiary is now repaying the cost of that guarantee from the subsidiary to the parent, the reimbursement is happening. Can it be termed as interest? The answer is simple no. Although there are 3 cases given, the answer is simple no, because there is no pre-existing debt in this scenario. It is only a guarantee. The word guarantee does not find its place in the definition of interest. So unless there is a pre-existing debt, any guarantee given on that debt would not amount to interest. So any repayment towards the guarantee charges would not amount to interest. Usance interest. What is meant by usance interest? For example, I have in fact, usance interest has been of much litigation. There were case laws on both the sides, right from Vijay Shipping to Visakhapatnam Port Trust, number of case laws, but nevertheless, what is meant by usance interest? For example, if I were to purchase goods from a party, I am supposed to pay him X amount of money. If there is a delay in repayment of that money and the supplier charges me interest, that portion would be termed as the usance interest. For the usage of the credit, I am making a payment. Delay in payment of credit bills, excess usage of the credit from the supplier would all tantamount to usance interest. Is usance interest liable for, is it chargeable to income tax under section 915, especially if the person who is receiving it is a non-resident. For example, I have purchased from a supplier who sits outside India, and there is a delay in payment of the amount purchase value. In that case, will the extra payment made towards interest, would it be treated as interest under section 2 clause 28A or not? Will it be liable for tax under 915 or not? I've purchased money, I've purchased goods, there is a delay in payment of the goods. For the delay, I'm paying back the amount together with interest. Can it be termed as a debt? Can it be termed as a debt, pre-existing debt against which an interest is paid? The scenario is quite distinguishing for the simple reason that if the vendor says that you take these goods, you don't need to pay me immediately, pay me after 3 months, taking a credit period, and pay me instead of, if you were to pay me today, I will be paying you X amount of money. If I were to pay after 3 months, you will pay X plus 3% or X plus 10%. Then in that scenario, what is paid is only towards the purchase value of the goods. It is never interest in real terms. But unfortunately, where interest has been used by the supplier, where there is a specific payment exclusively towards interest, then in those circumstances, it was held to be interest. Ideally, any payment to a supplier should normally be, irrespective of the time period in which I repay, should normally be treated as the payment towards the purchase of the goods. But unfortunately, where there is a payment towards interest, where there is a payment, where there is a delay in the payment, and towards the delay there is an extra payment towards the purchase price, in those circumstances, that extra payment has been treated as interest. The concept takes even more difficult turn when you invoke the provisions of Ind AS, where they specifically categorize that any payment during the credit period should be classified as interest, and the payment should be discounted to its real value. So, considering those aspects, user's interest has always been held by the courts as payment towards interest, and it has not been treated as payment towards the purchase price. The last issue is bill discounting charges. For example, if I have a purchase bill, if I have made sales to a party, and that party is supposed to pay me after 3 months, I go to a bank or I go to some other party and I were to discount those sales invoices for which I receive the payment now. Normally the party or the bank who is discounting those invoices would not pay me this value on the invoice, because he will be receiving the amount only after 3 months. So he would give me a reduced amount. For example, if I have made sales worth 1 lakh to a party, which is receivable after 3 months, I go to a bank, I discount those invoices. The banker doesn't pay me 1 lakh, which is the face of the invoice, which is the value on the face of the invoice. He would only pay me 90,000 rupees, saying that this 1 lakh will be collected after 3 months, so I will be reducing certain portion towards my interest. Can those bill discounting charges be treated as interest for the purpose of 228A? The answer again has been no, for the reason that there is no pre-existing debt in this case. After all, it is only a reduction in the sale value for a early receipt of money. Therefore, it has not been treated as interest towards any pre-existing debt, and therefore it is not chargeable under section 915. Any issues till this point? Any doubts on the concept of interest? There is an explanation to section 915. It's an interesting explanation. Originally, there were cases where foreign banks had PEs in India, foreign banks had branches in India, and those branches conducted the business of banking in India for those non-resident banks. You had Citibank, you had ABN AMRO, there are a number of foreign banks who operated in India, and for all those operations they have put up a branch in India which conducted the business of banking. For their branch initial investment, head office contributed certain amount as a debt, and the branch, whenever it earned money out of the surplus, it repaid interest to the head office of the bank. So the branch in India was paying interest to its head office outside India. Both the branch and the head office were non-residents, but essentially the branch was making a payment towards the head office towards the interest for the amount it had taken. During the course of assessment of that branch in India, branch was only liable to the extent of the profits it made. In computing the profits, it said, I have paid interest to my head office, so to the extent of the interest paid, it is required to be reduced from the profits, and therefore, to that extent, in computing the profits, the branch had reduced its profits. Immediately, the officers held that you have made a payment of interest from the branch to the head office, so ideally you should have deducted TDS under section 195 read with section 915. You have not deducted TDS, therefore I will not allow this interest payment as deductible expenditure for the purpose of the branch. When the matter travelled up to the judiciary held that branch and head office are one single person. You can't hold the TDS is liable to be deducted. TDS, in order to get attracted, there should be two different persons. There should be a person paying and there should be a person receiving. In this case, it is only the branch and the head office. Both of them are one, so there is no question of invoking TDS, was the judgment of the courts in general. Just to overcome that judgment, they have brought in this explanation where they say that in the case of a non-resident, being a person engaged in the business of banking, any interest payable by the PE in India to such non-resident head office would be chargeable to, shall be chargeable to tax, and the branch in India shall be treated as a separate and independent person when compared to the non-resident. This is how they have framed the explanation. So for the purpose of chargeability, the non-resident and the PE are treated separately. If the PE is or the branch is making a payment of interest to the non-resident, then PE will claim the interest paid as its expenditure, and the non-resident head office, which is receiving that income, interest income, has to admit that income in India as its income under section 915, and therefore has to pay the tax. That is how this explanation is worded. It artificially tries to capture the interest earned from India, from the branch in India to the head office. They have now artificially segregated branch and head office. They have said head office is different from the branch. Branch we can take it as expenditure, but head office will have to make the payment of tax on that income that it has earned. Now, there are some moot questions that come out from this explanation. This explanation is applicable only if the non-resident is engaged in banking. If the non-resident is not engaged in banking, if there is a payment from a branch to a head office, ideally in those cases this explanation does not cover those cases. Therefore, if there is a payment, then the branch will claim it as an expenditure. The HO need not admit it as an income as long as the non-resident is not in the business of banking. This proviso is applicable only for non-residents who are in the business of banking. So for all non-banking related business non-residents, this proviso is not applicable, and therefore they need not come and offer that interest income for to tax in India. That is one. Second, the proviso, the explanation artificially states that the branch and the non-resident are separate, marked it in red there, separate and independent of each other. Does it mean that the explanation is trying to say branch and head office are not associated with each other? Normally, if you test them for associated entities, you would obviously find that both of them are related to each other. But this explanation says they are separate and independent of each other. If you were to treat it as a separate and independent nature, if you were to treat them as not related to each other, then the question of testing the transfer pricing provisions would not at all arise. What does this explanation try to do? Does it try to circumvent the transfer pricing provisions by saying that you are two distinct parties. If they are not related to each other, there is no question of invoking transfer pricing. So he is transfer pricing out of scope. Again, this is one question I don't have an answer, but as of now it appears to be little confusing for the purpose of this explanation. The next aspect is, it is only dealing with a payment from Indian branch to a foreign non-resident head office. It is not dealing with a reverse case where there is a payment from the head office to the Indian branch. To the Indian bank it will amount to income, so the non-resident would be claiming it as a deduction. There, in those cases, this explanation has got nothing to do. It is not at all applicable. The non-resident is entitled to treat it in the way according to his taxation. So, considering that these are the issues that are there, this explanation requires some clarity, but unfortunately these are all the issues that come out of this explanation. I have mentioned those two case laws there only to state that they have been overruled by insertion of this explanation. Originally these were the case laws which stated that branch and head office are one single person and they don't require TDS and other provisions. I have by far covered the provisions relating to interest. Interest under the treaty is quite different, but treaty doesn't throw much of the aspects relating to interest. I have tried to cover it in the domestic law itself. If there are no doubts on the concept of interest, I will quickly move on to royalty.
So one thing on that recent bank thing out there, when there is practical challenge on filing return also, same time that to file return?
Yeah.
It's not possible, right?
The moment they say that these two are independent, you will have to say that branch is different from the head office. In those circumstances, you will have to take a new one, saying that this is the PE of the foreign branch. PE is distinct from the head of non-resident itself. So you will have to take a different PAN and then file the return.
Sir, in case of guarantee given by HO,
Yeah.
when the subsidy is paying, so you told that guarantee will be not falling under the interest.
Correct. See, guarantee is given by head office to a lender so that he lends money to a subsidiary. The lender would charge the head office or the non-resident towards that guarantee given. So he would charge them some fee. So if that fee is getting reimbursed by the subsidiary to the non-resident, what is the nature of the payment? It is definitely not interest because there is no pre-existing debt. That is the basis of the conclusion that it is not liable for interest.
Okay, you mean to say the guarantee fee is not subjected to interest, TDS under interest.
Correct.
Okay.
Guarantee itself is a concept because it was always subjected to transfer pricing. There is no doubt in it. Originally it was not a transaction, but subsequently they have brought it into the scope of transfer pricing. But as far as interest is concerned, there is no pre-existing debt to say that this guarantee fee is interest. In order to classify it as interest, there must be an existing debt. There is no such debt. It is only a guarantee that is given. Therefore, it is not treated as interest. Royalty. We all know royalty is quite a challenging issue because most of the software payments have been subjected to litigation by the department, calling them as payments towards royalty. So royalty is another issue. If you look at royalty, royalty is again differently worded under the Income Tax Act and it is differently worded in the treaty. Each treaty has got its own variation of the definition of royalty. And some of the terms that are defined under the Income Tax Act are not defined under the treaty. So the word, the definition of royalty is completely different under the Act and under the treaty. I am not trying to go to the treaty now, but I would only request that if a transaction is applicable, if it is liable for TDS or for whatever nature it is, if it is falling within the scope of 916, then it would be most ideal. For that matter, not just 916, 915, 916, 917. If a transaction is getting triggered, it would be most ideal to go to the treaty, look for a better scope or for a better rate, for the simple reason that Act is more complicated and treaty is more liberal. So Act permits you to adopt whichever is more beneficial. It is almost tried to say that as far as the treaty, whenever there is a provision concerning treaty and the income tax act, you have got the option to choose whichever is more beneficial to you. Section 90 subsection 2 very clearly says that. So where there is a treaty, it would be more advantageous to the assessee to invoke the treaty even at the time of deduction of tax at source, so that if the scope or the rate is beneficial or both are beneficial, you can go to the treaty. And invoking the treaty is not easy for the simple reason that you will have to obtain a TRC, you will have to obtain the forms mentioned in the act, and only then you can invoke a treaty. So with those conditions, we will now quickly see what is the definition of royalty. Royalty means consideration, including lump sum consideration, but excluding any consideration in the nature of capital gain. So royalty, the definition not only includes within its scope periodic payments, but it also says if there is a lump sum consideration which is paid, even that would form part of royalty. That would also be classified as royalty for the purpose of section 916. But it excludes when there is an outright sale of a inherent copyright. So if there is an outright sale of a copyright, then it would be treated as capital gains, but otherwise any exploitation of such copyright would be treated as royalty. Not just copyright, it could include even patent, trademark or whatever it is. The list is given just below that. The first three in the list deal with a patent, invention, model, design, secret formula, process or trademark or similar property. The first one says that transfer of all or any rights, including granting of a license in respect of a patent, invention model. The second one is about imparting of any information concerning the working of or the use of. The third one is the use of a patent, invention. So the first three deal with patent, invention, model, design, what the list that is given out there. The next one deals with the information concerning technical, industrial, commercial or scientific knowledge, experience or skill. The fifth one, which is 4A, deals with the right to use or use of industrial, commercial, scientific equipment. The fifth one, which is generally concerned with software, is the fifth one, which says the transfer of all or any rights, including the granting of license in respect of a copyright, literary, artistic or scientific work, including films, tapes for use in connection with radio broadcasting. Generally, the word software is treated as a literary work in the Copyright Act. I will just take you through the provisions of the Copyright Act. Provisions of the Copyright Act, computer software is classified as a literary work. Under that literary work, there are copyrights which are granted, and accordingly, if there is transfer of all or any rights, including granting of license in respect of a computer software, then it will be treated as then the payment towards that computer software would be treated as payment towards royalty. The last is rendering of any services in relation to any of the items mentioned in 1 to 5 mentioned above. This is the rendering of services is something similar to the treaty also. Even in the treaty, where there is any activity performed in relation to, which is ancillary or incidental to the enjoyment of right property, there also in the treaty also it is treated as royalty. Here also it comes as the same. Now, the issue that is before us is what is the impact of, how is a payment towards a software treated as a royalty? We all know now, almost it is set into law that payment towards a royalty is, payment towards a computer software is no longer called as royalty. It is treated as a payment for a purchase of a product. But how does it exactly translate to? How does it operate? What are the different limbs of the Copyright Act which really give you that meaning? We all know of the very famous comparison between a software product and a book. They say when I purchase a book, I am only buying a copyrighted book, copyrighted article. But when I am purchasing a software, why don't you give me an equal treatment? Department has always been countering the view that whatever you are buying, the software is only a license. Our definition in bracket says including granting of a license. If you refer to any software, they give you a EULA, end user licensing agreement. The moment you open the software, they say if you agree to the terms of the license, then we will grant you. If you say yes, it will proceed forward and it will install on your system or whatever is the manner of operation of that software. So the EULA, end user licensing agreement, is the grant of the license. We have specifically included it in our definition by saying that including grant of any license. Therefore, department always contended that payment towards software is payment towards royalty. If I were to purchase a software from a non-resident, then as per department, I am supposed to deduct TDS on all such payments. Now, as if this explanation was inadequate, they went on to add a few more paragraphs to strengthen their case with relation to computer software. They have added 3 explanations, explanation 3, 4 and 5. They said, explanation 3 defined computer software to mean computer program recorded on disk, tape or perforated media or any such device, information storage device. In fact, the word computer program is again defined in the Copyright Act, but nevertheless they went on to define what is a computer software. Then they have clarified, more importantly, that explanation 4 says transfer of all or any rights in respect of right, property or information has always included right in respect of right to use or use of computer software, including granting of license. They have added this explanation just to strengthen their case that any payment towards the purchase of computer software is royalty. To strengthen this case, they added this explanation. They also went on to add explanation 5 where they say that whether or not that possession is in your control, whether or not that property is in India, whether or not that information is used directly by the taxpayer, all this would be tantamounting to royalty. This is how they have defined, they have put in this charging section of 916 all the details relating to computer software. At this juncture, I would stop with 916. I would like to move to Copyright Act only to just see how does the Copyright Act operate with respect to computer software. We will just run through few provisions of the Copyright Act and then we will come back to see how does that copyright testing act as far as the computer software is concerned. Before I move on to Copyright Act, what is copyright? What is copyright? Any idea? I'm sure you would all be knowing what is a copyright. Every book you read, it is a copyrighted article. So what is a copyright? It is a right, a negative right which prohibits all others to copy that book. So if I were to write a book and if I were to publish it myself, and if you were to purchase that book, you can buy that book, you can read the content, but you cannot reproduce the content or you cannot make copies of that book. You can only purchase the book, read it, consume it, that's all. That is copyright in very normal sense on how we understand the provisions of copyright. In fact, copyright is the same. It says copyright means an exclusive right, to do or authorized to do the following. They have defined certain items. Any person who is granted a right to do one or more of the conditions mentioned there has got a copyright. If he is not authorized to do any of those things, then he does not have a copyright. That is the meaning of a copyright. In the case of literary, dramatic or musical work not being a computer program, you have got 7 rights. What are those rights? To reproduce the work, to issue copies, to perform the work in public, to make a cinematographic film, to make a translation, to make an adaptation, to do any other activities in relation to translation or adaptation mentioned in the list there. First one is literary, dramatic, or I have already clarified that computer software falls within the literary work. So for a literary work not being a computer program, they have given you the list. In this list, the second point is of vital importance. It says to issue copies of the work to the public not being copies already in circulation. So you are not allowed to make more copies. For example, if there is a distributor, the original programmer would give him one set of program, he would say make copies and sell it, distribute it across the, for whoever wants to buy can buy from the distributor. So the distributor is issuing copies of the same program. So any payment by the distributor to the original owner of that software, would it be copyright is something that we'll have to test again. But at least I would like to bring to your notice that issue making copies of the original work, literary work, would tantamount to copyright. So unless you have got the right to make copies, you are not allowed to make any copy of that original work. In respect of computer program, all the acts that are mentioned in clause A, apart from that you also have got the right to sell or give on commercial rental or offer to sell. So a person who, to bring in a nutshell, a person who has got the right to do any one or more of the activities mentioned here, if he has legally got the right to do, then he has got the copyright. If he has not got any right to do, then he does not have a copyright with him. That is the sum and substance of section 14. Section 16 says that, section 16 is of vital importance. Section 16 says that there does not exist a copyright other than what is contained in the Copyright Act 1957. So any copyright has to be within the law framed under the Copyright Act 1957. There cannot exist a copyright independent of this statute. They also talked about section 30, which talks about licensing. Section 30 talks about licensing. It is there in the Copyright Act itself. It says the owner of the copyright can issue a license to a person to do any of the activities listed in section 14. So a license contemplated under section 30 allows the licensee to do the activities listed in section 14. They also talk about section 51, which talks about infringement of a copyright. When does the copyright get infringed? So without a legal document, without legal authority, if you were to do any of the acts mentioned in the section 14, then it is deemed that you have infringed the copyright. Last and the most important point here is that certain acts are not considered to be infringement of copyright. Certain acts are not considered to be infringement of copyright. What are those acts? Reproduction of the computer software purely for the purpose of making backup of that program or for the purpose of protection in the case of damage to the computer system. All those things would not tantamount to infringement of a copyright. Similarly, making copies of the computer program from a legally obtained person for non-commercial use would also be treated as not infringement of a copyright. With this background, if you were to go back to our original question and test, this was the test laid down by the Supreme Court in engineering analysis case, wherein they said, if you were to test the software that you are purchasing, if you go to the EULA that is given, they will give you a non-exclusive right to use the computer software. They are not giving you any of the rights mentioned in section 14A or 14B. They are not giving you any of the rights in terms of that computer software. All that they are giving you is only the right to operate the computer program and right to run the computer program for the purpose for which it is framed. Barring that, they are not allowing you to make copies. Barring that, they are not allowing you to reproduce it. There is no adaptation. There is no translation into your own language. None of that is permitted. Whatever is given under the EULA is only a non-exclusive, limited license to do that. So this EULA, end user licensing agreement, cannot be compared with the license defined in section 30 of the Copyright Act. That is what the court said. You cannot compare this with the EULA. EULA is a very different way in which restrictions have been put in. So EULA is different from section 30. Therefore, there is no concept of licensing under the EULA. The moment the word licensing under section 30 is not brought in, then under the original definition of the royalty, when we discussed royalty, if I were to go back, see, including granting of a license, wherever there is including granting of a license, that license cannot be equated with EULA. The license that is mentioned in section 916 is a license granted under section 30 of the Copyright Act. in the present case, any end user license is not the same as the license contemplated in section 30. Therefore, these two are not equating to each other. Therefore, whenever you purchase a computer software, it does not tantamount to payment towards royalty. It is only amounting to payment for purchase of a copyrighted article. Even if you are a distributor, of the computer software, even if you make copies and give, you are not allowed to make copies of the program. You are not allowed to change the program. You are only allowed to make copies. Therefore, it does not fall within, because even the distributor does not have any of the rights mentioned in section 14. As I said earlier, a copyright means that you will have the right, any of the rights, any one or more of the rights mentioned in section 14. None of the rights are given to the distributor. Therefore, even the distributor cannot be called, the distributor cannot be termed as he's the copyright owner or he's the copyright licensee. Therefore, for all practical purposes, this decision is binding on all cases, even if their mere addition is made in the case much prior to the rendering of this judgment. Therefore, conceptually, now the issue of software has more or less been put to rest. The last explanation as far as royalty is concerned dealt with a word called process. The word process includes and shall always be deemed to include transmission by satellite, including uplinking, amplification, downlinking of a signal, optical fiber, cable technology, everything they have used. This was inserted into the statute in 2012 with retrospective effect from 1/6/1972. 1972, I am not pretty sure whether there were optic fibers, cables, or for that matter even satellites, at least for commercial use or for using within the region. I don't know, but nevertheless they have gone and amended the act and they have inserted the word process. The only reason why they did this was to overcome a few judgments rendered by the courts. What was the issue? If you go back to the definition, of royalty, if you look at any one, two, three, one referred to transfer of all or any right, second referred to imparting of information, third was use of any patent, invention, model, design, secret formula or process. So, with respect to satellites, earlier the satellites, as usual, they are up in the air. The owners of the satellites were non-residents. The satellites had their footprint in India. Therefore, if you wanted to have any telecast, you had to take that program and hand it over to the non-resident, who would then upload that content to the satellite, and the satellite in turn would beam its channels across India. Thereby, they could receive the content from the satellite and in turn display it to the viewers in India. Therefore, if the payment is made by a resident in India to a non-resident for the purpose of transmission using this satellite, the department contended that you are using an equipment. Since you are using an equipment, since you are using this process, I would call it as royalty. So a payment by a non-resident to a resident to a non-resident for the purpose of telecasting of the content, they said it was royalty. Then the word used the word process, then immediately the court said no, it is not process. So they have amended the definition of a process to say even uploading of data, downlinking, all this would be treated as process. The reason why courts have held that this is not a processor was that most of the department claimed that there is something called as a transponder in a satellite. It is the transponder through which these signals are beamed onto Indian surface. So they said every payment is for the use of a transponder. In fact, they did not have this knowledge. They only referred to the agreement between the resident and the non-resident. Non-resident charged money for usage of that transponder bandwidth. Transponder is a part of the satellite. It is a small equipment within the satellite. This transponder had a bandwidth. That bandwidth was being utilized. They removed the word bandwidth, they simply said you are using transponder, therefore you are using equipment, therefore you have to treat this as royalty. That is how they have jumped to this conclusion. Ultimately, courts have held that this transponder or the satellite is not being exclusively used by the assessee. He is only given a facility, he is not being given an exclusive right to operate this. Therefore, it should not be treated as a process. Just to overcome those few decisions, they have brought in this explanation 6, whereby they use this explanation to expand the definition of the word process. As mentioned earlier, although this word process expands the definition, although this explanation expands the definition of that word process, this is only restricted to the Income Tax Act. It does not move to the DTAA. So for the purpose of DTAA, whatever is the royalty given definition given in each treaty, that will only hold good. This explanation cannot go and amend the DTAA unilaterally. In fact, that was reflected in the Reliance Jio decision, wherein they held that even though explanation 6 is inserted, it has got no role to play when you are invoking royalty under the treaty. That is how they have concluded. So these are the various aspects concerning royalty. I have predominantly dealt only on computer software, but even for testing the other aspects of royalty, all you are required to do is whether is there a utilization of a copyright or a patent under that respective law. If that has been satisfied, then the payment would be treated as a royalty. Otherwise, the payment would not be classified as a royalty. This is the sum and substance of the discussion that we had on royalty. If there are any doubts, I will take them now. Otherwise, I will move on to FTS. FTS, fees for technical services, has been subjected to much debate and much litigation. In fact, if I were to put the number of case laws that are involved, it could run to some hundreds of pages also. There were every dispute more or less on the aspect of international tax either revolved on royalty or revolved around FTS. There is this, you might have known that there is a payment to Google for the purchase of a program called AdWords, where you type some words, immediately it gives you search results, this search engine optimization, all that. There was a dispute on that. There was an online advertisement in one particular website. They called it as royalty. When the definition of royalty failed, they immediately said, no, it could even be FTS, therefore try and test it for FTS also. So every payment which went from India to a non-resident was tested predominantly under royalty or FTS. The whole reason why they tested under these two categories was that non-resident anyway did not have a PE in India. So if they said business income, it would anywhere be not taxable. So they wanted to bring it into the tax net. They somehow said this payment would be royalty. If it is not royalty, you test it under FTS. That is how they have litigated the entire issue. So FTS has got adequate number of judicial precedents. But before we go, we will just try and see what is the bare section and how is it trying to conclude what is FTS. Explanation to 917 states that fees for technical service means any consideration, including lump sum consideration, for rendering of any managerial, technical or consultancy services. So effectively, if the consideration is paid for managerial, technical or consultancy services, then that would be treated as fees for technical services. The word fees for technical services is again used similarly in section 194J also. So even for a resident, if you are deducting tax under 194J, you will have to check for the satisfaction under the same clause, which is 917. Therefore, this definition holds good both for residents as well as for non-residents. What did the definition say? It said the payment must be in the nature of managerial, technical or consultancy, any one of the three. If it's satisfied, then it is called as FTS, otherwise it is not called as an FTS. Similarly, they said any payment for provision of services of technical or other personnel, then it would be treated as FTS. So if there was persons who were sent from the non-resident to India, then for providing those persons also, if there was a payment, it would be treated as fees for technical services. They have not included construction assembly or consideration for construction assembly or mining, because these are covered by a separate section under the income tax. Managerial services. What is meant by managerial services? There are a few decisions which have discussed what are managerial services. Managerial services essentially are those services which relate to management of any particular work or an organization. So if the word managerial is similar to that of the word manager, which would mean that for the purpose of terming that a work as a managerial work, or for the purpose of determining that a particular payment is towards a managerial service, you will have to ensure that the payment which is being made that is towards managing an organization or part of its affairs or for a particular activity. A payment towards a consultant who is involved in managing the affairs of a particular branch, or payment towards a particular payment to a person for managing one particular division of a company. All that, as long as he is not an employee, would fall within the ambit of fees for technical services. Fees for technical services would only get triggered if it is not covered by the provisions of employment. So if it is paid to an employee, then it would be covered by the provisions of employment, therefore outside the ambit of fees for technical services. But if he is not an employee, if he is employed on not on full time but as a consultant, and if he is engaged in rendering managerial services, then it would be treated as FTS. And as I said, managerial services would mean services for managing any particular activity or a company that would be treated as managerial services. Technical services. Before going to technical services, I will try and conclude what is consultancy services. Consultancy services again has been defined by, the definition has been given by several courts, and during the course of rendering these judgments, they have referred to various dictionaries also, law dictionaries. They finally concluded that the word consultancy services would denote services where there is involvement of consultation or a consultant. What is the purpose of a consultant or a consultancy service? It is to render an advice. It is to render an advice, or it is to render an opinion. Therefore, if you are invoking consultancy services, you will have to prove that there was a receipt of an advice or a receipt of a consultation from one person to another person. Only then the term can be defined as a consultancy service. Consultancy would be asking of an advice or solicitation of an opinion. That is what is meant by consultancy service. Now, first we have defined what is managerial service. Second, we have defined consultancy service. In between these two services is the word technical service. Managerial service cannot be rendered without a person involved. Consultancy service again cannot be rendered without a person involved. So both of them would require human intervention. Therefore, courts, while defining the word technical services, have held that even for a technical service to get qualified, it must involve human intervention. So if an activity is completely automated, if it is conducted only using machines, there is no human intervention. Although the word technical would get satisfied, it would not come within the ambit of 917 because there is no human intervention. The word technical is very simple. A service which involves technology is called as a technical service. A service or an activity which involves rendering or usage of technology is called as a technical service. To that extent, everybody is clear. But now the world has gone, now that the world is so much sophisticated that an activity can be performed without human intervention, in those cases, such activities are now excluded from the ambit of technical service. Only services where a person is involved, in rendering some work or doing some work using technology, only in those cases it has been held that a technical service would come into play. So when there is a rendering of managerial, technical or consultancy, only in these circumstances FTS would get triggered. So for a non-resident to fall, for a payment to a non-resident to fall under FTS, it should trigger any one of the three activities. I must again remind you that these are the three activities which are listed under the Income Tax Act only. It is not necessary that the same three activities would be listed in the treaty. There are some treaties which have said technical or consultancy. They have removed managerial altogether. So it is not necessary that the same three words should appear in every treaty. Every treaty is negotiated on the basis of each country's capability and its power. Therefore, it is not necessary that these three words should appear in every treaty. Most of the treaties would say only technical or consultancy. Some treaties still say managerial, technical or consultancy. Depending upon the terminology used, definition can be invoked in the treaty also. Most of the yes.
If the treaty is silent about it, then we fall back only on the Income Tax Act.
Treaty is silent on what aspect?
Management, technical and consultancy.
No, a treaty, if at all the word FTS is used. For example, if I'll get back. See, a treaty contains something called as articles. Within articles, there are again paras. So, if there is an article called as royalty and fees for technical services, then within that article, you will have a specific clause which defines what is fees for technical services. For some reason, if the article itself is absent, there is no question of invoking FTS. It would be treated as a business payment. You will test whether there is a PE or not. If there is no PE, the payment is not taxable. If the article itself is absent. But I would rarely concur with the view that article is present but the definition is absent. Because most of the treaties, wherever you see, there would be, if there is an article on FTS, definitely the word FTS would be defined.
So you're in one.
Outside India would also be treated as a income which is deemed to accrue or arise in India. Unfortunately, they have not included a foreign company here. So if for some reason a foreign company becomes a resident in India, for example, a foreign company due to invocation of this place of effective management, it could be treated as a resident in India. Even if a foreign company becomes a resident in India, if it declares dividend, that dividend is not treated as accruing or arising in India. Similarly, for example, if there is a foreign company, it earns its income substantially from India, or in fact 100% of its income, even if it earns from India, if it is distributing dividends, it is still not treated as accruing in India. So a foreign company is always treated outside, the dividends of a foreign company are not deemed to accrue or arise in India. That is the reason why you will find that the taxation of a foreign company is at a much higher rate, 40%, rather than your Indian company, which is taxed much lower, from 22, 25 to 30. It is taxed at a much lower rate because they feel dividends of the Indian company would anyway again suffer tax in India. But for a foreign company, the dividends would not suffer tax. That's why they have increased that rate and kept it at a much higher rate. My last limb of presentation would be on gifts to non-residents. This was not there. From 2019 onwards, they have brought in this provision under section 918. They say that any sum of money, if it is paid to a non-resident, then that sum of money would be treated as, if it is paid without consideration, it would be treated as income. Generally, gifts are on account of capital nature, so unless they are specifically treated, they would not be treated as income. All gifts are on capital account only. So, in order to tax those gifts, they have amended the definition of income, wherein they have specifically included to 27A, 17A, where they say that even a gift is treated as an income to the extent mentioned in section 56(2). So, to that extent, if there is a gift from a resident to a non-resident, even if the gift is given outside India, to the extent it pertains to a sum of money, that income is treated as accruing or deemed to accrue or arise in India. But that doesn't mean that gifts to close relatives are also covered here. 56(2)(10), with all its exceptions, will continue to apply. So even if a gift is given to a close relative, it will still enjoy the exemption as given in 56(2)(10). Only gifts to non-close relatives as defined in 56(2)(10) would be subject to tax here under 918. They have, from 1/4/2023 onwards, they have included not only non-residents but also persons who are not ordinary residents within the meaning of section 918. So, as long as the gift that is given is a sum of money, it is liable to tax, but if the gift is in the form of immovable property or movable property, it would still enjoy the benefit of exemption under 918, even if it is to an unrelated party. So, That is the framework of 918. With this, I think I have completed my part of the presentation on section 912, 912 to 918. If there are any doubts, I will be happy to answer.
Like in case of secondment,
Right.
you told that the reimbursement. Say there is no question of reimbursement. The subsidy, the company in India pays directly to the employees. I mean, non-resident employees. They were deputed to India and they were given employee numbers, employee contact is there, everything is there. But for the purpose of social security, the foreign company is paying some social security benefit with the home country. And there is no routing of money or something, anything. Even in that case also there will be a litigation chance in this second petition.
There would not be a scope for FTS, but there would still be scope for one service fee and two TDS under 192. See, you are saying the salary is divided into two parts. For the purpose of post-retirement benefits, there is a contribution outside India. For the purpose of salary, monthly salary, there is a payment within India. Payment within India anyway is subject to section 192 TDS. You will have to deduct and remit it. To the extent you contribute outside India, even if it is on account of whatever the terminology you use, it is you are paying that amount only because the employer has rendered the service in India. Therefore, this also has to be included in the computation under 190.
Yes.
So that is one aspect. Two, if at all the employees constitute service fee for the non-resident, to the extent of the services they perform, you have to attribute some profits and thereby non-resident has to pay tax. You will only be excluding FTS within the scope of the example that you have given. Other two would continue to be taxed.
TDS is being deducted.
Correct.
The person is a director, for example, as a company said he is a whole-time director and he will be employee. In that case also he will be constituting as a service fee.
Service fee, if it has to constitute, there are some guidelines. So every treaty would say there is some treaties talk about 90-day period, some treaties talk about some elimination period. If it constitutes a service fee, some treaties don't even have this service fee concept. So if at all there is a treaty, if at all you constitute a service fee, there is a possibility of attribution of profits. If you are not a service fee at all, then there is no issue.
The person stays in India for years together.
Sir, the problem is that if you look at that Morgan Stanley decision, they have classified employers as legal employer and economic employer. Who is a legal employer? If a person is deputed from non-resident to India, that person who is coming into India, he does not lose his job outside India. He continues to have a lien on the job which is outside India. He is only coming here, working here. So even if he is removed from his job within India, he would still go back to his home country and work for the non-resident because that job he never lost. So with this, the court said the non-resident is the legal employer, but the person who is using the services of this person, deputed employee, is the economic employer. In this scenario, in this fact set, they have said that economic employers have to effectively, they are the persons you are using. So any payment made by the economic employer to the non-resident, it is only for provision of certain technical personnel, therefore liable for FTS. That is how they have come to the conclusion. But it all depends on the activities performed by the deputed employer. In Morgan Stanley, a couple of employees came. Court said they have come for the purpose of ensuring the quality of work done by the subsidiary. It is only to maintain the quality of the non-resident by the subsidiary they have come. That would be called as steward service. As a owner, I am responsible for looking after my subsidiary. So in that role, I have sent employees. They are steward services, not liable for TDS. Was one. So what is the exact nature of activity that is being done by the deputed employees? All this would come into play in deciding whether FTS is liable to be, whether FTS gets attracted or not. It is not straight jacket situation.
One more, if it is the other way, that is the parent is paying directly to the employees and they is cross charging it to the subsidiary. So employees, because the money is earned in India, will have to pay tax at their level. And then the company, the Indian subsidiary, will also have to deduct TDS as FTS. So there will be double tax, economic double tax. So, is there any judgment on
No,
that?
I said no. Courts have, there is no fixed conclusion on this aspect. Most of the rulings seem to suggest that if there is no service fee, then there is no FTS also. But if at all there is a service fee, then there could be a possibility. I think this is a question that my next speaker would handle better because he's handling the service fee aspects. Yes.
So when you say professional services of person, do you mean only employees or it can be a person hired as a consultant?
If it is deputed by a non-resident, the word other personnel there, technical or other personnel, if he is being deputed by the non-resident, then yes,
The
it will be
contract is of a service contract, it's not an employment contract. So an Indian company is sending somebody to a foreign country. He's not on a salary, he's not an employee, he's gone as
Mostly
a
you will
consultant.
not get covered.
So then FTS will not. Is that very specifically
No,
there?
but he would anyway be covered by the main limb instead of this provision of the services. No?
We're just trying to read this also because the contract was very vague in certain terms, which is why we were trying to figure out this.
If you have engaged a person who is not the employee of the parent, you have engaged somebody who is not the employee of the parent, you are making a payment to him. You will have to test it directly under managerial, technical or consultancy. If he is satisfying that limb, anyway it would be covered as FTS. So if he is not falling on this limb, then he may be excluded under the provision of service employees. Because there is no provision of service, there is no provision of the personnel. You are engaging him directly.
No.
Provision of technical personnel would mean head office or the non-resident should send you the personnel.
The subsidiary is sending a person to the main company.
Okay.
So the subsidiary is Indian subsidiary.
Okay.
Is sending a person abroad.
So you are receiving income for sending that person.
Yes.
So
That
it
is
is
one name of the company. From the person's aspect, if he is going to a foreign country, is he considered as an employee because of this particular services of personnel? Do you have to be an employee or you can be a consultant also?
you can, but the relationship of employment or consultancy would depend on the relation of between you and the consultant. This provision doesn't put you into employment just because it is treating it as FTS. Employment or not is an independent fact which has to be established. Is he on your payroll or not? That is a fact which has got nothing to do with 917. But having decided that he is not on your payroll, having said that he is a consultant only, then you will have to test it under the main limb only, not within the provision.
So,
Yeah.
in make available clause, is there any concept called OECD countries? For example, with Switzerland, we are having a DTAA. The Article 12 is very clear that we have to tax that payment at 10%. But because that is a OECD country, we have to give them a benefit of make available clause.
So there is this concept called as MFN, Most Favored Nation. Most Favored Nation talks about invoking some other aspects of a treaty into the present treaty. For example, I am transacting with, say, Switzerland. I have a DTAA with Switzerland, India, Switzerland DTAA. In that DTAA, I don't have a make available clause. But if I have a DTAA with, say, Slovenia or Slovakia, it is a country which has a DTAA clause. And if it is an OECD member country, then there was a provision to invoke that beneficial thing into this. But everything has been unsettled by a recent Supreme Court 2023 judgment, wherein they said MFN is not automatic. There must be a notification through which only MFN can come, and they've almost taken a very divergent stand on MFN. So I would not now venture to invoke MFN without an explicit notification. Your answer would be a simple no. You'll have to test it, see a notification exists or not, only then you can invoke. If there are no other questions, then I thank you for a very patient hearing.
We all have studied Section 9 of the Income Tax Act 1961 briefly in our CA Intermediate and CA final in detail, right? RITA, Revisiting Income Tax Act 1961, now refreshing the provisions with practical aspects into it. It was our central concept member Kota S. Srinivasa's idea to get into this RITA. Expertise lies not in referring to section and then get to know some case laws and then when we come across that kind of a transaction, but refreshing and reading and researching the provision on a regular basis, which makes us expert. That can be with this RITA, attending RITA. Thank you so much, CA Chaitanya sir, for that wonderful session. A big round of applause for that. On behalf of members present here and all the managing committee members of Bangalore Bank, we would like to hand over the memento as a token of gratitude and respect. Can I request CA Arvind sir to come out to dais and then do the honors? Thank you, sir. Members, now we shall break for snacks and tea and then reassemble sharply by 6. Yeah. Welcome back, members. I welcome you all for this second session of second day of first module on RITA, that is revisiting the Income Tax Act 1961. For the second session, we have speaker CA K. Prasanna sir. Can I request our CA Ramesh Sharma sir to come out to dais and then welcome him with floor bouquet. Thank you, sir. I have privilege in introducing the speaker. K. Prasanna is a chartered accountant and a commerce graduate with more than a decade of experience in corporate and international taxation and transfer pricing. Prasanna has extensively advised clients on inbound and outbound structuring, holding jurisdictions, and business model evaluations. He also has extensive experience handling corporate litigations also. He has won the FIT Fellowship Scheme from the Foundation of International Tax for 2018 and 2019. He is a regular speaker at ICAI study circles and at the International Fiscal Association and has contributed articles on contemporary issues. He has contributed to the book on demystifying Section 194R published by Tax Sutra. With this brief introduction, I present before you CA K. Prasanna sir. Over to you, sir.
Thank you one and all who are present here. My apologies for the delay. I got stuck in traffic. So, Chaitanya, the earlier speaker, would have touched upon dividend, interest, royalty, FTS. So, if you look at the Section 9 order, so the business connection, asset or source of income in India, transfer of a capital asset in India, and then taxation of salary come first in the order 911, 912. And then the dividend, interest, royalty and FTS comes after that. But if you look at explanation to Section 9 subsection 2, the order is little different. The explanation says, irrespective of whether the non-resident or from the perspective of the recipient of income we are looking at, if they have business connection or not, the precedence goes to royalty, FTS. So therefore it is more appropriate that Chaitanya has preceded that session before I take over on Section 9. So this is just a glance of Section 9, like I said, 911 and 912, which is, if you look at 911 covers 4 facets: business connection, property in India, asset or source of income in India, transfer of capital asset in India. Salaries, I clubbed it together. If you look at Section 9, it has 2 limbs. 912 talks about salary earned in India, and 913 talks about salary paid by a government. So this is what we're going to deal with as part of this session. With regard to dividend, interest, royalty, FTS and gifts, it's already been dealt. If anything has been left out there, and if you have any questions, feel free to ask. Now before we move on to each of these segments, if you look at some of the cardinal principles of Section 9, why Section 9? If you look at Section 5, which would have been dealt in the earlier session, where the scope of total income of a resident or a non-resident has been bifurcated. With regard to resident, in respect of income accrue or arise in India or income accrue or arise outside India is taxable. Likewise, you have deeming fiction deemed to accrue or arise in India, deemed to be received in India. With regard to the non-resident, if you look at the accrue or arise outside India is not taxable. Only accrue or arise in India and deemed to accrue or arise in India is taxable. So therefore, the role of Section 9 is creating some sort of a fiction that okay, even though in respect of a non-resident or not ordinary resident, because the entire gamut of Section 9 is more relevant for a non-resident or not ordinary resident, because in case of resident anyway the income accrue or arise outside India is taxable. So therefore we need not to bother where does it accrue. Whether it accrues in India or outside India, the scope of income, total income covers that particular. But when it comes to non-resident or not ordinary resident, accrual arisal outside India is not there. So therefore, Section 9 creates a fiction. Even though your income is accruing or arising outside of India, because of some sort of nexus, the income as in India, Section 9 creates a fiction. Okay, I'm going to, because of these factors, what are all the factors, we will look at it in a while. Because of some of the factors which has a close nexus in India, it creates a fiction that although it is accrued or arisen outside India, by creating a fiction, I'm shifting the place of accrual back to India. If I paraphrase this with deemed to be received, the deeming fiction of receipt slightly operate in a different context. Because deemed receipt, if you look at Section 7 or Section 196 for that matter, although you don't receive actually, but it creates a fiction that you have received it. Whereas when it comes to Section 9, it cannot make an income accrual. There has to be an accrual already outside India, so as to create a fiction to shift the locale. So this is the slight difference between a deeming fiction when it comes to accrual and deeming fiction when it comes to receipt. One another important point which we have to be mindful is when it comes to Section 9 is, if the income is already accrue or arisen in India, then the question of Section 9 is not relevant. Why? Because it shifts the locale of it. If the locale is already in India, I don't have to look at Section 9 to create a taxation. And like I said, it cannot fasten an accrual. If an accrual has already not happened, Section 9 cannot make it an income accrual. So it can't prepone the accrual. All it can do is shift the locale. So this is the cardinal principles when it comes to Section 9. Moving on to each of the factors. Which are the factors which is connecting a particular income with India, which creates a deeming fiction? Now if you look at the first limb of 911, it does talk about business connection. But if you look at what do you mean by business connections, until 2003, we never had any definition of business connections. All the interpretations, everything is based on court rulings. Right from the beginning of Hero Mills till R.D. Agarwal, based on some of the fact pattern in particular case, they chose to interpret what constitutes a business connection. And they were also cognizant of the fact that I can't put a precise definition of what constitutes business connection, because the dynamics of business
is kept on changing. So therefore, if I put any specific definition which may not be sufficient to cover the future changes in the business model, so therefore they kept it open. That okay, based on the facts and circumstances, we will look at is there a business connection or not. Later part in 2003, if you look at explanation 2 was inserted. This explanation 2, if you look at, somewhat similar to a dependent agency provisions, which is there under the tax treaty. Like if I operate through an agent, if that agent habitually concludes a contract or has an authority to conclude a contract. Second, under the treaty generally we perceive is agent does not have an authority, but he habitually maintains the stock through which the goods are delivered. And third, in select treaties you have, close to 20 odd treaties you have, securing of orders. So these are some of the limbs which we will find it in Article 5.5 of any of the Indian Tax Treaty or 5.6. Then there is an independence agents concept. Similar concept has been borrowed and put in place under the definition of business connection. That too, it is only an inclusive definition. So therefore, not only this particular definition constitutes business connection, any other activity could also constitute business connection. What are those any other activities? If you look at the Rangoon High Court in Visalakshi Akshi, this is a classic case where the assessee was lending money to the earlier British India, to a Burma people. So therefore, the income earned in Burma out of that money lent, whether that will be taxable or not. So whether is there a business connection between British India and Burma? So it was discussed in the context of Section 42 of 1922 Act. So the court went on to look at the business connections to say that it must denote something which produces profits or gains. Why it talks about profits or gains is because the opening para of 911 talks about income arising directly or indirectly. I'm saying opening para of Section 9. Income arising. So there has to be some income for me to tax it. In order to have an income, it should lead to a profit generating activity. If I equate this with a tax treaty, we do have a preparatory or auxiliary exemptions in many of the treaty. If you look at 5.3 or 5.4 in any of the treaty, it says if a particular person, non-resident, carrying on any activity in India which constitute preparatory or auxiliary, then that particular activity cannot lead to a permanent establishment. Why so is because the activities of this nature which was listed in 5.3 or 5.4 is not an income generating activity. Even if someone were to say it is an income generating activity, the possibility of attribution income may not be so material, so therefore they want to put a threshold. Okay, I am going to look at an attribution only if the activity creates a fiction of a fixed place establishment. So therefore they want to exclude it. So likewise in business connection, it should be something which produce profits or gain and not a mere state or condition which is favorable to making the profit. So therefore, not every activity that I do in India can automatically result in a profit. That activity should be such that it is capable of contributing to the profits of the non-resident. So therefore, they went on to define or interpret business connection in this manner. So therefore, there is a distinction whether all the business transaction that a non-resident carry out could lead to a business connection or not. We always have a distinction either to before 2018 or 2020, before the introduction of SAP, which we will deal later, whether transaction with India versus transaction in India. When a non-resident makes a sale, whether a non-resident is taking part some activity in India or is taking part some activity with India. So say for example, a non-resident is selling the goods, all the titles, everything has been transferred outside of India, and then the Indian buyer pays the customs duty and then takes the good. Whether this transaction can be capable of arguing that it is a transaction in India. If one were to look at or dissect what is the activity of the non-resident in India, no part of the activity is being undertaken, right from the procurement of raw material, manufacturing, quality productions, sales and marketing. Everything happens outside India. Delivery is happen outside India. The Indian guy is only importing the goods. So per se, no activity is undertaken in India. So it is a transaction with India. So this distinction, although it is a business transaction, but it cannot partake the character of a business connection. So there is a distinction needs to be drawn as to what constitutes business connection and what constitutes business transaction. Because what essentially section 9 is targeting is business connection, not business transaction. Business transaction we will come later point when we deal with SCP. Subsequent to this Visalakshi Archie, we had several other jurisprudence. One of the famous jurisprudence which many of the courts look at is the principles emanating from R.D. Agarwal, the Supreme Court, where the Supreme Court said that business connection undoubtedly means something more than business. There has to be some activity which the non-resident has to undertake in India. Why the requirement of activity is essential is, if you look at explanation 2, which defines business connection in an inclusive manner, there also it talks about activity carried out by a non-resident through an agent. So therefore there has to be some activity which requires to be carried out. Look at explanation 1, subclass B, which talks about attribution. We will deal with it little later in detail. There also if you look at the principles of attribution states that if all of the activities of non-resident is not undertaken in India, then the income generated from a particular transaction could be reasonably attributed to the extent of activities undertaken in India. So therefore, there is a requirement of activity undertaken in India in order to constitute a business connection. So therefore, they said it should be much more than the business. Business carried out, like we already see, that it aims to yield profits and gains. Then third, what they say is there has to be some element of continuity is required. A stray or isolated transactions cannot be regarded as a business connection. Why so is, when I have to establish a connection of a non-resident with India, because it uses the word connection, a connection is not established in a single transaction. It has to be a meaningful connection. If I have to say there has to be a meaningful connection, there has to be some continuity in the transaction. So therefore they went on to say that a single isolated transaction cannot constitute a business connection. But if you look at the definition of business, 2 subclass 13, a business includes an adventure or a trade. An adventure is a one-off transaction. So we need not to confuse the definition of business with connection. We have to read this together to say, to form a meaningful connection. So therefore, there has to be an element of continuity. One-off transaction cannot trigger business connection. It may take many forms. The court went on to say, an agency is through which you can conduct a business. You need not directly engage in marketing, you engage an agent. So therefore, this is one form of a business connection. Other forms could be establishing a branch could lead to a business connection, because branch is nothing but a main entity. While commercially it may be 2, for tax purpose it may be 2, but in a legal form, in a legal fiction, branch and head office is one and the same, but for tax purposes it could be 2. Even in case of a subsidiary, could also form a business connection if the activities of the parent and subsidiary is so interlinked. Point of control could also be regarded as a business connection. These are some of the principles which is emanating from various rulings which the R.D. Agarwal also taken cognizance of. Then they have highlighted that each case has to be looked at and depending on the facts and circumstances, a particular case may constitute business connection, a particular case may not constitute business connection. So all along we have been only looking at business connection. So there was a issue came up before one of the courts. The word used is business connection. Does it includes professional connection? Wherein the court said that business need not to be looked at in a normal sense. It has to be looked at from a commercial point of view. Even a professional, occasional or consulting could also trigger a professional connection. The Andhra Pradesh High Court in GVK Industries has culled out various principles from different rulings to put together what are the factors or characters that it could lead to a business connection. If you look at each of the limbs, it is a connection between Indian person and a non-resident. It's a mixed question of fact and law. Because as I said, in the R.D. Agarwal, it has said it depends on the facts and circumstances. So they have said it is a mixed question of fact as well as law, which has to be determined based on facts and circumstances. It is too wide to admit of any precise definition. I can't put a precise definition because the business is evolving, but it has some attributes. Some of the attributes which they have highlighted is it should be close, real, intimate relationship and commonness of interest. So the close, real, intimate relationship is what highlighted here in the earlier ruling of R.D. Agarwal, which talks about a continuity and isolated transactions. Continuity versus isolated transactions. So there has to be some element of continuity should be there for to constitute business connection. That is what defined in the third bullet, close, real, intimate relationship. Commonness of interest, like it said, holding subsidiary relationship, some point could lead to a business connection. Point of agency is also a form of business connection, which we will deal in the subsequent slide. A control and management of finance or substantial holding of equity shares. There must be continuance of activity. So this is what the Andhra Pradesh High Court has consistently, based on the past rulings, has observed, which was approved by the Supreme Court in the 2013 ruling. Now there was a strange ruling in 2020 in the case of Volkswagen Finance Private Limited, wherein an intangible business connection was discussed. The facts of the case is Volkswagen India Private Limited was launching a different model. They conducted a show in Dubai. Close to 150 odd people has flew from India to Dubai to participate in the show. They have invited a Hollywood actor, Nicolas Cage, to come participate in the show, just to render a speech, and then part of greet and meet will be there for about 30-35 minutes. For this, Volkswagen Finance Private Limited has paid a lump sum, close to $4 lakh to the company which is owned by Nicolas Cage, the promotion company which is owned by Nicolas Cage. So the question before the tribunal is whether the payment made by Volkswagen Finance Private Limited is subject to withholding or not. In the context of 195, what the tribunal held is, if you look at the purpose for which the event is conducted, it is the business of the Indian entity. The targeted customers are all from India. The product is going to be launched only in India, although the promotional event is conducted outside India. But nevertheless, everything is related to India. So therefore, a business connection court have already held that it is not a precise definition, it is an evolving definition. Since all these factors is closely linked with India, so they said there is some sort of an intangible business connection which is created. So therefore, this particular payment which is made by Volkswagen Finance Limited is subject to taxation. But unfortunately, if you look at from whose perspective, I have to look at the business connection. It is only from the recipient perspective. But all the factors which the tribunal has looked at are all from the payer's perspective. Now, in order to constitute business connection, there has to be some activity which the non-resident has to undertake in India. What is this activity that the company of Nicholas Cage undertaken in India? All the activities are happening outside in India. And if you look at the sportsperson related, I think 194 BB, where any payments made to a sportsperson or an entertainer includes the actors. So the payment is taxable in India only if the activities are performed in India. So therefore, unfortunately, the tribunal has not disregarded 194 BB or even Article 17 of a particular treaty, but chose to operate in an intangible business connection model, which looked at from the payer perspective. So therefore, I believe this ruling is not an appropriate ruling.
The charge comes from 194 BB. The charge for what is the
Charges under the rate, I think 115 BBE or something, there is a specific provision which includes entertainment. The rate is given in 194 BB, 20%.
But even in this instance, attribution can be only to the extent activities are performed in India.
Agree. But the court, the tribunal has not looked into the attribution principles at all. They have said, from a payer perspective, they have looked at and they said that it is unchargeable to tax in India.
Why even go to 115 BB or 194? Is there even in line?
Yes, I agree. So that is why I said the ruling is erroneous. Now, if you look at section 9 explanation 1, there are some exceptions which talks about purchase for exports. If you look at 1922 Act section 42, there is no such exceptions for purchase of exports. Even a non-resident who has come to India doing any purchases, the courts have said those activities constitute business connection because purchase is a significant component of a particular business. It may not be a critical function in case of a manufacturing, although it is a critical function, but from a overall activities perspective, if you look at raw material procurement is only a part. You do your R&D related for manufacturing a product, and then production process, sales and marketing. All these activities are also important. So therefore, courts under the section 42 S12, section 42 of 92 Act has said this is one of the important factors. So therefore, a business connection is constituted, but when it comes to attribution, I am talking about the 1922 Act. So therefore, they have restricted the attribution to the purchase activities. Later on, so this particular explanation was inserted in 1964, where after the 1961 Act, where the government believed that in order to attract foreign customers or rather foreign manufacturers, I may have to give some leeway for them so that they come and do some sort of a business in India. They will also look at India as a country where I could purchase products. So therefore, they gave this particular exemptions that if your activity in India is confined only to exports, that is, you purchase the goods for exports, then this particular exemption is available, which although it could lead to a business connection, explanation 1B says no attribution. So in effect, business connection definition has been nullified by attribution. But if you purchase the product, later on you are selling the product, let's say for example you set up a branch in India, you purchase it and if you sell it, then this particular exemption is not available because it is a proper business. Yes, ma'am.
The last bit again.
Sorry?
If you set up a branch,
If you set up a branch, purchase the goods, but sell the goods in India. It is a proper activity, it is not for export. when it comes to export, there are some critical judgments which are there. If you look at the case of Mushtaq Ahmed, where what has happened is, this is a case where an individual who is carrying on a proprietary business in India, he purchased products, he was selling goods, diamonds. As a part of another activity, he was purchasing some garments in India and then exporting it to Singapore for his subsidiaries. So he had two set of business, but the activity which is undertaken in India is on a proprietorship basis as well as this. So therefore, he filed an application before the authority of advance ruling whether the activity of purchase of goods for the purpose of subsidiaries outside India, whether it could fall under the explanation 1B to section 9, whether the activity is confined to exports or not. The authority for advance ruling has said this: the purpose of section 9 is only if the income is accruing or arising outside India. You look at your fact pattern, you already have a proprietorship through which you are purchasing goods in India, diamonds, and then selling goods in India. As a part of same proprietary, now you are purchasing different set of goods and then exporting. So therefore, you are carrying on a business activity in India and your income is already been taxable by virtue of section 9. I need not to go to section 9 for you to get an exemption, because I cannot look at business connection qua each activity. I have to look at qua assessee. So you are already carrying on an activity which translate into an operations are carrying out in India. How can I give an exemption to another activity which is housed in the same proprietorship business? Yes, ma'am.
To that extent of purchase, it is not attributable, right?
So, problem is business connection is looked at qua assessee, not qua activity. So if tomorrow branch is manufacturing and it is housed in SEZ, it is manufacturing and selling goods. The same branch purchases some goods and then sell the goods to its parent. Will you say this particular activity I will give you a 9-month exception? You are looking at an activity for a branch.
Agree. But the profitability related to the purchasement of procurement activity is still not taxable
Why?
because of the same explanation.
I am purchasing the goods and then I am selling it. You have already carried on an activity here, right? So the individual, in this case proprietary concern, is buying the goods and then selling it, which is itself is an activity.
Agree. To the extent of manufacture, whatever profit has to be paid, tax on profit has to be paid, has to be paid. But are you saying that the procurement activity, merely because there is another activity undertaken in India, the procurement activity will also be taxable?
Yes. Similar to your proprietary, right? A non-resident is carrying on multiple activities, right? If each of the activity is not proprietary, then you can't claim an exemption for one. Okay, activity A, it is proprietary. Activity B,
The two distinct activities. Procurement as a separate team, manufacturing as a separate team. You are saying the assessee will be penalized because he is doing more.
yes. You do it in a different entity.
If I register it as a separate branch,
You will possibly get an exemption. Here, in the same proprietary concern, he was doing it. So once already section 5 is triggered, the AR said, where is the question of me going to section 9 to relieve you from this? In your case, if there is two branch, although PAN everything will remains the same, but you are looking at qua different activity. But under the MLI regime, it will be tested together depending on the choice adopted by the respective treaty partners. Otherwise, each activity will be looked at because this particular branch is different. B branch is different. I will look at these activity in isolation. But if there are certain treaties where automatically provides you for combining this, say for a classic example India-UK, where it makes you to combine these activities together as a whole to see whether you are crossing the limit of preparatory or auxiliary. If that combining is not there, you will escape, otherwise you will get caught. Now,
I thought there was some narrowing down of the scope a couple of years ago, not able to recollect.
that is on the SCP point, which I'll cover that later. After the so they have carved it out, this particular exemption for SCP. So another important ruling which came from the Karnataka High Court in the case of Mondial Orient is, in this case what happened is, so this particular company has set up a branch. The branch was doing some consulting to its head office based on the requirements and specifications of the head office. It goes to various vendors to look at the qualitative parameters of vendors, their manufacturing process, everything, and finally it provides a sign off. Based on that, the goods are purchased by the head office. Likewise, this particular activity was also done to third parties. So in that case, department alleged that it is a classic case of a business connection, because this activity is not confined to purchase of goods. Apart from activity you perform to your head office, you are also performing this activity to third party. So it is proper business, so therefore you will not be covered by explanation 9(1)(b). The Karnataka High Court reversing the decision of the tribunal, where they have said this, if you look at 9(1)(b), nowhere it uses the explanation that activity of purchase that is confined to purchase is qua the non-resident. It is qua any non-resident. So you cannot restrict, as long as the activity is confined to purchase of goods, it doesn't matter whether you do it for your parent, that is head office, or you do it for a third party. This exemption is equally applicable. This is one strange ruling from the Karnataka High Court.
Nike decision, the controversy is the same, right?
Yeah.
So it is not unique. That position is being contested
Yeah.
by the revenue across.
It is pending, Nike is pending for the Supreme Court. And then Columbia Sportswear is pending before the Bombay High Court. Because Columbia Sportswear also same fact pattern, where AAR held it is taxable. Against that AAR ruling, they went to Supreme Court. Then Supreme Court said it is not the right forum to file a SLP, you go to the respective High Court and challenge the AAR ruling. So therefore it has gone to the Bombay High Court. It to be tested with a particular position. And there is an exclusion for news agencies or shooting of cinematograph film. This shooting of cinematograph film is slightly on a different. When it comes to royalty, in 2021 they made an amendment that even shooting of cinematograph film could fall under the definition of royalty, but they never made any amendment in section 9. Earlier there was an exclusions under the royalty, but that exclusion has been removed only from royalty, not in. So these are some of the precedents on continuity and real and intimate connections, which subsequently relied by the GVK Industries, by the Honorable District Court. Now moving on, agency business connection. For the time being, we will focus on what is there in before 2018, and we will look at why the requirement of amendment came in 2018. So if you look at, so this is the definition which was inserted in 2003, explanation 2. For the removal of doubts, it is hereby declared that business connection shall include any business activity carried out. This is what I was highlighting. In explanation 2, it talks about carried out through a person who acting on behalf of a non-resident. Then it gives what are the parameters where this could trigger a business connection. The person who is acting on behalf has and habitually exercise in India an authority to conclude contract on behalf of non-resident, and there is an exception unless his activities are limited to purchase of goods or merchandise for non-residents. Why this particular exemption is, if the non-resident is directly doing an activity in India which is confined to purchase of goods, you anyway don't attribute anything. How does it make a difference if I am doing this activity through another person? So therefore these exemptions were given even in case of if I am doing any activity through an agent. Then the second limb says, has no such authority but maintains in India a stock of goods or merchandise from which the agent regularly delivers. So therefore if there is any occasional delivery, this particular clause may not trigger. If there is a regular delivery, this could possibly trigger. And in treaty, when it comes to preparatory or auxiliary, there are some issues in different treaties, because each treaties either gives a preparatory or auxiliary exemptions for delivery, some gives only for occasional delivery. Say for example, India-US treaty gives an exemptions only for occasional delivery. And third, habitually secures orders in India, mainly or wholly for the non-resident or for the non-resident and the entities which are common controlled by the non-residents. Either I do it for the non-resident or any of its subsidiaries or associate enterprises who are subject to same control. So therefore, I will not only look at the non-resident, because the word used is mainly or wholly to a non-resident as well as his subsidiaries. So I will combine together and see am I securing contractors or contracts on behalf of them. This particular issue came up in GE Energy Part Sync, which the Delhi High Court has dealt with, where close to about 18 countries where GE was operating. So the case was regarding the 18 entities which are operating in multiple jurisdictions. The Indian entity was concluding some contracts, which is the department alleged that you are doing some bit of activity, marketing activity on behalf of the non-resident. So the Indian entity argued that you look at, I am not only doing this activity to one particular person. Within the same group, I am doing this activity for multiple persons. So therefore, I am an independent agent. What constitutes independent agent will come in a while. So this is what they have argued, where the court said, nothing doing. I will not look at for each entity. All the entities for which you are doing a marketing function is one single group. So therefore, I will combine all these entities as a part of a single group, and I will look at this particular agency related criteria. Now, if you look at, this is the budget memorandum in 2018, where they looked at some of the developments in OECD as well as the BEPS Action Plan. The BEPS Action Plan 7, which was released in October 2015, has highlighted several issues in the context of a permanent establishment, that is specific to agency permanent establishment. What are the various structures or possible pitfalls there under the existing treaty, which are used by the MNCs to come out of the agency PE related aspects. So India looked at these provisions, and then anyway we have entered into an MLI in 2017. Depending on the choice of the provisions between the India adopted and between the other counterparties adopting, my treaty language with regard to agency PE may undergo a change. At that time, I should have a similar definition under the domestic law. Otherwise, what happens? 90 subsection 2, which says that if the provisions of the act is beneficial, then a non-resident can adopt. So therefore, between the wordings of the treaty and wordings of the domestic law, whichever is beneficial, the non-resident will adopt. If my treaty language is so wide to cover any agency PE, but if the domestic law definition is not so wide, naturally the non-resident will say, okay, apply the domestic law provisions because that is more beneficial. So therefore, it should not lead to such a situation. The Act was amended in 2018, all on account of WIPS Action Plan 7. Now what has happened after this when it comes to explanation 2 is, the first bullet has unhabitually exercised in India and authority to conclude contract remains the same. They went on to add or habitually plays principal role leading to conclusion of contract by non-resident, and the contracts are in the name of non-resident or for the transfer of ownership of or for the granting of right to use property owned by non-resident or that non-resident has right to use or for the provision of services. So they've expanded this definition similar to MLA. So the only difference between the multilateral instrument and the wordings which are used is, in the multilateral instruments, they are used about principal load leading to conclusion of contracts that are routinely concluded. The word routinely concluded was removed. So therefore, a non-routine transactions could also be possibly covered under this explanation too. Then the second line with regard to habitually maintained stock remains the same. Habitually secures orders in India remains the same. So the changes happened in link 1 alone. And if you look at another important changes which has happened is, in the erstwhile definition, it says unless its activities are limited to purchase of goods or merchandise for the non-resident. This particular exception is not there when it comes to the 2008 definition. However, explanation 1B remains intact. While a specific exemption is not given under explanation 2, but explanation 1B still confine you that particular benefit. So therefore, despite this particular amendment, there is a possibility to argue that while it could trigger a business connection, but you can't do any attribution if the activities of an agent is confined only to purchase of goods.
Triggering a business connection, but there is no attribution.
Now, these are some of the terms which we have already confined to acting on behalf, similar to an agency relationship that we have under the Indian Contract Act, where I have to involve the non-resident to some extent, that there has to be the binding force on the non-resident. Habitually, the word used is, so similar to what we saw in business connection, the traditional court-driven rulings, where they talk about some sort of element of continuity. Likewise, here the words used is habitual. It need not to be regular. We have to distinguish between what is regular and what is habitual, because some of the choice of words has been used interchangeably. We have to be careful about what is the choice of words that has been prescribed in each of this and be mindful of that. Habitual is something short of regular. There are some elements which could prove when an agent is said to have authority to conclude contract. One, by nature I do this, or the principal has given me an authority, you go ahead and do whatever you want. See, majority of the online contracts now we have, when it comes to even for that matter Microsoft, the license agreement has been passed on to the agent. giving in a colloquial sense, because there are occasions where the Microsoft license are distributed. Assume for a moment, it is not a distributor, it is only an agent. The contracts are so standard that you don't have a choice but just to bind the principles. Agent is so independent that the freedom has been given by the principal to act in whatever form he wants. He has been authorized to negotiate all the elements, if not all, majority of the elements of a particular contract. And the approval in case of those contracts by the non-resident is mere formality. The agent has undertaken all this. I am so happy. I just have to sign the contract, that's all. In substance, everything happens in India except for just an approval. Court, even before the 2018 amendments, the Indian courts have looked at. I will look at what is the critical elements or major elements that the agent is concluding for the foreign. If the major elements are concluded by the agent in India, and if the non-resident is merely approving, merely because the contract are ultimately signed outside India, does not mean the contract is not concluded in India. Conclusion has happened here. It is only the vetting which is happening outside India. It is like a form versus substance test. And there is an interesting para in the OECD Model Convention which is equally there, where what happens, there are occasions where the agent is also present with the principals during the course of a meeting where negotiations have happened. Unfortunately, if you look at the para in the OECD, it is still what dicey. It doesn't give a clear answers. Many of the provisions does not give a clear answers when it comes to this. It says, if an agent is present in a meeting with the principal where negotiations are happening, it gives an indication that agent is also concluding the critical elements. Immediately after this, it is not only indicative, possibly a lack of active involvement is also being used. So somewhat dicey, if a mere presence of an agent automatically in a meeting, does it mean that he has concluded all the elements? What happens is just going there, sitting and listening to what the principal is discussing with the customers. But the burden of proof is first on the department. They have to prove that agent has undertaken in the meeting. But how do you prove all this? It's all choice, it's all by substance. The manner in which the interactions between agent and principal happens. Because many times we never know, some of the mail communications between the agent and the principals gives an indication that agent does all this. Classic cases, if you look at most of the sales and marketing activity which is undertaken by the Indian subsidiaries, where if you look at some of the appraisals of the employees, they have been appraised based on the sales incentives or the sales that they have generated, leads that they have generated. These are some of the indicators to say that okay, he is doing an active involvement. Because I have been remunerated based on the sales that I am generating, which means there is a clear indication that India is doing much more than what has been agreed in the agreement. So therefore substance is what relevant and not the form of what the agreement says. Principal role leading to conclusion of contract. What we looked at is the traditional agent. Now we will look at after the M&A comes into force. What do you mean by principal role? Role intends to include arrangement where conclusion of contracts directly results from the action that performs in a source state on behalf of the principal. So therefore, what it essentially says is the conclusion of contract which is happening elsewhere is mainly on account of the activity or the efforts that was put forth by the agent and not by the principal. the test focus on substantive activities. Because the word used is principle. If you look at when it comes to indirect transfer, we use the word substantial. Various provisions under the Act uses the word substantial. Say for example 79 talks about 51% for carry forward of loss. Likewise, here there is no proportion when it comes to, there is no predefined threshold. That if someone does 50% or if someone does 70%. I will only look at what activity contribute that leads to the conclusion of this contract. Whether it is the activity of the agent or is it the activity of the principal. If it turns out it is the activity of the agent, then the activities of the agent is a principal role which leads to the conclusion of contract. And it should be tested in the light of the object and purpose of para 5, which is the OECD, which covers activities of the person or intent to result in regular conclusion of contracts. So here also some bit of regularity is being discussed. It is a facts sensitive one. If you look at the last bullet point, the person who negotiate in a state all elements and details of a contract in a way I bind the foreign enterprise, then that particular person is said to play a principal role leading to conclusion of contract. So these are some of the parameters which are discussed as part of Action Plan 7, which is now inbuilt in the OECD Model 2017 currently, as well as in US Model currently.
Securing contracts then has no difference with conclusion of contracts.
In a way, if you look at principal role leading to conclusion of contract or the securing of orders, there is not much of a difference. Unfortunately, in any of the jurisprudence, if you look at, there is no clear-cut definition of what constitutes securing of orders. A securing of orders, if I have to put it in a small, let's say for example, it is falling short of a conclusion. I do all the activity, but I don't do conclusion. Conclusion I leave it to the non-resident. So I am securing some spot, but that particular spot, in this case the contract, is concluded by someone. What difference it has when it comes to principal role leading to conclusion of contract? If you look at only 2 treaties which India has, somewhat gives an indication what is securing of orders. One is India-US when it comes to exchange of notes, or even in the protocol they have defined, and second one is India-Switzerland. They have given you some indications where they say the conduct of the agent has to be looked at. If the conduct of the agent is such that, okay, it gives an impression to the buyer of the goods that if an agent agrees to a particular elements of a contract, it is as good as accepted by the principals. If your behavior with the customers are such that, then possibly it says securing of orders. That is what the US treaty and Switzerland treaty gives an indication. But if you look at some of the precedents, take case of Rolls-Royce, or even for that matter, the MasterCard ruling. They never went on to explain how the Indian entity has secured the contracts. They went on to decide, okay, they have secured the contracts because all the contracts and proposals of a particular contracts are routed through the subsidiaries.
This last bullet is in the context of principal person leading to the securing or conclusion of the contract, not in the context of securing or concluding contracts.
But India's, even before this particular para comes into force, has looked at the substance test. While the contracts in some of the cases were signed by the non-resident outside India, but court still went on to rule that by substance, India act as an agent. So these are some of the precedents on authority to conclude contracts, which the GE parts also have discussed. Now when it comes to independent agent, all along we said, if I do, these are the activities, I am an independent agent. But when do I become an independent agent? One, I have to prove that whatever I do as a part of this, let's say this agency business, it is in my normal course. And my business or the supervision is not there by the overseas entity, that is the principal. I have a degree of my own control. The control is not exercised by the overseas principal. If the overseas principals day to day, if they give me a directions, the manner in which I have to conduct my business, then legally I am depending on it. Then second aspect what we have to look at is economic dependence. Economic dependence is nothing but the proportion of business that I have with the principal. If tomorrow the principal stops his business, will my business independently in India survive, capable of surviving on its own? If I am only doing this particular activity to one particular principal, then I am economically depending on him. If tomorrow if he does not give a business, I am not able to survive. So therefore, I have to see whether there is a legal dependence or whether is there an economic dependence, and whether the activity carried in the ordinary course of business or not. If legally I am independent, so therefore the choice to perform this activity is vested with me. Economically I am also an independent and I am doing this activity in the ordinary course of business, then I am an independent agent, not an dependent agent. One interesting point when it comes to this particular is, here the wordings used is ordinary course of his business. Whereas in the multilateral instruments, the wording which is agreed is ordinary course of that particular business. So therefore, a dispute could arise in a situation where I also do some distribution activity on my own, and I am also doing some agency functions for a principal. Because the wording used is ordinary course of his business, should I look at qua the assessee? I am doing distribution business and I am also doing an agency business. I will combine these business together to see I am economically dependent to the principal or not. The multilateral instrument says it should be looked at qua that particular business. What for I am testing the dependency or independency? It is for the agency business. So therefore, that particular business alone has to be considered to test the economic dependency, not the entire business of the independent agent or the agent. Whereas under the Act, there is a possibility to argue because the choice of word used is his business. Under the income tax itself, there are divergent ruling. In one particular case, they have said qua that particular business, agency business has to be looked at. Whereas in another case, you have to look at the entire business of the agent. These are some of the precedents when it comes to. So, the amendment to explanation which you are asking. If you look at the bold highlighted part, explanation 1A, in the case of business, other than the business having business connection in India, on account of significant economic presence. So therefore, if your business connection is triggered on account of significant economic presence, then explanation 1A is not applicable. So therefore, if you look at this particular impact, if a business connection is triggered on account of explanation 2, that is agency relationship, although the explanation 2 does not excludes purchase of activity after 2018, but still possibility to apply here. But if the business connection is on account of SCP, then this particular exemption is not available. So that is the impact of the amendment which has happened in explanation only. So this is the sum and substance of the business connection, traditional business connection. We will move on to SEP, which is also a business connection.
Under the treaty, how is procurement exempt?
Under the treaty, if you look at Article 5.4 or 5.3, where the third limb or fourth limb talks about purchase of goods. There it never talks about export or import. It says all purchase of goods are exempt. But there are some fine differences in some of the treaties, where some treaties says if you carry out a particular activity which are described in 5.3 or 5.4, depending on the clause in which the preparatory or auxiliary exemption falls, it is deemed to have been exempted. It is an exempted activity. Even you can set up a branch in India and do this purchase, even though it could be a substantial activity. Say for example, a non-resident is conducting a distribution of goods. It engages a branch in India to procure goods. For a distribution function, in a normal scenario, purchasing is an important activity. But the treaty never considers all that. It says, if your activity falls under that particular exemption, which is listed in 5.3 or 5.4 of the relevant treaty, it is deemed to have been exempt. But there are certain treaties which says that, no, it is not like that. I will look at for each activity, whether each of this activity fit within the ambit of preparatory or auxiliary or not. Only then you are entitled for exemption. That is what got amended in MLI, where the preparatory or auxiliary exemptions are subject to various abuse. So therefore they wanted to plug the loophole. But they have given some options to the countries to choose. Either you say that if the activity is listed in the treaty, either in para 3 or para 4, will be given an exemption only if it is satisfied the preparatory or auxiliary independently or on a collective basis. Let's say for example, like he has, what if I have a multiple branches? Each branch carry out some activity. Individually it could be a preparatory or auxiliary. But if I combine all the branches together, it may not pass the threshold of preparatory or auxiliary. It may go beyond preparatory or auxiliary. In that case, an option has been given to the respective countries. Either you chose to keep silent, maintain the status quo when it comes to the treaty, or give exemptions if the activity strictly falls under preparatory or auxiliary activity, either on a standalone basis or on a combination. That is how the exemption falls. Again, 2018, significant economic presence came into picture. This is on account of Action Plan 1 of the base erosion profit shifting. Action Plan 1 was in a draft stage where they said many of the digital companies able to generate lot of profits from the market-centric countries without having any physical presence. If you look at, for example, Google, although Google India has a presence here, Facebook presence here, but still in those days they will be able to generate so much of business because of the users in a particular country. Amazon is a classic example in the early days where you order goods, you get delivered. Now you do have an Amazon India. So likewise, without having a nexus, because traditional business connection requires you to carry out an activity in India, whereas the digital companies were able to generate revenue without even conducting any of the activity in India. So therefore, what they believed is, we have to bring some sort of nexus when it comes to digital companies so that the market jurisdiction is a main factor for digital companies able to tax some of the profits which are generated by these digital companies. So therefore, in 2015 they released a draft report wherein they've said they've identified some 3 parameters. One, either we have to come up with some sort of a nexus which should connect the foreign companies, that is the digital companies, with the market jurisdiction, or you do ad hoc withholding in respect of all the transaction, or 3, some sort of an equalization levy. This is what some of the types of aspects they have discussed. But at that point in time they have said we are not going to recommend any of these factors to any of the countries, but India chose to pick it up, and they have introduced significant economic presence. If you look at the 2015 as well as 2018 report, the 2015 report has given 2 different factors on a mutual basis. One, the digital companies able to generate so much of profits in a market jurisdiction on account of the transactions that they are undertaking with the respective market jurisdiction as well as the user. So they've said, okay, if we have to create a nexus for these digital companies, we have to look at these 2 factors together. There has to be a level of transaction and then the level of user. Put together, you create some sort of a nexus. India borrowed this idea, and what they did is, instead of using these 2 factors collectively, they have chosen to use this factor in an independent fashion. That is what translated into significant economic presence. If you look at for the removal of doubts, it is hereby clarified, I am reading from the 2018 amendment or 2018 introduction, clarified that significant economic presence of a non-resident in India shall constitute business connection in India, and significant economic presence for this purpose shall mean transaction in respect of any goods, service or property carried out by a non-resident in India, including provision of download of data or software in India, if the aggregate of payments arising from such transaction or transactions during the previous year exceeds such amount as may be prescribed. They never use the word and, they chose to use the word or systematic and continuous solicitation of business activities or engaging in interaction with such number of users as may be prescribed in India through digital means. This is the initial definition which was introduced in 2018 in respect of significant economic presence. But later on they have realized that this sort of definition, if you look at limb A, is nothing but a transaction based, limb B is user based. Because if you look at the last line, transaction during the previous year exceeds such amount. So it is a transaction given, whereas in clause B talks about such number of users. So this was used in an independent fashion. Later on they have realized this is somewhat similar to a business connection because it requires carried out by a non-resident in India. So therefore, already we have seen these digital companies is not conducting any activities in India, then how different will this be if I chose to implement the definition in the same fashion? So therefore they have amended in 2020 that transaction in respect of goods, service or property carried out by a non-resident with any person in India. So therefore, if you look at the difference, earlier the non-resident has to carry out an activity in India, whereas now the non-resident has to carry out an activity with a person in India. So therefore, as long as he transacts with a person who is in India, then if that particular transaction exceeds the threshold which is prescribed, then it could potentially trigger SCP. Likewise in the limb B, such numbers of users in India, they have removed the word through digital means. So either you do the systematic and continuous solicitation of business through a digital mean or through a physical mean, it doesn't matter. If it exceeds the prescribed number of users, then it could potentially trigger SCP. Now the transaction limit which they have prescribed in July 22 is 2 crores. When it comes to users, the limit prescribed is 3 lakh users. So some of the factors which they have said, it is irrelevant. Yeah.
Just thinking out loud on all these, the royalty and license fees and FPS payments that you do to your ultimate holding company, makes it a significant economic presence.
I have a specific point on that. So what happens if you look at the last bullet?
Yeah.
So explanation 2292, where it gives a priority to royalty or FTS. Because whether or not you have a business connection in India, there it doesn't say only a business connection of traditional nature. Business connection also includes SCP. So therefore, even if you have an SCP, the right goes to royalty or FTS. The moment a specific clause which already taxes this particular transaction, you need not to again look at that particular transaction to determine the limit under SCP. See, the purpose of SCP is existing 9 able to capture some of the transactions. Now I want to cover those transactions which is not falling under the existing transactions, be it royalty, FTS, interest, dividend, or even the traditional business connection. Now anything which is left out in all this, I want to cover it as part of SCP.
So, we have a subsidiary and an ultimate holding which is outside. Now, the subsidiary in India is paying royalty. The recipient is the ultimate holding outside India. The moment he receives, the ultimate holding is receiving the royalty, they have to file the returns in India.
Yes.
Which is why this SCP is coming in picture and they are filing returns in India. Is this the trigger?
No, if you look at 115A, which prescribes the rate for non-residents in case of a royalty or FTS. If you look at before 2021 amendment, a non-resident is not required to file a return of income in India in case of a dividend or interest, provided the rate at which the tax is withheld on this particular transaction is as per the rates prescribed under 150A. Now if you look at more at that point in time, the rate under the treaty is much more beneficial when it comes to royalty or FTS. 10%, whereas under the Act, at that point in time, it is 10% plus surcharge and cess. So invariably people were taking. So anyway, that exemption under 2021 was not available for royalty or FTS. So therefore 139 if you read, every person has to file the return of income in case of a company. The exception was given only with respect to dividend and interest. Later on, this particular exemption was given equally to royalty and FTS, provided the rate of reduction of tax at source as per the domestic law. Now the rate of reduction as per 115A is 20%, which is what carried out in the first schedule.
So the moment you do one as per 115A, then you don't need to file it.
You don't need to file the return.
Then what about this SCP? Because you have a significant economic presence, will that get connected?
So now what happens when, let's say we have 3 different transactions. One I have a royalty, one I have an FTS, and third one is a sale. Majority of the cases, let's say for example, the rate as per the treaty for royalty and FTS is only 10%. But you chose to deduct 20%. The non-resident also don't want the headache of filing the return. But when it comes to SCP, as a taxpayer, what position I will take? because until July 22, there was no limits that has been prescribed. Now, the limit which has been prescribed is 2 crore. Assume for a moment I cross this 2 crores. So should I, now there is a SCP trigger, but on account of SCP, is there an income attribution? So only if there is an income, there is a question of you offering that income. The charge is created in India. If there is no income in India, then the question of you taking a TT exemption does not arise. If that is the case, you don't have to file the return. Okay? Still confused? See, the issue which came up when it comes to majority of the cases is most of the non-residents need not to be a related party. Majority of the Indian MNCs has been purchasing goods from a third party suppliers. When it comes to third party suppliers, when you make a remittance, you don't have to file 15 CB because there is a specific carve out is given. In case of import of goods, you don't have to file. If the purchase is more than 2 crore, SCP is triggered. Now the moment SCP is triggered, should I presume that there is likely to be an attribution in India? Because all along this is not regarded as a business connection because no activity. Now that activity is displaced with a transaction based test. So therefore, merely because SCP is there, is it trying to tax all those companies that are untaxed? Is one question. If you look at, that is not the case. This particular provision was inserted to tax those companies who has an economic allegiance with India, but they were never paying taxes. I still believe, while it could possibly be an SCP, but there is no attribution is left. But when it comes to digital companies, you look at why they are bringing these sort of systematic users in India is because, let's say for example, I transact, if I transact, I will fall under limb A, this particular limb, because this deals with any goods, service or a property. But when it comes to users, what do I do? See, today I go to Amazon. For a moment I search some products, but I don't buy anything. Later on, if I open a Facebook or Instagram, an ad keeps pop up that you have searched for this product, an offer is available. Even from the app, it generates a notification and a mail also comes. So it starts systematically and continuously soliciting a business, or it is engaging an interaction with this user. With this, what does it gain? It undertakes the interest of the users. Which are all the products the users are interested. So therefore, the ability of the companies in targeting these users could be properly achieved. Say for example, if 3 lakh users have used a particular portal to look at a certain products. Now, as a Facebook, I have this data that so much of users in India is interested in this particular product. I can go to that particular company, say you don't channelize your energy in some other country. Look at the number of users which are interested in these products in India. Why don't you channelize your energy in this particular country? I can get the data and sell the data. If a user has purchased a product, I may not fall under clause B. After an interaction with the user, eventually you purchase a product. It never talks about goods or services. It only talks about interactions. If it's goods or service or property, you anyway fall under clause A. So therefore, even in 1 year, say for possible, SEP may trigger. The what they target is the data when it comes to link B. You get the data, but you're able to sell outside India. But the data belongs to users in India. So therefore, that is why they brought this particular factor. While the BEPS action plan was discussing this as a part of transaction and digital factor together, India looked at it differently because the pool of users that are using the social networking. That is why in general there is a saying that the more amount you spend, because they never charge you. What the consideration that the social media is receiving is the amount of time that you spend on a platform. That is the consideration for them. So as much time you spend on a particular social media, they are able to generate so much of data, which data they could mine it and then they can monetize it. This monetization is what India is trying to attack. So this is some of the distinctions. There if you look at link A covers all modes of transaction because goods, property, services, everything is being covered. Non-resident is not required to carry out an activity in India because of the 2020 amendment. A stray or isolated activity, while it may not be a traditional business connection, it could possibly be covered here because of the transaction limit. Because the transaction limit is 1 crore. In a single transaction, I make a sale of, let's say, 10 crore. While in the context of business connection, I will say that there is no continuity of business. So you can't treat me as a business connection, but nevertheless, it could be a business connection on account of SAP if I cross the threshold of 2 crores.
Will the attribution happen in case of sale of data?
No one has a clue about it.
Will it not be subject to legal?
Equalization levy is there for the time being.
Subclause D, there is no mention of during the previous year. So is it lifetime users?
So if business connection is tested qua the previous year.
Yeah, because in the first leg, it specifically uses the word during the previous year exceeds such amount. Whereas in the second leg, there is no mention of during the previous year.
Because in the first one, it requires a transaction.
Right.
So therefore the transaction is for the year. But if you read along with section 3, 5, everything, because section 5 scope of total income is for the previous year.
Agreed. I'm saying if my lifetime users are 3 lakh versus my users acquired during last year are only let's say 50,000. So should I go back?
It is for the year. One particular year it is.
Acquired or interacted?
So the problem there it comes is who is a user. Let's say for example, when we are, let's say we are not a premium customers of YouTube. Whenever we see any of the songs or any of the video, there is an ad which comes. You want to skip the ad, but unfortunately you click the ad. Another window pops up. Will I be regarded as a user? But if you look at the 2018 the interim report of the BEPS Action Plan 1, where they have tried to distinguish between active user and a passive user. What they intend to cover is only the active user. Why? Because the usage of language is systematic and continuous solicitation. So when you do a systematic, it is some sort of a planned one.
Curious to know how you will say you are not using YouTube. How are you not a user when you are using?
No, you are a user of a YouTube, but if an ad pops up in between, some Amazon product comes, by mistakenly you have clicked, it will take you to the portal. So even if you look at, there were times where Google charges you based on the number of clicks. I can mistakenly click something, but it gets counted. You look at the income tax department, in the bottom of the website it says number of users visited. I still open my income tax website in this. Today morning I connected to the Wi-Fi in your office. Immediately it got loaded. It gets added. My intention is not to visit the income tax website today, but it nevertheless gets added. You look at the advertisement of when the new e-filing portal was launched. It said so much of users visited the website. You will never know whether actually someone visited or by inadvertently someone has visited. So there in the action plan interim report is trying to differentiate between active user versus passive user, but nevertheless they never made any conclusion because it is being an interim report. But here the word used is systematic and continuous solicitation. So therefore there has to be some meaningful communication between the non-resident and then the users in India and engaging in interaction. If you look at here, the solicitation was.
Sorry, back to that page, the previous page, the next page, sir. So
Sure.
what is the final conclusion? Are we going to include royalty FTS?
See, if your royalty or FTS is already taxed as a specific provision under 916 or 917, that particular transaction need not to be looked at for SCP.
So
Let's,
determining limit, we will take only the goods purchases and the
Yes.
users.
because this being a specific over general, because 9.2 explanation talks about this. Something is already been taxed. No point in again including it. The purpose of SCP is not there. And something on, they have also talked about download of data software in India.
In practice, you will end up filing a return because the rates under the Act are higher than the treaty rates. Second, you may also need to file a Form 3CEV for the non-resident, which a lot of people miss.
No, so we do that. That's why I was wondering because this is a new thing to me. SCP.
No, it is only on the limits point I
Huh.
brought this.
I-
Unfortunately, what happened when they gave the exemption under 115A, they never gave any exemption for 92E. Someone, there are instances where some of my clients have taken a view that I will not file the return, but I will only file Form 3CB. In the return, you have to give the details of SCP now from 22 onwards. Assessment year 22-23, most of the assessments for non-resident is picked up mainly on account of the disclosures of SCP. That you have disclosed so much of transaction, but you never offered any income. What happens to that income? They issued 143. Uses some of these issues is act of solicitation versus infractions. A solicitation will, how do I then say what is a solicitation? How do I different between infractions? Does it generate all the time income, which is what I explained? It is all on account of the data I generate, which I can monetize it. The monetize also happens at a different point in time. You refine the data further and further and further. But mind you, if you look at, as long as the data belongs to the user, it doesn't matter. Not only the primary sale is subject to taxation, even the secondary sales. Say for example, one non-resident obtains the data from India and it sells. Let's say for example, Facebook sells the data to Google. This is taxable. Google sells the data subsequently to HP. That is also taxable because those are the data belongs to user in India. And 3A, if you look at attribution, this is only on attribution. Whenever it says, say for example, for removal of roads, it is hereby declared that income attributable to operations carried out in India as referred to in explanation 1 shall include income from such advertisements which targets a customer who resides in India or a customer who accesses the advertisements through Internet Protocol address located in India, sale of data collected from a person who resides in India or from a person in India. So for example, you trigger an SCP in 1 year, 3 lakh users have been exceeded, data has been collected. In the subsequent year, the data has been sold by Google in the form of an advertisement, which is getting taxed because that particular advertisement is considered for the purpose of attribution of income. You have triggered an SCP, but income is generated in subsequent year, it goes get tagged along with the disk. So this sort of nuances is yet to be addressed. What happens in a scenario where business connection on account of SCP is there in 1 year, but income is generated in year 4 or year 5? How do I keep track of this? Those are some of the issues still open. And anyway, now for the interim period, you do have equalization levy. But if you look at this particular line items, which is equally there in equalization levy, the only point of difference between equalization levy and then the SCP is mainly on account of the limb A. Because when it comes to limb A in equalization levy, it has to be done through an online platform. Whereas here, the requirement of online platform is not there. That is the only difference. Because rest of the things has to be done, advertisements or interactions with the user. Majorly will be to, if you have to reach out to the 3 lakh users, generally, possibly only through a digital means. Unless someone say like in election exit polls, how they go and take the survey, it's very difficult.
Section 9 will have precedence over EL, right?
No. EL, the exclusion comes if you are having a permanent establishment and then that income is effectively connected with permanent establishment, then only equalization levy not applies.
Royalty FTS also has precedence.
Yes. If it's a royalty or FTS, it never fall in this.
Right. And then, no, I'm talking about EL interplay. So, if it is, you're saying SCP does not have precedence over EL. So, to that extent, there is an overlap between SCP and EL will hold the field now.
Yeah. I'm just skipping this slide because capital asset is a little important. I'll come back to this slide if the time permits. So, if you look at the last limb, through or from any capital asset situated in India, that is what section 911 talks about. How does this fiction is created when it comes to capital asset situated in India? It's mainly on account of the asset is situs of the asset in India. We have a specific definition of capital asset under 240. Transfer is also separately defined under 247. Situs of the shares of a particular company. In the Vodafone case, as well as in some of the private international law, if you look at, it is categorically said that the place where the company is incorporated is the place where the shares are located. What about intangible property? Will be a question. Where does the intangible property resides? We had a controversy in the case of Foster's Australia ruling, where the AAR said the situs of the intangible property resides in the place where it is exploited, which the Delhi High Court rejected, and they relied on one of the Latin maxim, mobilia sequenta persona, which says that intangible follows the owner. Where the owner of the intangible resides, that is where the intangible also resides. If the owner is outside India, applying this maxim, intangible is also residing outside India, which this particular ruling had relied on. It is pending before the Supreme Court. This particular maxim came in the US on account of levying an estate duty. There, what happens if a person who dies in a particular state-wise estate duty, but the proceeds has to be passed on to someone in another state. So for administrative convenience, they put this maxim to say that, okay, let the state where the person had lived and died, that state will levy. That was done for the purpose of administrative convenience in those days, but unfortunately that has been relied on by the Delhi High Court, where many of the people believes that this may not hold the water before the Supreme Court. This is one point which I just thought I will lay it out. And then in 2012 we did have an indirect transfer provision which was inserted with a retrospective effect after the math of Vodafone. In Vodafone, what they've argued is through or from a transfer of a capital asset situated in India. So therefore, the revenue tried to expand this definition of through. Through means in consequence of. So therefore, the indirect transfer is subject to taxation in India. I will explain the Vodafone structure. Then we had after the aftermath of Vodafone, explanation 5 to 7 along with the relevance rules between 2015 was formulated. And there was a clarification in the context of overseas dividend. Now if you look at, simplify the structure of a Vodafone, you did have an Hong Kong entity, Cayman entity, Mauritius entity, there was a Netherlands entity as well, but I have simplified the structure, which owned ultimately the Indian entity. Purchaser was from UK to Netherlands. Now this Cayman shares was sold to the Netherlands entity. India argued, if you look at the Cayman entity as well as the Mauritius entity, both are only investment entities. All the values of these two entities is represented by the asset that the Indian entity holds. So what they essentially transferred is not the shares of the Cayman entity, it essentially transferred the shares of the Indian company. So therefore, in consequence of an asset which is located in India, department wanted to tax this particular transaction, which the Supreme Court said, no, let me not read the word through in the manner in which the department says, because there is no provision. Although section 9(1) says income accrues directly or indirectly, it is not from a through a capital asset situated in India. What has been transferred is only the Cayman shares. I can't see through the structure to say that what you have transferred is the Indian assets. So therefore, to overcome this particular ruling, they have inserted several explanations. One, I have not included explanation 4 here. Explanation 4, the word through was clarified in terms of, in means of, or in consequences of. To overcome the observations of the Supreme Court, they have inserted explanation 4 to clarify what do you mean by through. Then explanation 5, they have inserted that, okay, I don't want to tax all the indirect transfers. I want to tax those indirect transfers which substantially represents value from India. This came after the Shom Committee's report, which was released in 2012. In 2012 itself, indirect transfer provisions was inserted, but the explanation 5, 6, 7 came only in 2015. In between, there was one particular ruling of the Delhi High Court in the case of Bhopal Research, which I have highlighted as part of explanation 6. So explanation 5 says that if the value of overseas assets is substantially derived, its value from the asset located in India, then possibly I create a fiction that there is a nexus between what the income is generated outside India vis-a-vis what is the asset in India, thereby section 9 is attracted. Explanation 5 in 2017 says exclude investments that are held by non-residents by a foreign institutional investors category 1, category 2 AIF, FPA, I don't want to include. Because those are all anyway under the FEMA, they can't hold more than 10%, so they wanted to exclude them. Explanation 6 has been inserted to define what do you mean by substantial value. They are given two conditions. One, I want to look at those assets in India which has the value more than 10 crore. And second, the proportion of India assets vis-a-vis the overseas assets should de minimis be 50%. Valuation rule is prescribed. How do you determine this particular item? When do I determine 50%? At what point in time I should determine this 50%? There is a specific definition. Now between 2012 and 2015, there was a case of an indirect transfer where explanation 5 and 6 is not there. The Delhi High Court interpreted the word used when 2012 provisions were introduced is substantial. So substantial could possibly mean 50%. They have also went through the Shone Committee report which resulted in 2012 amendment to say that 50% is the ideal criteria to determine the indirect transfer. So therefore, in that particular case, 50% threshold is not crossed. So therefore, they said no indirect transfer. Explanation 7 is somewhat what happens in a scenario where Indian assets is more than 10 crores. In overseas, the proportion may satisfy. 1% shareholder, if he sells the share, shareholder is holding only 1% shares. Or even someone holds only 1 share. If he sells the share, indirect transfer should possibly trigger in the hands of a shareholder, because the shares which I have sold, the shares of the overseas company, that derives value substantially from India. So therefore automatically the share which I own in the overseas company should also corollary get the substantial value from India. So therefore they don't want to tax all these sort of small shareholders. So therefore they come up with a limit that if you are holding in a particular entity is less than 5%, then I don't want to tax you, because the determination of 50% threshold and other things requires getting the balance sheet of the company. As a minority shareholder, I may not enforce the company to share all the balance sheets, not only of the foreign company as well as the Indian company. So therefore they want to give relaxation to the small shareholders. One another important aspect that explanation 7 looks at is the attribution principles. Because, let's say for example, the value that the overseas shares derives from India is 60%. Explanation 7, I have not included here, but I just thought of clarifying it. It is also coming out of Rule 10 UC. If your proportion is only 60%, then India gets a right of taxation only to the extent of 60%, nothing more. So that proportion has been addressed as part of explanation 7, read with Rule 10 UC. Unlike in case of treaty, where some of the capital gains articles, if you look at, if the overseas entity's shares is principally contributing or principally deriving its value from an immovable property located in India. Let's say for example, there is a Japan entity, there is an Indian entity. Indian entity is a real estate entity. A shareholder of Japan is selling the shares of the Japanese entity. If the Japanese entity's share value is represented by the real estate property that India has, then the treaty says the right of taxation goes to India. So the moment you determine if the value of this particular shares is deriving value from the immovable property which is located in India, there is no proportion concept there. Treaty allocates the right of taxation to India. The proportion concept is inbuilt under the income tax by virtue of explanation 7, read with 10 UC. While the treaty may give you a 100% rate of taxation, but by virtue of indirect transfer, you will limit your taxation rights only to the extent of proportion. This is one situation where the domestic law provision is much more beneficial compared to the treaty, because treaty does not give you any proportionality, whereas domestic law gives you a proportionality. So corollary, you will apply domestic law. So the determination of specified date, when do I look at this 50% criteria? It gives two situations. One, the last balance sheet date of the overseas entity I will look at, or the date of transfer. Between these two dates, which date I should take? Axis. If there is no substantial change in the book value of assets, you ignore liabilities, focus only on asset sides. Between the accounting date, that is the last balance sheet date, vis-a-vis the transfer date, if the change in book value of asset is not more than 15%, then you go and pick the balance sheet date. If the change is more than 15%, then I have to look at the transfer date to determine this 50% threshold. It is only for the purpose of relevant date to determine 50%, for nothing else. You will only look at the last balance sheet date and the date of transfer to say which date I have to fix to see the limit of 50%. And then you have this proportionality. There is a specific valuation which is prescribed in Rule 10UB, through which we will identify this proportionality. Just a simple case to explain. Let's say, for example, in case 1, 31st March 23, my book value is 500. On the date of transfer, the book value is 525. The difference is not more than 15%. So therefore, I go and take accounting date, the last balance sheet date. Whereas in case 2, if you look at, the difference is more than 15%. So therefore, I have to go and pick 24/3, which is the date of transfer, for the purpose of determining this 50%. Likewise, in case 3, 50% is not crossed. So therefore, you will look at only the closing date. See, some issue could possibly come up because of this is, let's say for example, in the case 1, 31st March 2023 we have taken. In 31st March 2023, you may possibly cross 50% threshold. But as on the date of transfer, you may not have crossed. But despite that, possibly indirect transfer provisions will apply. Corollary, in the second scenario, on the date, or rather in the third scenario, on the date of transfer, you might have crossed 50%. But on the date of the balance sheet, you might not have crossed, or rather you might have crossed. This possibility is there because if the gap between the closing balance sheet date of the foreign company and the date of transfer is so wide, let's say 31st December was a sale happening somewhere in September, 9 months, anything could happen. But the Act chose you to look at only the asset side of it, because they feel that with liabilities you can play around. You can infuse some debt within the company to pull down the value, so therefore they want to look at only the asset side of it. So this is
being reported somewhere is how do we assess? Now, sitting in India, you're looking at a balance sheet of an Indian company. There will be multiple companies that they are connected to. How do we assess if there is a capital transfer happening elsewhere?
See, as a part of group restructuring, something happens, possibly you may come to know. There is a form which is specifically required for reporting of this indirect transfer.
Which forms?
I think form 48B or something. It is
As an annual this thing?
not annually. Whenever there is a transfer, section 285A or something is the section which.
61B. Form 61B.
Oh. So 285A is the section which deals with the reporting, where if you don't file the form, 5 lakh is a penalty. if it is on account of transfer of shares. If it is on account of any transfer of interest, then the penalty is 2% of the value of a transaction.
So if we don't know then,
You don't have a choice.
You don't have a
we
choice.
have to ask and get.
You have to assess.
So what happens is, there are various mechanisms as well, even for companies that you have to report significant beneficial ownership. SBO, you have to look through all the structures. Now, if you look at the recent times, the regional directors of one of the state has levied a penalty for not reporting an SBO. They look at different interpretations when it comes to a limited partnership, because they have applied the laws of Delaware to say that the owner of the limited partner is supposed to be a beneficial owner, which the company failed to disclose, so therefore they levied a penalty. So those sort of positions one has to look at. See, majorly what happens when it comes to a listed entities, you will come to know, because potentially LODR regulations may trigger, if it goes beyond a certain point, open offer.
Private company.
For a private company, you don't have a choice, just to ensure every year group structure is there a change. But when there is a specific, in one of the cases we got to know, because the overseas started asking some of the questions, you give me the valuation, you give me the valuation. So when you are, what for you are asking for this valuation, that's when they opened it up. No, there is a potential transaction which is going. If it is 1 or 2 layer, you will definitely know. But what happens if it's a series of 4 or 5 layers?
Exactly.
Unfortunately, you have to keep appraising the client, that be aware of this particular.
What's the form again, sir? What's your form again?
4090.
What?
4090.
60 monthly.
No, not SFT, sir. For this indirect transfer form, they are asking.
4090.
Pardon me.
This form need not be filed if
There's no transfer.
no, transfer is there, but the substantial interest requirement is not met. If that is met, this filing is required. So you'll have to do the assessment and thereafter make.
So there are cases where majority of the treaties will relieve you from indirect transfers. So in those cases also, if the threshold under the Act is crossed, you may have to file the form. This particular indirect transfer has reached Supreme Court in the context of Sanofi Pasteur. But after this introduction of Vivad Se Vishwas, after this Clean Energy and Vodafone India arbitration, in 2023, there were a series of amendments were brought in that India wanted to settle some of the indirect transfer disputes, which were inserted after Vodafone with the retrospective effects. So as a part of that, the SLP was withdrawn by the department in the context of indirect transfer. So how many minutes I have? Quickly cover a salary earned in growth.
Sir?
Yes. So is it? See, we do have a specific computation mechanism under section 15 for salary. If you look at limb by limb, it is taxable either on due basis or payment basis. But section 5 uses the word arise. So therefore, is there a difference between arise or due? In some of the cases, they looked at, there is a distinction between arise versus due, but it has been used interchangeably. When it comes to the situs of the source of a salary, there are some English code decisions which has been borrowed by the Indian courts to say that the situs of the place of salary where it accrues is either it is where the contract, employment contract is made, or where the payment for the salary is made. Either contract is made in India or the payment is made in India. If these two conditions are satisfied together, that is the place where the situs of the salary is there. Now, if I were to shift the situs, let's say for example a non-resident employees, you would have entered the employment contract outside India, and you would have enforced the payment of salary outside India, but he comes for a deputation in India. So how do I fix the nexus? So therefore, from 1922 Act, they borrowed this definition, salary earned in India. If the salary earned in India, then nexus is created. So therefore, Section 9 is triggered. In one of the ruling, P. Natale, the Gujarat High Court said, earned in India means service has to be rendered in India. If the service is not rendered in India, then it is not be regarded as an earned in India. So therefore, they have said a portion of salary is not taxable in case of a non-resident. So therefore, Act made an explanation to say that
It's the other way around. They said because the contract was entered into outside India, it is not earned in India.
So therefore what they have said is, you have rendered a service in India, that doesn't mean that I will not tax you. So they overruled this ruling by putting an explanation, says that earned in India could be equated as service rendered in India. If you rendered the service, then it is equivalent of earned in India. This particular part is subject to a short stay exemption under 10(6), where if the non-resident, not being a citizen of India, because citizen of India, short stay exemption is not there. Only if you are a non-resident. If your visit to India is less than 90 days, then by virtue of 10(6), you are getting an exemption in any case. But if you are more than 90 days, but less than 180 days, for the time being ignore the 120 days related issue, then one has to look at Article 15 under the treaty to look at will I get any TPS exemption or not. So if I render any service in India, so by virtue of this, the accrual which is happening outside India has been shifted to India. Now some conundrums, if you could see, if the employer is based in India, services are rendered in India, anyway Section 5, taxable. This is what non-resident. Employer based outside India, but services are rendered in India, salary received in India or outside India, it doesn't matter. Services is rendered in India, so I create a fiction. Fourth point, employer is based in India, services rendered outside India. Salary received in India or outside India, taxable in India. Why? Because accrual. Yeah.
Services rendered outside India, it should not be taxed in India. Let's leave the receipt out. If the service is performed outside India, it's not taxable.
If the employee contract is entered in India, and if it is required to be paid in India or outside India, possibility to argue. Courts have laid out that it is accrued in India. So 3 and 4 is right off. Positions has to be looked at.
You're on the last point, right?
I'm on the last one.
Employer is in India and service by the employee is rendered outside India.
The third point, employer is based outside India, services is based outside India, salary received outside India, not taxable because Section 5, none of the limbs is covered. If salary is accrued and paid in the same year, taxable in India on a receipt basis. One controversy is there between the receipt versus accrual. If something is already accrued but received later point in time, what happens? Let's say salary is accrued in one particular month but payment is happening also. But if it is in the same year, there is a view it is taxable on receipt basis based on Keshav Mills and Raghava Reddy rulings. And if it is received in India later part of the year, there I could easily argue it has already been accrued in the earlier year, so mere receipt in the subsequent year cannot make the income taxable once again. But with regard to the item number 2, there is a controversy between receipt versus accrual or receipt versus due. My point is, now if 6 months salary is already accrued, but the payment is happening in the later part of the 6 months, although it is within the same April to March, will I be subject to taxation by virtue of receipt?
Question and
If it's
So-
already, if you're saying taxable in India on receipt basis in the same year, then the same logic should apply for the next one also.
So that-
Controversy is in the point.
So here if you're saying, if it is two different here, we are accepting, because explanation also gives if something is already accrued and taxable, by virtue of its receipt in the subsequent date it is not taxable. But what happens if it is in the same year, something is already accrued? So when you test section 5 under each of the limbs, if something is accruing or arising in India, you don't go test it on a receipt basis. So what happens if a salary is due in the first 6 months, but I pay the actual payment in the 12th month, but the payment is happening in India?
It's either
practically a reduced treaty benefit.
So whatever I am discussing is subject to treaty. I am only on act.
Accrual has happened because taxability is based on accrual. So the receipt at the end of the 12th month is also not the taxable event. I will look at and test it for accrual.
There is a view based on the Supreme Court decision in Raghava Reddy application is receipt being in India, so therefore if it is happening in same year, possibility of taxation in India. So therefore this particular theory is yet to be tested, because there is a proposition which Padam sir and Chaitanya sir had written in decoding section 5, where once the income has already been accrued, then whatever you receive after its accrual is realization of a debt. So therefore what I do is only a realization, so there is no actual receipt. This is a proposition, interesting proposition.
On a lighter note, very difficult to test this because very rarely will you have salary received after 12 months.
So that's all from my side. Thank you for your patience. Any questions?
After listening all the class, only one thing. Government will find a connection somewhere that you have a connection with India, even though you don't. Okay, finally, so thank you so much. A big round of applause for that wonderful session by CA. On behalf of all the members and all the managing committee members of Bangalore branch, we would like to hand over a memento as a token of gratitude and respect. Can I request CA Arvind sir to come over to dais and hand over the memento? Thank you so much. Thank you once again.
Good morning, members. Welcome you to the third day to revisit income tax. Today we have CA Kaushik Raj with us for a session. Welcome you, Kaushik Raj. I request Kaushik to occupy the desk. I request Jayashree to welcome him with a floral bouquet. Thank you, sir. K. Kaushik is a fellow member of ICI. IBB registered valuer for asset class SFA and has graduated in commerce from St. Joseph College. He qualified in the year 2014. He was associated with the Big Four for a period of 2 years and was involved in handling tax matters of MNCs and representing before various tax authorities like CIT and Appellate Tribunal. He has a strong passion for direct tax and has been regularly taking classes for students of Company Secretary and Chartered Accountants course. He is currently a partner in Kaushik and Shivram Chartered Accountants, leading a direct tax practice. He is an active speaker in many forums. He specializes in business valuation, direct tax, startup consultancy, and advises on business process solutions, startup business solutions, ERP implementation, and migration services. He has experience in structuring various companies right from incorporation to funding. Over to you, Kaushik. On behalf of the Bangalore branch, I would like to present a gift voucher to Kaushik.
Very happy morning to everybody. How's the course going on? Good? Section 1 to section 9, all clear? That's what is being completed, right, till now? Isn't it? That's what is being completed? Section 1 to 9? Okay. How is it being till now? So how is the actual learning or revisit? I think most of you would have already seen. So how many of you are in practice? All of you are in practice? Okay, how many of you are new to practice? Or you are in industry and you have come back to practice? Something like that? Okay, we have a couple of them. So it will help you for you to see, get the practical insights from the perspective of the provisions then and now. Isn't it? Okay. So what is that you have learned in the last 2 days is something about the basics of income tax, the charging provisions of income tax, and the computation of the scope of total income in section 5 and deemed income provisions in section 9. Isn't it? Yes?
Right.
Now we will, until now in the last 2 days, you have been talking about incomes which are taxable. How to tax income? What is taxable? Something that is going to be completely how to get under the purview of the taxation bracket or the taxation net of the consideration. But today it is a break, okay? Our entire module or entire curriculum for the number of days that the program is scheduled, every day or every session talks about how to tax, what to pay, how to pay, what is the interest, what is the penal provision, what is that not going to be, exemptions and the exclusions and inclusions, everything is about the taxation perspective. But in today's next 3 hours, we will be only discussing the incomes which are not going to be taxed. Okay? So, what is that exempted completely? We call exempted in the sense we know that this certain categories of people are exempted, certain provisions are exempted. When we say that it is certain provisions are exempted, that means to say what is included in a particular set of provision is the set of A, B, C, D. Out of this, certain things are not included, X, Y, Z. So that is called as exclusions or the exemption, due to which certain criteria. So in such similar fashion, we will be learning today what are the incomes which are exempted from the general understanding or general provisions of section 1 to 9, what you have learned till now. Because the charging section 4 talks about completely what kind of income to be taxed, isn't it? Section 4 you would have learned now, right? What is charging section? There is a charging section which says that it has to be taxed. And section 6 comes into picture from the residential status perspective. Based on the residential status, we get the scope of total income. ROR, RNOR and NR basis, the taxability will be determined what kind of income, whether income received in India will be taxed, income accrued in India will be taxed, income deemed to accrue or arise in India will be taxed, income deemed to be received in India will be taxed. So there are 4 categories that we can get. One is received, accrued, and then you have deemed to accrue or arise and deemed to be received. So these 4 categories based on residential status, it becomes chargeable to tax. Apart from this, we have certain deeming fictions. What is not is considered as income. Generally, what is not considered as income, by virtue of compulsion, by virtue of making it compulsory deeming it to fit as taxed under the income tax provisions. So that is coming under section 9, where if though income is not received in India in certain time, it is taxable. Though income is not earned in India, it will be considered as taxable in India. So these are the things that is gone till now. Now, we will quickly move to understand what are the certain categories of income which are not coming under any of this charging sections or inclusions. So we will be looking at what are the incomes which are not chargeable and in what scenarios and to whom. Okay. So that is the entire objective of this next 3-hour session, split into 1.5 hours and 1.5 hours. We will be having certain break, and then we will proceed to the next set of exemptions. So now I have divided the session. Probably the first 1.5 hours is going to be very important and commonly used exemptions, which are applicable for medium and small kind of businesses and individuals at large. Okay. Then in the second half, we look at from the international perspective, that is in case of non-residents or the international organizations or the foreign companies get certain exemptions in certain investments or certain incomes that they earn in India by way of certain transactions that they enter into between the Indian entity and the foreign entity. Are we all set? Have we set the context in the right manner? Any disalignments or any disconnects? Are you all with me? Yes. Okay. So let's proceed. Let's have some introduction. So like I said, exempt income can be, section 10 entirely talks about exempt incomes. Okay. And I think you might have also seen the structure of the entire Income Tax Act. There are different chapters in the Income Tax Act. And chapter 3 deals with entire exemptions in the Income Tax Act. So the first thing is the agriculture income, which we say is exempt in India. because it is by constitution, Article 366 has told that the agriculture income is exempt and not chargeable to tax in India. We'll get into detail as to what is the kind of agriculture income and all of that. So that is the major part. For 15 to 20 minutes, we'll deal with that agriculture income specific, section 10, subsection 1. And then we move on to other exemptions in specific. Like I said, the first part of the session will be covering the important and frequently used exemptions that are most likely applicable to many of the medium and small businesses as well as the individuals. And then we move on to the less likely used exemptions, but we'll try to touch upon those as well in the second part. And in the last, if we get time, if time permits, we will also touch base upon the special economic zone, section 10AA exemption. This is primarily applicable for the businesses which are located in the special economic zones and operating for export of services in terms of the encouraging the export aspects of the country or getting more of foreign currency into India. So this is the broad framework with which we will be going forward in today's session. But before we actually dive into agriculture income, let's spend a minute or so in terms of understanding what is exempt income vis-a-vis deduction. Okay. As we progress along, you will get introduced into different 5 heads of income. Correct? So you might be aware that there is something called as 5 heads of income. Any income, it should categorize and fall in this 5 heads of income. When this 5 heads of income comes into picture, there is something called as deductions that are available in the each heads of income, which is called as head specific or income specific deductions. Apart from income specific deductions, we also have general deductions under chapter 6A of the Income Tax Act, 80C to 80U. Okay. So these are the two deductions where we enjoy in terms of the computation of the income. Now, when we say deduction, that means it is not chargeable to tax. Let's say my income is 5 lakh rupees and I say 1 lakh deduction is given. That means what is the income that is going to be taxed? 4 lakhs. So on 4 lakhs only tax I am going to pay, that is 1 lakh I am not paying. In net, on 1 lakh I am not going to pay any tax. So the resultant is that I am getting the benefit of not paying tax of 1 lakh by way of deduction. That is one way of looking into it. Now coming to the exemption, the word exemption. Exemption means if I say I have 10 lakhs of income, 2 lakhs of income is exempted. So on what is the amount that I am going to pay tax? 10 lakh is my income, out of that 10 lakh income, 2 lakh income is exempted. So what is the income that is going to be taxed? 8 lakhs is going to be taxed. So net here also, the quantum of exemption that I am telling is not subject to tax. So there is no requirement for paying any tax on that 2 lakhs of exempt income amount. Now what is the key difference between the first scenario of 1 lakh deduction and the second scenario of 2 lakh exemption? The end result that I am not paying tax on this both incomes which are eligible for deduction vis-a-vis eligible for exemption on the other hand. But it is very key to note that what is the difference between the deduction and the exemption. Okay, so exemption is the kind of benefit that is given without even forming part of the computation. It gets the benefit of non-payment of tax and it remains outside the computation mechanism. That means when I take the computation mechanism or when I start doing the computation, I will not include the 2 lakh income itself. I directly take only 8 lakhs and compute the tax for 8 lakhs. But in the first scenario where I said 5 lakh income, first I take 5 lakh income and then I take the entire computation, I arrive at the 5 lakh of income and then reduce the deduction of 1 lakh and then get the taxable income of 4 lakhs. That means to say, in the deduction mechanism, that first it forms part of the total income computation and then it gets the reduction by way of deductions that can be reduced. But in case of exemption, I don't even make it enter into the computation mechanism. As soon as it is derived or as soon as it is analyzed that it is an income which is in the exempt nature, I don't even make that item to enter into the computation and I keep it outside. So this is the basic difference between the exemption and the deduction. So when I say exemption, that means it is not increasing my income, gross total income. When I say deduction, before deduction my gross total income can be higher amount. Okay? So let's say I have income of 50 lakhs and I am eligible for deduction of 30 lakhs. That means my net taxable income is only 20 lakhs, but my gross total income will be 50 lakhs. If I take the same scenario on the other hand, 50 lakhs income, out of that 50 lakhs income, 30 lakhs income is exempt. Okay? 30 lakhs income is exempt. That means I don't get that 30 lakhs into the computation. I only get that 20 lakh remaining portion into my income computation. Thereby, my base or the gross total income will start only at 20 lakhs and my total income will still remain. In the computation anywhere I don't see 50 lakhs. I start the computation only at 20 lakhs. So this is the basic difference in terms of the deduction versus exemption. Are we all clear here? Any confusions or anybody has any questions or any points to add here from your end?
How many exemptions are there?
Section wise, it is only one section, section 10, but there are a lot of subsections and clauses and things. It goes, I think 100 plus exemptions are there.
21 is what I have just.
Correct. So it's, I think 2 years back it was around 90 or 95 when I had an occasion to count. But recently, of late, there are a lot of additions that have happened and it has gone more than 100 is what I understand. So I think, like you said, there could be 120 or 150 or 115 to 120 exemptions that are available in the entire section.
We have to still disclose the exempt income in our IDR, right?
Correct, correct. So that is the disclosure part which will come to the discussion part. Yes.
So from 90 to 120 you said, earlier few years back it is 90, now it is 120. I heard somewhere around 2 years or 3 years back, Nirmala Sitharaman was mentioning that based on OECD guidelines that we will reduce the exemptions, but they did not follow this.
No, I think that still implementation is in the transition part. They are not still completely migrating. That is how the deductions part are now going on in terms of new regime versus old regime. Slowly they might become now 1034 is not there, 1038. So like that slowly they might come in. It is in the transition phase. It might take another 5 years minimum, 3 to 5 years minimum. Correct. Okay. So this is the major difference. But now coming to one of the point that what happens if it does not enter into the computation mechanism itself? How will government know that some assessee had that exempt income of 20 lakhs or 5 lakhs or 2 lakhs or 3 lakhs? So from the point of information updation to the income tax department, there is a separate schedule in the income tax returns which is called as exempt income schedule, EI schedule. In the schedule EI, the list of incomes which are in the form of exempt or section 10 related incomes has to be disclosed in that schedule. It might be any kind of nature of income whatsoever. You might have heard 5 sources of exempt income and all the 5 sources of exempt income has to be separately shown by its particular description and section applicability. We cannot tell 30 lakhs entire exemption, one line exempt income 30 lakhs. Out of that 30 lakhs agriculture income can be 5 lakhs and some other interest income which is exempt can be 2 lakhs. Partnership share of profit share can be 7 lakhs. So I'll have to show all the descriptions separately in the exempt income schedule of the income tax return format. So that is from the disclosure perspective, nothing to do with taxation. So though you show it in the disclosure, it does not form part of the total income computation. The moment it does not consider the total income, there is no tax that gets computed on the exempt income. Are we all clear till here?
What about deductions? For example, 56 to gift. Let's say a family member has been a gift. How do you disclose that? Because if you say only exempt income, means only section 10 exemptions have to be disclosed in schedule EI. Then what about this 56 to 10?
Those are called as the chapter head specific exempt income. Those kind of gift also comes under exempt income, which needs to be shown in the schedule EI.
That also can be shown.
Correct. Correct. So next we move to just to have a glimpse of the exemptions which are chapter or different specific head of income. Now we have, all of you are familiar with 5 heads of income, isn't it? Income from salary, income from house property, income from capital gain, income from business or profession, and income from other sources. Now when we look at the exemptions, so So from the income from salary, these are the different exemptions that are available which are specific to the salary head of income, okay? Which are popularly known as leave, LTC, leave travel concession, gratuity exemption, leave encashment, pension computation, or in terms of the VRS scheme that is going to be applied or applicable, the proceeds from the VRS scheme, retrenchment compensations, all of this. And one of the other most important and popularly known as house rent allowance, HRA. Now these are all that is relevant and most popularly known or applicable for the salaried people or persons who are earning salary income. And another thing is the provident fund or the superannuation fund or the NPS. These are the other retirement or the corpus funds which they get accumulated over a period of time, and the proceeds from these funds also enjoy certain exemptions, but these are closely related to the income from salary and of income. Moving further, in terms of income from capital gain, so there are 4 exemptions that are particular to capital gain chapter. The first one, if you see the capital gain on transfer of a unit scheme. So from one scheme to another scheme, when we see these mutual fund schemes, when this consolidation of mutual funds happen, the transfer of unit from one scheme to the other unit will not be chargeable, it is exempt. Income received on buyback of shares of a domestic company. Capital gain on compulsory acquisition of agricultural land with specified urban limits. So we'll see that in terms of the what is an urban limit, what is the rural limit, all of those limits we'll see. So whenever any transfer of a land which is in the form of agricultural land, which is within the limits of rural area or outside the limits of urban area, will be considered as exempt. Income received in transaction of reverse mortgage or personal expenses. So these are specific to income from capital gains. Income from other sources, interest income arising for certain persons, there are certain exemptions. Family pension received by widow or children nominated heirs of armed forces members is another criteria. And the clubbing provisions. So clubbing provision also certain exemptions in terms of when the minor's income gets clubbed in the hands of the parents. So 10-15 gives the exemption of 1,500 rupees per child. So that exemption is getting covered under the chapter income of other person included in assessor's total income. Then comes deduction from gross total income. There also we have receipts from LIC, payment from NPS trust pension scheme or NPS trust to an employee. These also gets exemptions in the section 10, 12, 12A, 12B, 10, 11. We'll look into those specific things in the part 1 series of the discussion of today's discussion. So just to give you an idea of what are the specific head-based exemptions versus the general exemption. Apart from this, everything else is general exemption which is not directly related to any particular head of income. So quickly let's get into the exemptions now. First thing is we'll move to the agriculture income. So once we finish the agriculture income, we'll proceed to the other exemptions, and then if time permits, we'll go to the SEZ 10AA exemption. Okay. So agriculture income, like I said, it is excluded at the constitution level. So the Article 366 gives the constitutional provision stating that agriculture income cannot be subject to tax by states or the union. Basically from union list they are excluded. And what are these agriculture income? What is the definition of what is an agriculture income? What is an agriculture activity, or what kinds of income can be considered as agriculture income? Section 2 subsection 1A gives us the agriculture income. Says that agriculture income is exempt from tax as per section 10 subsection 1. Now let's quickly see there are 3 to 4 kinds of agriculture income which are exempt. And first one is coming from any rent or revenue derived from land which is situated in India and used for agricultural purposes. That means if any person has a land in a rural area which is used for the purpose of cultivation, which is used for growing crops or grains, which is called as agriculture. When we go to the definition, it says that it should be cultivated, crops should be grown, it should be harvested, all of that will come. That is tilling of the land, sowing of the seeds, weeding of the plants, all of that called as the agricultural activities. So any land which is not barren and which is used for the purpose of cultivation is called as agricultural land. And if this land is given on rent, or if it is given for the purpose of cultivation, and then the crops are grown and the crops are sold and then revenue is generated. So two ways of revenue that can come through agricultural land. Let's say I have an agricultural land of 2 acres of land and I give it on rent to you. You use it for agricultural purposes, and let's say you grow some kind of crop and then you sell this proceeds or the harvested crops, and out of the proceeds received you pay me certain share as a rent or share of agriculture produce. Now the income or the share that you have given to me is called as agriculture income, even for me. For you also it is agriculture income, for me also it is agriculture income. So any rent or any revenue derived from the agricultural land is called as agricultural income. So any rent received from use of agricultural land for agriculture purpose, whether in kind or money, will be deemed as agricultural income. So this is the deeming fiction. Now let's say I have given the land for you for your cultivation as the landlord, as the owner, and you are the person who is doing the agricultural activity. Now let's say you have grown 10 quintals of paddy. Out of that you are giving me 5 quintals of paddy as a share of profit or a share of rent or whatever it is. You are giving me around 5 quintals of paddy. Now what is the income that I am getting? I am not getting money. Ideally you were supposed to give me rent in the form of money, but you say that there is no money, I don't have market to sell the paddy now, I have to wait for another 6 months. For now I can give you paddy itself. I am giving you 50% of the crop harvested to you as rent. Now the 50% of the share or the 5 quintals of paddy that is received by me from you is called as agriculture income in my hands, because though it is not received in money but it is in kind. In kind is also considered as deemed agricultural income for the recipient. Now say, so the same example is here, the share of agricultural produce received by landlord is though in kind but it is rent and thus agricultural income in the hands of the landlord. So this is the first type of agricultural income. Any doubts or any kind of clarification required till now? All of you are with me? So this is the first type of agriculture income. So we are in the first exemption, agriculture income. Under agriculture income, first type of agriculture income is what we have completed. Now before going into the second, third and fourth types of agriculture income, let's spend certain time in understanding what is the agriculture meaning or the type of definition that we have in the, what is the derived meaning in the Income Tax Act. So the term agriculture has not been defined in the Income Tax Act, but it has derived the meaning. What does it mean? However, the cultivation of field involving human skill and labor on the land can be broadly termed as agriculture. So whether you do it manually or through equipments by way of tractors or by way of any animal husbandry or whatever it is, but you will have to do cultivation over the land. So the tilling of the land, the sowing of the seeds, all these are called as cultivation activities. That collectively all these activities together is called as agriculture in general terms. Agriculture means tilling of the land, sowing of the seeds and similar operations. It involves basic operations and subsequent operations. So basic operations is preparing the soil for cultivation and then sowing of the seeds and then watering the plants and then weeding out any unnecessary plants that are grown, and then you pluck the entire harvest and then you clean that, separate the husk and the seed and all of that. This is called as subsequent operations. Collectively all put together is called as agricultural activity. Now moving further in understanding the next level of agricultural activity, process ordinarily employed to render the produce fit to be taken to the market. So till the time the harvest or the agricultural produce is fit to be taken to the market is called as agricultural activity. We know that from the start of the preparing the soil for cultivation, sowing of seeds, watering plant, all of that is agricultural activity. Till what time it is considered as agricultural activity? Till the time the produce is harvested and it is made fit to be marketed in the saleable market. Okay, till that time it is called as agricultural activity. Sometimes to make the agricultural produce a saleable commodity, it becomes necessary to perform certain process. Such process is also called as agricultural activity. The income from process employed to render the produce fit to be taken to the market would be agricultural income. Now what is this? What kind of process can we talk? Like the simple example that few minutes back that I took is paddy. So the paddy will be in the grain. Now if I have taken only the grains, I cannot sell the paddy as it is. I will have to differentiate the grain and the inside the seed, the husk has to be removed, and then I have to separate it and then take it. So this is one kind of activity which is called a subsequent operation, which is ordinarily employed to make the agriculture produce to be fit to be marketed. Otherwise it is not fit to be marketed. So somebody might tell there's a lot of judicial conflict that has happened over the period of time, and based on those these analogies have been derived. Somebody says that if it has to be considered as agricultural activity, it has to be only in the soil. The moment the harvest is or the produce is harvested from the soil, afterwards whatever you do, it is not agricultural activity. So they said only to the extent of growing the crops is called as agricultural. After growing, whatever process you do, that is not called as agricultural activity. So there became the conflict of differentiation. So there came the need for drawing reference as to till when the income can be considered as agricultural income, or till what activities, till what time the activities can be considered as agricultural activities. However, it must be a process ordinarily employed by the cultivator or receiver of rent in kind, and process must be applied to make the produce fit to be taken to the market. Somebody cannot tell even after the ordinary process, if some person is doing some more additional processes, that additional processes cannot take the shelter of agriculture. We see that when we go into certain incomes like composite agricultural income, like when we go into the examples of the rubber, coffee, tea, there we get to know that certain processes are ordinarily employed and certain processes are not ordinarily employed, but that is not constituting the part of agricultural income. So we look into those examples as well. Sale of such agricultural produce in the market. So this is the third extract of the understanding the word agricultural income. Any income from sale of any produce to the cultivator or receiver of rent in kind is agricultural income, provided it is from the land situated in India. So very key to note that the land should be situated in India. Only then the income generated from such land situated in India is exempt under Income Tax Act. Let's take an example. A person is having a land in Sri Lanka, and that land in Sri Lanka is an agricultural land, he is growing crops there, and he is generating income from such land situated in India, and he is an ROR in India. That means he is a resident, ordinary resident in India. Thereby, the global income becomes taxable in India. Now, by virtue of section 10 subsection 1 and by virtue of definition given under section 2 subsection 1a, can I take the shelter to state that agriculture income is exempt in India, thereby the agriculture income derived from a land situated in Sri Lanka is exempt in the hands of the person because of ROR status in India? No, because very clearly it is being mentioned that the income should be generated from the land or the agricultural land situated in India. The moment the land is outside India, the exemption is gone. The exemption is gone and the income becomes chargeable in India even if it is agricultural activity. However, if the produce is subjected to any other process other than process ordinarily employed to make the produce fit to the market, the income arising on sale of such produce would be partly agricultural income and partly non-agricultural income. So they are not very stringent enough also. The moment there is some activity which is involved, which is non-agricultural activity and agricultural activity together, to the extent of agricultural activity it is exempt under section 10 subsection 1, and to the extent what is non-agricultural activity it is chargeable under other ends of income. So we will see that kind of integration example in the subsequent slides. So are we clear till here?
For constitution, you said that agriculture is out of purview. I mean, agriculture is excluded.
Correct.
So, whether that agriculture income, whether it is in India or outside India, it is same or then how can we tax?
The Constitution of India applies only to India. So, the Constitution has the power to restrict that exclusion to only India.
Whether it is really excluded outside India, in Constitution or in this Act it is excluded?
It is derived meaning from different things, where the Article 366 has power to exclude Indian Constitution or the agricultural income. And the Income Tax Act has gone further to state that Constitution will apply only to India. Constitution do not have any rights on the other countries, so the exemption is only limited to Indian agricultural lands.
That subclause B, basically if I read it together, it says any income derived from such land by performance by a cultivator or receiver of rent for any process ordinary employed, etc. etc. So income derived from process, like for example DST, what you got for paddy, that process, income will be derived by the person who is performing not the actual farmer, right? It will be by, let's say, a mill or whoever is actually doing that.
Correct. For him also it will be agricultural income.
You talk about them.
Correct. Now, sometimes, so this is only when the growing person and the process person are different. But otherwise, most of the times they will have their own machines. Sometimes it is manually done. Sometimes it is used semi-automatic machines. Sometimes they take it to a different vendor or a person who is doing that process.
So if it is done by a separate person,
Correct.
for him also it
it will be considered.
not treated as business. But then sugar mills are not.
Correct. Correct. That is not process ordinarily employed.
Sugarcane can be.
Till sugarcane it is agricultural activity. After that it is the business activity, non-agricultural income.
What about rice, puff rice?
Puff rice is agricultural income. Any other questions before we proceed? So we'll move to the, if there are no questions, then we'll move to the second type of income, which is
coconut and arecanut.
Huh?
Coconut and arecanut.
agricultural income. But for arecanut, you sell it as it is, then it becomes the agricultural income. But there are different variations in the arecanut where you cut it and you put some flavors, masala and all that becomes the non-agricultural income. Only purely growing the arecanut plant and then plucking, then you only remove the shell of it, out of it, make it into 2-piece, sell it, agriculture. Till the making of...
Some traders directly go to the agriculturist, they buy the product and they will do subsequent. That one.
Correct. That subsequent activity, if it is related to process ordinarily employed, then it is exempt. If it is non-ordinarily employed processes, that is in terms of adding flavors, then making into different kind of processes which are not generally deployed, that becomes the non-agricultural income.
Arecanut leaves, nowadays the trend is to use the last part of the leaf, that is the stem, into plates and bowls.
Correct. Arecanut leaves and all, there is a kind of thin line of difference that comes in the picture that becomes not an agricultural produce and becomes a business activity. So that is one argument. The other argument they are telling it is coming through the agricultural activity, it should be exempted. So that is the kind of grey difference that is still prevailing. Disputed.
Trader buys the farmer, sells it to us. If you look at arecanut, buys the farmer.
If you, that is agricultural activity. Correct, agricultural activity. Rice, buying rice and selling rice is agricultural activity.
For trade also.
That is exempted.
Trader also should be exempt.
No, they are pretty bad.
No. So to the extent of growing and bringing to the market, it is exempt.
He's selling the trader by.
Trader has to be.
See, you are a farmer, I am a trader. I buy from
For farmer it is exempt. For a trader it is taxable. Correct.
And now in the process, if the third party has been given some services, so legal
That is not
services.
taxable. That is not allowed. We come to that. Where we tell indirect relation to the agricultural activity. We'll come to that example. We have that kind of scenario in subsequent
Once
slides.
it touches traded, it means that it is marketable, is it so?
The once it becomes produce fit to market, then it is a taxable income.
No, in our example, the pulses or whatever you mentioned, the seeds have to be removed. As a trader, I went to agriculture land, the farmer said that we don't know.
To that, correct. Once you take and once you do the cleaning activity or once you remove it, ideally that does not happen. Very rarely that happens. But if you make it happen, then you have to segregate it. It becomes the burden of proof for you to prove how much of it was agricultural activity and how much of it was non-agricultural activity. More likely to so that all of them will declare that as non-agricultural income. It becomes a very burdensome activity for that rice trader to prove him that how much of agricultural activity that he had done and how much of it was non-agricultural activity. So in that scenario, you would like to prefer to get the produce directly after having all that processes done, so that he does not have to have the burden of proof to be made before the income tax authorities.
Sir, during the course of agriculture, farmers grow the animals also, cow animals. From that pouring the milk, it is agriculture income or?
That comes under cattle breeding and all of that. Then there's another example, we'll come to that. That is not considered agriculture income.
There is one new activity, the farmer, which is happening. He grows tamarind trees. He says, okay, these 10 tamarind trees are gone. That's all, and he gives it to a trader, a contractor. He says, you go, you pluck, you sell. Per tree, you will sold. So the trader is plucking, he'll do the cleaning, and then he'll take it from market and sell. So for the trader in this activity, whether it will be considered as exempt activity?
No, in my view, no. Because he's
plucking.
He's cleaning. Correct.
He is
like the same example the other person also asked here, one of our friend, where he said that the rice is not cleaned or the husk is not removed, and then the rice trader does all this activity. So it becomes the burden of proof on that person who is doing this activity of plucking and cleaning to establish that how much was the process that was deployed to make the produce to be ordinarily done for marketable.
So here we are talking about exemption for income. What you are talking is the activity prior to the sale.
Correct.
But how is that connected to my income? I am saying my income itself is exempt.
Correct. So as a trader,
how do you segregate?
That's become the whole point of question here to prove before the tax authorities. So much of my income is related to cleaning and plucking. So much of my income is on the trading activity.
Are you suggesting that if the ultimate selling price is let's say 100?
Correct. I have to segregate. Definitely entire thing cannot be claimed as exempt. I have to segregate a part of the income is related for the activity of plucking and cleaning, which can be construed as agricultural activity, as a process ordinarily deployed as a trader, from the trader perspective. Then that it depends, and the onus completely lies on the trader to prove that this activity was done by him and how much of that income is attributable to this process. So that becomes a subjectivity point.
There is no statute backing what you are saying. I don't think what you are discussing now. You find it in section 10. I don't think so.
No, they are not given in section 10, but it becomes.
Depending on the rules. I don't think.
It is a general process right now. So the point here is the trader is going and plucking the tamarind or whatsoever. It can be any produce, mangoes or coconuts or whatsoever it is. So the trader is going and plucking and then doing the cleaning and then he sells it in the market. So when he does that, so are we trying to conclude that this entire activity is agriculture income and for trader it is exempt? Definitely not is my point of view.
One point, I mean one way of looking at it, whatever the farmer has to do, the trader is doing it.
Right. That is,
so do you think that should be exempt in my hands?
That is the view that has been taken in various court of laws, but it is not permitted is what I am trying to say. There the courts have been told that what is exempt is the agricultural activity. Is the trader doing the agricultural activity? He is establishing that I am going and doing the farmer's job to the extent of plucking and cleaning. So please do segregate your income to the extent of activity of plucking and cleaning. And then claim that as exempt and not the entire.
There is no process after plucking and cleaning. Let's say after.
If he simply plucks it and sells it, then what percentage of income that he can attribute to the agricultural activity?
No, it will not be then 100% because plucking and cleaning, then it is marketable. Then if there is no other process involved. So whatever income I am earning ideally should be called as agricultural income because in the harvesting stage, I am saying the plucking will be equal to harvesting.
So here the courts of law will look at the logical reasoning and substance over form rather than form. In substance, am I doing the entire agricultural activity? Agriculture meaning is derived from the process of starting from the making the soil, preparing for the growth, and then tilling of the land, sowing of the seeds, growing of the plant, watering, and then weeding, unweeding, de-weeding, harvesting, all of this. The trader comes at the end, he does not do all of this and then he wants to claim himself to be as agriculture and claim it as exempt. Might become very difficult to get the exemption. That is the point of view. There might be chances where he might have got the exemption of the courts of law. It is a debatable issue. Okay, let's proceed in terms of the next pointers. So income from farm building. So this is the second kind of income which is called as agricultural income. Any building which is in the immediate vicinity of the agricultural land should be, which is used by the cultivator for the purpose of the agricultural activity or storage of the agricultural produce, or he himself is staying there. Then the land is situated outside the urban area, and the cultivator should use this building or dwelling as house or storehouse. Then any income that is generated as a rent or any income that is generated from this farm building will be considered as agricultural income. So 4 conditions. One is that it should be adjacent to the agricultural land or within the agricultural land in one part of the agricultural land, in one of the corner or one of the side of the agricultural land. Should be used or should be occupied by the cultivator. So let's say in our first example, the landowner is me and I have given the land for you to cultivate. Now you have constructed a farm building and you are staying there. So you are the cultivator, you are staying there. So that you should be staying. You should not give it on rent for some school or for some college or for some other training. That is not permitted. It should be used by the cultivator. The land is situated outside the urban area. Outside the urban area means, so we'll understand what is urban area. Urban area is a city area, and outside urban area comes the rural area limits. And then the cultivator should require the building as, or should be required to use the building as house or storing the produce. So these are the 4 items which he should satisfy. Once he satisfies these 4, any income that is generated from such farm building is considered as agriculture income. Let's quickly understand what is an urban area. So urban area is divided into 3 limits of area-wise and population-linked area. Primarily, urban area means any area within the jurisdiction of municipality or cantonment board having population of equal or more than 10,000 within such municipality. So first basic limit is that in any area, if there are population, a number of people more than 10,000, that is called as urban area. If any village or any city or any area which has a population of less than 10,000, then that is called as rural area, which is not called as urban limits. Now what happens if it is more than 10,000 and up to 2 kilometers, 1 lakh population limit is available. So up to 2 kilometer radius from the cantonment of the municipal area, it will be considered as urban, and outside the 2 kilometer, it will be considered as rural area. Now if the population is more than 1 lakh, up to 10 lakhs, 6 kilometer area is there. More than 10 lakhs, 8 kilometer limit is given. Up to 8 kilometers, it is considered as urban area if the population is more than 10 lakhs. And the moment any land which is situated beyond 8 kilometers is considered as rural land or rural area, and the land situated in that rural area is considered as agricultural land, which is eligible for exemption for all these things that we are discussing. But if it is within the urban limit, then even if you are doing agricultural activity, it becomes this farm building income will not be considered as agricultural activity or agricultural income. For this farm building, only this criteria is there, that it should be outside the urban limits. So the same thing here, it depends upon the shortest area distance from the local limits of municipality or cantonment board, and the population shall be based on the last preceding census data that is available, published before the first day of the previous year for which the income is being assessed or computed. Okay? So that is the criteria in terms of which population I have to take, on what date I have to take. On the first day of the previous year, as on that date, what is the last available census data, that data I will consider, and I have to take the shortest aerial distance from the municipality of the cantonment board of the area. So these are the limits in terms of the urban area and the rural area. Moving on to the third type of income. Agriculture income includes income from nursery operations. So the nursery operations is also, let's say there are farmers who go and buys the saplings from the nurseries. So the nursery operation is also called as the agricultural income. Any income derived from sapling or seedling grown in a nursery shall be deemed to be agricultural income. Accordingly, irrespective of whether the basic operations have been carried out on land, such income shall be treated as agricultural income, thus qualified for exemption under section 10, subsection 1 of the Income Tax Act. So here, what we discussed, the sowing of the seed, tilling of the land, making preparation of the land, watering, all of that, those are entire basic operations is not carried out because the saplings are grown in a separate pouch or a separate container for a small duration of time. So that activity is also considered as agriculture income, though the basic operations of the agriculture activities are not performed. So this is the third type of income under agricultural income which is exempt. The fourth thing comes the composite income, that is any income derived from such land by agricultural operations including processing of agricultural produce so as to render it fit to the market. But there is more processes to be done in that. Would become income arising from transfer. Okay, before moving to this point, we'll discuss this composite income later when we go to the integration in the examples of rubber, coffee, tea, where we come into the direct examples of composite income. So now the question is, would income arising from transfer of agricultural land situated in urban area be agricultural income? So let's say that outside the limit of 2 km, 6 km and 8 km, there is a land situated. Now the agricultural land itself is sold. So when the agricultural land itself is sold, can that income generated out of the sale profits of the agricultural land be construed as agricultural income, and shall it entitle for exemption under section 10 subsection 1 is the question here. So this is specifically excluded. The agricultural land which is situated within the limits is only exempt. Okay, in urban area. So if it is situated outside the urban area, then it is exempt. But if it is situated within the limits of urban area, then it is not exempt and it becomes taxable under the capital gain chapter under section 45. Okay, so entire thing is possible under the agricultural income activity, but only the land sale proceeds, which is within the urban limits, is considered as capital gain. If it is the land situated in a rural area, then the capital gain is also not attracted on such agricultural land, then it becomes agricultural income exempt under section 10 subsection 1.
So this urban versus rural is purely depending upon the population and the
Correct.
distance and all of that. What is the documentary evidence which says the population is so much and the land is situated so far? How will you establish?
Again, it is based on the, like I said, it is based on the population census data, which is lastly available, or the latest data that is available on the first day of the previous year. Now, if I am assessing for assessment year 17-18, that means previous year 16-17. So on 1st April 2016, what is the latest census data that is available? If it is 2011, then I will take 2011. Even though there is changes that have happened from 2011 to 2016, as on 2011, what was the population? If it is coming within that limit, then it gets the benefit or it gets attracted with those limits accordingly. And in terms of the distance, it is the aerial distance. Now, it has certain parameters how to measure. Probably a Google map today can help. What is the aerial distance? And ensure the...
How to put this forward to an assessing officer? I mean, if he wants some documents to see, to establish.
There might be certain third-party agencies or the authorities like the sub-register office who can help us with this kind of data, can be certified, or the income tax officer also can hire or appoint an internal departmental officer to do this activity. Practically difficult, we'll have to make them understand that this requires this kind of effort. Sitting in one office room with in front of table and chair, we cannot calculate it, and whatever we present, they might be not accepting it on the face of it. It becomes a challenge, but we'll have to ensure that these preliminary and additional evidences are given by way of evidences.
So the one basic question I missed somewhere, that limits whatever we are discussing, the agricultural land, whatever outside the limits, it is exempted.
Outside the limits, it is exempted, correct.
So if I go somewhere nearby any agriculture,
and if you sell, that will be subjected to capital gain.
That is land.
Correct.
Whatever we, if I produce.
Producing is exempt. Even in urban area, even in the center, even if next to institute, if you have a land and if you are going, that is exempt. But the farm building is not exempt. Income from farm building, because it is in the urban limit, that is not exempt. The
Farm building and capital gain is only
Correct.
for that too, we have to see the limits.
Correct.
So in case of sale of urban land, some criteria is there. 2 years before this assessee owned agricultural land and selling that property and investing in agricultural land.
It comes under section 54 exemptions in terms of urban land. That is not the urban land exemption. That is sale of agricultural land in urban limit. So in order to get the exemption under section 54, he should be utilizing or using that land for last 2 years either by himself or by his parents in the cultivation or agriculture activity, then he will be eligible to get the exemption. That is from the capital gain exemption perspective, 54.
What document do you get to check the population? For example, what happens over the period?
Government records.
Municipality, jurisdiction will get changed. That is one thing. Second thing is, what is the exact source to get the population? Because other than Google,
Other than
Google.
Other than Google, I think there are the authorities of the census records of the population data maintained by the government authorities. And it is available now on the websites also of the government websites. So that can be downloaded from there and we can show it. The point of date as on which that we are downloading is the condition that it should be as of the last available census data, and that usually it becomes very challenging if the census is not, let's say in 2021, if they are supposed to do it every 10 years, if they are not done in 2021, then I need not wait for 2021 data, or if they are in the process of doing 2021 census and if it is not updated, I need not wait for 2021, I can go for 2011. And the Ministry of Census and Population, or whatever ministry that it is being maintained, from that human resources, that we will get that data. It will be available. These challenges were there some 10 years, 15 years back, where all were manual records and nothing was digitalized and nothing was available online. But as of today, most of the data are becoming publicly available. Like for example, guideline rates or the stamp duty rates. Earlier it was only with the sub-register office with the book that we'll have to go and check, but now all those rates are mostly more likely in metro cities and all of that. They have been uploading in a PDF formats in the websites.
The requirement that what you were saying to claim that Section 54 extension, 2 years prior you need to be cultivating, you should be agriculture revenue records. Those are only for the exemption, right?
Correct, only for the exemption.
So for me, if I want to claim the agriculture income, let's say I started agriculture activity only this year.
That is
For the
right.
past 2 years it was bad.
No, there is no condition like that.
And even for the
And that condition is also there when you sell the urban land, that will be subjected to capital gain. And that capital gain can be exempted if you invest in another agricultural land. To get that exemption, the land which was subject to sale should be engaged in agricultural activity for last 2 years in order to enjoy this exemption. That is the only condition.
What about rural land? Rural land is exempted.
Rural land is first of all it is not subject to taxation.
It is exempted, but is it subject to condition that rural land which has been subject to agriculture only then it will be?
No such conditions.
So there are a lot of barren rural agricultural land.
No, there is no condition there. In the first instance, there is no chargeability. The moment the chargeability comes, then only that will come into the conditions.
To qualify as rural agricultural land,
The moment it is in the rural area and it is sold, there is no condition in terms of what is applicable for urban land.
Any land, barren land or normal land, then if I show there is no capital.
That is, which is in rural area, that is what is point of view.
In rural area.
Correct.
And the people who build the houses in that land.
That is where it becomes whether it is converted or non-converted agriculture, and there is a green belt, orange belt, red belt, converted land, non-converted land which is coming under agricultural area. Those are all in terms of the record how it is being prevailed.
So it has to be
If it is converted, then it is no longer called as agriculture land, even if it is in rural area. Your question is that people who are selling in rural area are correct. That is not at all agriculture land.
So practically the second rule, that is it should be agriculture on revenue records.
Correct.
That should satisfy.
Correct. Then only it can be considered as agriculture
So
land.
you don't have to actually do the activities for whatever practical reasons if you are not doing, but if, as long
Hey, you have been cultivating from 5 years, and from last after 5 years, for the next 2-3 years there are more rains and it has become barren and you have not cultivated. Then you decide to sell. You still get the exemption.
So in sale of agriculture in rural area, some of the sub-lists are insisting to deduct the TDS, even if convey them this agricultural land.
That is section 194 IA applicability, that will have to make them understand. It becomes very difficult for them to appreciate that it is actually not an urban land, because 194 IA provisions are applicable for land other than agricultural land. But people are insisting there again the confusion is, as on today it might not be an agricultural land, it is coming within the limits of urban area, but they are not applying the exact provision of the census prevailing as on that date. So we'll have to tell them as the provision. In practical purposes, if they don't agree and if the registration has to go through, if TDS has to be done, it has to be done. And at the time of claiming or filing written of income, it has to be established and presented before the tax authority and claim as a refund. Okay, now this is the indirect connection with the land where sometime back we had a discussion about indirect connection. So where we'll take this example and then we'll understand. X was managing the managing agent of a company. Okay, person X was a managing agent of a company. He was entitled for a commission at the rate of 10% per annum on the annual net profits of the company. A part of the company's income was agricultural income. Okay, so the company was into agricultural industry and it was having agricultural income. X claimed that since his remuneration was calculated with reference to the income of the company, part of which was agricultural income, such part of the commission which was attributable to agricultural turnover was supposed to be exempt in his hands was his claim. Okay, so he said since company is doing agricultural activity and my commission is based on the turnover of the company, so to the proportionate turnover of agricultural activity, whatever commission is paid to me, that should be exempt because that is also agricultural income. So this is the claim made by the managing agent of Mr. X. So there the conclusion or the provision that we have to see that since X received remuneration under a contract for personal service, it is not directly in relation to agricultural activity. So he was managing the land. It is a service that he is giving which is not in the nature of agricultural activity, which is in his personal capacity. From this, he might have certain skills and certain mindset or technical qualification because of which he is giving professional service or personal capacity but not agricultural activity. So on the amounts of the profits earned by the company, such remuneration does not constitute agricultural income and it will not be exempt in the hands of the managing agent. So after having seen that agricultural income exempt, whether it is received by tiller or the owner of the land with ownership or without ownership. We said even the cultivator of the land, for him also it is agricultural income and for the owner also it is agricultural income. Then is there any other person who gets that benefit like this? No, we don't get that benefit of the indirect connection with the agricultural land. However, non-agricultural income does not become agriculture merely on account of its indirect connection with land. So non-agricultural income is this personal capacity income. That is, the managing agent is doing the services in terms of some managing project management service or is doing some consultancy service, whatever in his personal capacity, it is not directly related to the agricultural income. Another example, Y owned 100 acres of agricultural land, a part of which was used as grassland for cows. Okay, let's say he had 100 acres of land. Out of that, 30 acres of land is used for growing the grass, like pasture for a feed for the cows. Okay. The land was purely maintained for manuring and other purposes connected with agriculture, and only the surplus milk after satisfying the assessor's needs was sold. The question arose whether the income from such sale of milk was agricultural income. The sale of milk, is it an agricultural income? So here again the milk, the cow, the cattle breeding and then the sale of milk is not agricultural income. That is what they mean to say. Though the indirectly it is related to the agricultural land, it is not agricultural income. In this regard, income from sale of such, we will see from here. Even though operations is in the, the regularity with the sale of milk were affected and quantity of milk sold showed that the assessee carried on regular business of producing milk and selling it as a commercial proposition, hence it was not a agricultural income. So it is completely agricultural, opposite to the agricultural meaning, and thereby the benefit of exemption cannot be claimed. The third example, in regard to forest trees, there is a spontaneous growth of trees which grow on the soil, unaided by any human skill. There is no human skill, nobody prepares the soil for cultivation, nobody waters it. There is no activities of cultivation or there is no activities of growing, nothing happens. So even unmaintainable human skill and labor, there is no cultivation of the soil at all. Even though operations at the nature of forestry operations performed by the SSC may have the effect of nursing and fostering the growth of such forestries, it cannot constitute the agricultural income. Thereby, income from such sale of such forestries of spontaneous growth does not therefore constitute agricultural income. So these Nilgiris trees or teak trees or sandalwood trees which are grown in the open forest as it is, any sale happens from that will be subject to taxation and cannot be exempted. So these are the few examples of what is agricultural income and what is non-agricultural income. Like income from breeding of livestock, income from poultry farming, income from fisheries, income from dairy farming is not a agricultural income. So to conclude whatever we have discussed till now, to derive the conclusion meaning, on the right hand side are the examples of such activities which are not forming part of the agricultural income or coming from the perspective of non-agricultural income.
What about floriculture? Floriculture and nursery doing in urban areas.
Nursery is
urban area itself, on the rooftop.
Okay. Wherever it is nursery, they are given an exemption from the meaning target. Nursery activities is there. Now, floriculture is a kind of new culture that has been grown, which is coming from the perspective of whether that saplings is used. In my view, my understanding of nurseries is where this is becoming a raw material or an input for the actual agricultural activity. Now when I give the saplings of coconut plant, this or a saplings of banana plant or a saplings of mango plant, now this goes to the agricultural land for the agricultural activity. Now floriculture for, if it is going for the actual flower growing or the flower thing, that should be considered. But if it is for just for the show plant and all of that, in my view, it should not get the exemption, literally going. But in form and substance, in form, if it is enjoying the benefit of exemption, it is still enjoying the benefit of exemption.
Export of rose flowers on Valentine's Day, big business.
That's what I'm doing. So if it is just grown in the nursery plants and it is taken away and sold.
But all the skills are used in doing the cultivation of roses.
Correct. If it is in the land, it should be there available.
Yes.
But even if it is done in the kind of the nursery, they are enjoying the benefit of exemption, though it is not the actual agricultural activity. Okay, now the last concept that we are going in the agriculture income before we go into the other exemptions, integration of agriculture income with non-agricultural income. Whenever there is a person who is earning agriculture income, along with agriculture income, there is some other income. Then whether agriculture income is exempt or not. So in plain or in simple, the exemption is given to only such person who is earning only agricultural income. Okay? That means to say a person's total income should not have any other source of income but for only agricultural income. Then that income is exempt under section 10 subsection 1. The moment there is a flow of any other source of income, then the integration rule will apply. What is integration rule? We'll quickly look into it. Okay? That means when I have agriculture income, so you're able to see this example. Let's say there is an agriculture income of 7,500 which is exempt. There is a non-agricultural income which is salary income which is 4,35,000 which is taxable. So there is both agriculture and non-agricultural income. So this both needs to be added in step number 1. So tax on both agricultural income and non-agricultural income. So when you add 4,35,000 plus 75,000, it becomes 4,42,500. The tax on that is 9,625. So this is the step 1. Compute, the tax needs to be computed on both agriculture income and non-agriculture income put together. The tax needs to be divided. And step 2, we need to compute tax on only agriculture income and the basic exemption limit aggregated. Okay? So what is basic exemption limit? In case of individual HUF, AOP, BOI, artificial judicial person, we have basic exemption limit irrespective 2.5 lakh or 3 lakh or 5 lakh as the case may be. Whether it is old regime or new regime, we have this exemption limits. So let's say a person is having basic exemption limit applicable is 2.5 lakh and on 2.5 lakh plus the agriculture income 7,500 will be clubbed together and the tax on that 2,57,500 will be computed, which is 375. This 375 will be given as a reduction from the tax arrived in the step 1. The step 1 tax is 9,625. So here we have arrived at 9,625 of basic tax, and in the step 2 we have arrived at 375. So from 9,625, 375 will be reduced, 9,250 is the tax payable. But however, there is a rebate under section 87A for resident individuals up to 12,500 there is a rebate, so 9,250 will be reduced and tax payable will be. But the concept of integration will go as it is. So let's quickly see in terms of the step 1 and step 2. The first we need to compute the computation of tax on total income including agricultural income. Total income including agricultural income. What is total income? Agricultural income plus non-agricultural income, both put together, tax needs to be computed. Step 2, I will take the agricultural income and aggregate in terms of the basic exemption limit. So computation of tax on agricultural income plus maximum amount not chargeable to tax, as the case may be 2.5 lakh, 3 lakh or 5 lakh. Then whatever is the liability arrived in step 2 shall be reduced from the liability arrived in step 1. That will become the total tax payable in case of where the person is having both agricultural income and non-agricultural income. After having understood the mechanism of integration of agriculture and non-agricultural income, let's see to whom it is applicable. Whether it is applicable to everybody, yes, it is applicable to everybody provided it satisfies the 3 conditions. The 3 conditions are, this is applicable only for the individual, HUF, AOP, BO and artificial juridical person. And agriculture income should be more than 5,000 rupees. If it is less than 5,000, then the integration will not apply. Non-agriculture income must exceed the maximum amount not chargeable to tax. So 2.5 lakh or 3 lakh or 5 lakh, it should exceed that, and the agriculture income should exceed 5,000. Only then the partial integration will apply, otherwise it shall not apply. If all the above conditions are satisfied, then integration will be done in the below manner of step 1, step 2, step 3. And after arriving at the liability, that is in step 3, after reducing the step 2 liability from the step 1, whatever is the liability, that liability will enjoy the rebate under section 87A, if any, applicable in case of resident individual. For non-residents, rebate is not applicable. Is this clear?
In case of companies,
for them, this is not applicable. Now, if you see, there is another example here quickly to see. The agricultural income is 70 lakhs, salary income is 40 lakhs. So this is, if it was only 70 lakhs of agricultural income, there wouldn't have been any tax. Now, just that there is some other income apart from agricultural income, then the integration will apply. Step 1, I have to take this 70 lakhs plus 40 lakhs, 1 crore 10 lakhs. On 1 crore 10 lakh, I have to calculate the basic tax plus surcharge plus cess as it is applicable. It becomes 37 lakh 22,550. From there, I go to step 2. On 70 lakhs basic, on 70 lakhs of agricultural income, basic exemption limit of 2 lakh 50 will be 100. That becomes 72 lakh 50,000. Tax will be computed. Here, that becomes 22 lakh 73,700. So, from step 1 liability of 37 lakh 22,550, step 2 liability of 22 lakh 73,700 shall be reduced, and only 14 lakh 48,850 needs to be paid. So this is the integration concept. If at all, if I had only non-agricultural income, let's say if I had not had any agricultural income, that is only salary income of 40 lakhs, what is the tax that I would have paid? I would have paid 10 lakh 53,000. Because of integration, now I am paying 14 lakh 48,550. Thereby, there is a nominal tax that is getting taxed on the agricultural income also. So it is purely not exempt. The moment it is the agricultural income along with agricultural income, if there is any other non-agricultural income, a part of agricultural income will get taxed by way of partial integration. So here it is very clearly evident for us that if I would have had only agricultural income, non-agricultural income, that is salary income, non-agricultural income, so then the tax would have been paid as 10 lakh 53,000. Now, because of integration, if you see the step 1, step 2, step 3 liability, now I am getting 14 lakh 48,850 rupees as the tax liability. So there is a 4 lakhs of additional liability on 70 lakhs of income. Is this evident and clear now, concept wise? Okay. Now, in case of composite businesses, there are 3-4 examples like rubber, coffee beans, and coffee roasted. And other composite businesses, what they say, Rule 7A, Rule 7B and Rule 8, they are given specific percentages. So they have not given this ambiguity. Okay, each one of us will come and tell this much is pertaining to agricultural activity, this much is pertaining to non-agricultural activity. Nothing doing. From the sale proceeds, a certain percentage is treated as agricultural income and certain percentage is treated as non-agricultural income. So in case of rubber, the rule number 7A is applicable. They say 35% of it is becoming non-agricultural income, 65% becomes the agricultural income. If I sell rubber of 1 lakh rupees, then 35,000 is business income which is taxable, 65,000 is agricultural income which is exempt. So this is fixed irrespective of the actual expenditure or the income that he is incurring for agriculture and agricultural income. In case of coffee beans, it is 25% and 75%. So 25% is non-agriculture, 75% is agriculture. So here the key thing to remember is the highest portion or the maximum portion is going towards the agricultural exempt portion, and the lowest portion or the smaller portion is going towards the non-agricultural income.
So same way I have to do basic plus exemption. Basic
Not
exemption for 25% is other income.
Correct. For this it will be applicable.
So we have to calculate the tax as per the integration scheme.
Correct. The moment the non-agricultural income is having more than basic exemption limit and agricultural income is more than 5,000, and if you are an individual HUF, AOP, BOI, then you have to do the partial integration.
What happens in case of a company? So company, at what rates do a company will tax it? Will it be completely exempt in case of agricultural income and business income gets taxed?
For company, I think agricultural income is completely, if they have only agricultural income, for them it is exempt. And they do this farmer producer companies kind of companies, for them it is exempted. But they have different section under section ATP, cooperative societies, consumer credit cooperative societies specifically coming. Otherwise, it becomes business activity for them in the case of other activities of business. Usually these are the kinds of companies generally that are happening in terms of individual firms and all of those people like farmers. But if they are collectively coming together, then it is FPOs. They have a separate taxation regime that is applicable. And otherwise they operate in terms of structure called as cooperative societies and specific associations. And then
I can incorporate the company and I can do I can buy the lands and I can do cultivation. No?
Correct, you can do.
Then if I do if the company raises agricultural income, then taxability
exempt.
So if the company doing this kind of activities, they will prepare one single P&L account for our process. They will, in that, for example, say 5 lakh rupees is net profit. In that, you can bifurcate 40% is steel business, 60% is like that you can do.
Correct. That's what they have to do at the proceeds level, not at the profit level. At the sale value level, gross level, not at the profit level. Gross sale proceeds. From the sale proceeds, I have to segregate 65% is agriculture, 35% is non-agriculture. The moment it becomes non-agricultural, it does not form part of my business income computation. Only 35% forms part of my business computation. There I take that 35% is my sales. Out of that, what is the expenses that I can claim, and the balance will become net profit taxable as the income from business or profession. So this is a quick example of Rule 7A, 7B and Rule 8, where sale of rubber, coffee, roasted tea and coffee beans. So sale proceeds, total proceeds is 4 lakh. Out of that, 65% is agricultural income, that is 2 lakh 60, and non-agricultural income will become 1 lakh 40. So it is just application of the formula of 60-40, 65-35 and 75-25. These are the 3 limits that are given. What happens if there are any other businesses apart from this? Like earlier we had an occasion to discuss about the sugar, sale of sugar from the sugar cane growth. Till the time the sugar cane is grown, it is agricultural activity. From the time the sugar cane is used for the purpose of manufacturing sugar, that is business income. So we have to look at the purpose of then Rule 8 or Rule 7 has to be applied. We'll have to see from the market value of aggregate produce utilized will be deducted from the sale price of the finished goods. So sugarcane is the raw material used for the purpose of the agricultural activity. Till the time the sugarcane is used, the value of the sugarcane, that sugarcane will be considered the agricultural activity, that will be reduced, and the balance activity will be considered as the non-agricultural activity, that is in terms of the production activity. Now let's say the sugar price is 60 rupees per kg, and for producing 1 kg of sugar, I have to purchase a raw material of 40 rupees. Now, out of 60 rupees, 40 rupees is considered as agricultural income. Only 20 rupees is considered as business activity. And for that 20 rupees is what I will do the manufacturing process cost, manufacturing labor cost, overheads, all of that, and then there is the profit. So whenever
If there is a common cost, which is
It
applicable.
has to be segregated.
Based on the turnover, I mean.
That again is subjected based on the turnover or based on the activity, more likely which is more suitable in the activity.
40, 60 you will decide. 60 is the same value, like you said.
60 is the actual market value of the sugar saving.
Then 40, that is again the market value.
Market value of procuring the raw material of sugarcane for producing the sugar.
How do you establish that? Is this already
Market price.
Market price.
If I grow sugarcane on my own and I use that sugarcane produced for manufacturing the sugar. So, and I manufacture the sugar and sell the sugar of 60 rupees per kg. For entire 60 rupees is not business income. To the extent that is attributable to the sugarcane, it should be reduced as agricultural income. So I go and check in the market what is the price that is required as a purchase of raw material of sugarcane. So that sugarcane cost marketable will be reduced. Or in other words, whatever I have grown as sugarcane, if I sell it in the open market as it is, what is the cost? That is called as agricultural component, and that will be reduced.
I got it, but I'm saying scientifically, in sense on paper, what are the means to, is there any rate given by government that is relied on?
It is the market rate prevailing. The government cannot keep on issuing rates. No, sugar rates keeps varying every day, and you have to depend upon the market rates as on that day. And the indicator rates can be based on the market, that minimum rate fixed or something like that, APMC rates that can be taken as an indicative rate. So this is all about the first segment of important agricultural income. We have very in depth we have understood the each and every aspect of agricultural income. After the tea break, in the second part, we'll quickly go into the other important exemptions which are applicable to the individuals. Okay?
How do you access the
We'll give the link or we will convert this into PDF and give it to you. So this is an online PPT version which is available on the link basis, which you can do, you can be able to maneuver the entire presentation in the same manner. Otherwise it will come in the PDF format, it will be available for all the participants.
after the practice?
Yeah, I have still not shared, after the session I will be sharing it.
All right, thank you.
So let's now get into the other exemptions over and above the first section of 10 subsection 1 of agricultural income. The next frequently known exemption is section 10 subsection 2 exemption, which is important exemption from the perspective of share of profit or share of income from HUF in the hands of the members of HUF. So we all know that the taxation should be on one income once at one instance in the hands of one person. Okay? So there cannot be multiple instances of taxation that can happen on the same income in the different capacities. What is HUF? All of you are popular, right? What is an HUF? Anybody who needs any explanation on HUF? So basically, husband and wife on the marriage, they form an Hindu undivided family as per the HUF law, as per the Hindu Succession Act. They get the right of forming the HUF, Hindu undivided family. Now, any income, so in the Income Tax Act, they get a separate recognition as an assessee or a different taxable person. HUF is a different taxable person as compared to the individual. Section 2, subsection 31 defines what are the different types of person, like individual, HUF, AOP, BOI, limited liability partnership firm, companies, all of this. Similarly, HUF is one such category of person which is having a separate status of taxing individual or a taxing person as an assessee. So, any income that is generated by this particular assessee, that is HUF, will be taxed will be assessed in the hands of HUF independently in the hands of HUF as an assessee. Now, the tax that is being paid by HUF after having paid the tax, whatever is the surplus that is left out, will be available for distribution amongst its members. Okay? Who are the members of HUF? The entire family members, including husband, wife, children, whoever are the total number of members of the family will be the beneficiaries of the surplus money that is available in the HUF after paying the tax. Now this distributed money is what is received as income by the members of the HUF. Now, this income received from HUF by its members, is it again taxable? So, is it an income in the hands of the member of HUF? Definitely it is an income in the hands of member of HUF. But is it taxable? What is your opinion? Let's say now I am working in a company and I am getting a salary. The salary is taxable or it is an income for me. Similarly, I am a member of HUF. So member of HUF is making some business or running some business and it is giving monthly 20,000 rupees to me, which is in the form of share of profit. So this 20,000 received is taxable. Is it an income for the member? Yes, it is an income. So when I am receiving it as salary, that is also income. When I am receiving it as share from the HUF as a member, that is also income. So both of them should be taxable. Both of them should be taxable? No. So why no? Because HUF is just distributing its profits after having paid the tax to its members, and the tax is already paid by the HUF. So thereby they brought up this provision of section 10 subsection 2 where they are told that any surplus money after having paid the tax in the hands of HUF distributed to its members is exempt in the hands of the member of HUF. Let's take this example here where we are seeing that HUF is a different person. Visible, right? So the members of HUF is A, B and C. So there are 3 brothers. So Karta's brother, Karta's younger brother. Apart from this, there will be many other members. What I am trying to say here is as an example that only male members are given here. But I think before the Amendment of Succession Act, only male members were the co-partners to the HUF. But now every member will become a co-partner to the HUF. So Karta's brother and Karta's youngest brother are the members of the HUF for this example limited purposes. Income earned by HUF is 10 lakh and expenses for earning that income is 4 lakhs. So the profit made by HUF is 6 lakh. So the tax to be paid on this 6 lakh will be based on the slab rates up to 2 lakh 50 it is in case of old regime, 2 lakh 50 to 5 lakh, 5% that is 12,500. Over and above 5 lakh up to 6 lakh that is 1 lakh, 20% is the tax. Correct? On 1 lakh 20% is 20,000. So 20,000 plus 12,500 is 32,500. That is the tax on profit of 32,500. Cess of 4% on 32,500 comes to 1,300. So the total tax will become 33,800. So from the cash flow perspective, 10 lakh I received the sale proceeds, 4 lakh I spent for my expenditure, 33,800 rupees I spent for paying the tax. After that, what is left out in forms of cash? 5,66,200. Let's say this 5,66,200 I distribute to all the members equally. So that amount becomes 1,88,733, 1,88,733 and 1,88,733. Now, when I have distributed this 1,88,733, this is mere distribution of tax suffered income. Thereby, it should not again be taxed in the hands of the member of HUF. Now, for giving this relaxation, section 10(2) comes in the rescue of the individuals or the associates where this income will not be subject to taxation. So the very fundamental criteria is that any income that is already taxed in one person or in one associate's total income, it should not be taxed in another place. So that is the whole logic which they are giving exemption by of section 10 subsection 2. So this has another implication from the clubbing of provisions, section 64 subsection 2. Any income that is arising from an asset which is transferred by an individual to HUF for an inadequate consideration will not become the income of the HUF. Thereby, it will be taxed in the hands of the transferor, that is the individual himself, for the purpose of taxation. Though the asset is transferred on theoretical basis to the HUF, the income, though it is hit the credit of the bank account of the HUF, because of section 64(2), that income will get added in the hands of the transferor, that is individual, and it shall not be exempt and it shall become taxable. So let's say the property is there and the property is transferred to the HUF's name, and that property is enjoying a rental income, and that rental income is received by the HUF's bank account. If the transfer is for an inadequate consideration between the individual and the HUF, then the rental income received by the HUF will not be taxed in the hands of the HUF, it shall be taxed in the hands of the individual, though it is received by the HUF bank account. So that any of clubbing provisions again will revisit, but I just wanted to bring that passing reference here. A similar provision in terms of section 10, subsection 2A, in terms of a partnership form. So partnership form gets a very particular recognition only in the Income Tax Act as a separate legal entity or a separate entity. Otherwise, nowhere else it is considered as a separate legal entity. Only for the purpose of income tax it gets a recognition as a separate entity and it gets assessed as partnership form. The moment any income that is chargeable to tax and tax is paid by the partnership firm, and any amount received by the partners of the partnership firm will be subject to exemption under section 10 subsection 2A. Any amount means only share of profit, nothing else. Now, what are the other kinds of amount that a partner can receive? He can receive salary, he can receive interest, he can receive in the form of remuneration, he can receive in the form of incentive, he can receive in the form of bonus. All of this will be subject to tax. Now the logic here, all of these items, whatever I am telling, salary, interest, remuneration, bonus, commission, whatever it is allowed as an expenditure in the hands of the partnership firm while computing the profits of the firm. Thereby, the partnership firm has not paid tax on these amounts, hence the partner is required to pay tax on these amounts of income. On the contrary, after having deducted all these amounts of salary, interest, bonus, remuneration, incentive, commission, whatever it is, the profits that are available, that is before tax, on that profit tax is paid by the partnership firm. After having paid that tax, whatever amount is left as share of profit, which is attributable to the partners, that share of profit is only exempt under section 10, subsection 2A. Are we clear with this? Yes? Let us take a scenario here, please.
So in case of HUF, suppose there are three members in HUF. So one of the members transfers some amount to individual transfer to HUF, the clubbing provision. So it will be taxable in hand of transferor or the karta?
Transferor.
Transferor, not the karta.
64(2) clearly says transferor. So there is no confusion to state that it will be taxed in the hands of the karta or any other person. It cannot be any other person, it should be the transferor.
Sir, in case of family partition, if the property is allocated to the family members, is HUF automatically created here, or you will have to legally recognize it? For example, HUF is a creation of law. It is not separately incorporated.
Correct.
So once the family partition happened, it is a full partition. It is not a partial one. So HUF is automatically created, right? So coming to tax law, you will have to take a separate PAN, and that is a separate
partition. When partition happens, so it becomes a dissolution of the existing HUF, right?
Correct.
So what are we referring here as a creation? So what is that you are referring to creation?
He is a married person. He gets one part.
So you are telling an example of where father, mother and two children are there.
Yeah, both
and
are
then
married.
They both are married, and then there is a partition. So whether the two children who were there, whether that HUF will get automatically created.
That is what. Because here the property will become a HUF property. So there is no question of transferring the property from individual to HUF for inadequate consideration in this case.
Okay. Now the issue here is that when it is partitioned, it is given to the members. It is not given to the new HUF of the children. Okay. So let's say there is a younger son and younger daughter-in-law, and the elder son and elder daughter-in-law, and all of them gets the equal share. all of them are the members of the HF. Today, the female members of the HF are also co-partners as per the amendment in 2021 onwards, whenever the Hindu Succession Act was amended, all of them gets the equal right. Now, this property share that is coming to the younger brother and the younger daughter-in-law cannot automatically create its own HF. It becomes the share of them.
It will become their property.
Their property, individual property.
So what is the daughter's stand after her marriage in case of HUF?
She will become the member of the husband's HUF.
She'll exit from the...
She will exit from the father's HUF.
Another question. Now HUF is used for tax planning most of the time. So there is no transfer of property as such. But the income generation, a company is formed and the business provider or consultancy provider is an HUF karta. So will the clubbing provision still apply there?
There is no clear provision like 64(2) in terms of property, but this can become clubbing because it is there is a provision that says that if there is any income earned in the personal capacity of an individual member of an HUF, then it should be taxed in the individual member's hand. It cannot become the income of the HUF.
Even though the generation is in the name of HUF.
Correct. It is not generation. It is only the mere movement of money into the HUF's bank account.
Yeah, by the karta.
Correct.
Not in
So
individual
that,
capacity as a karta.
correct, correct. So that becomes taxable in the hands of individual by way of interpretation to state that any income generated by a member of HUF in his personal capacity, will become the income of the individual and not the HUF. Say for example, I am a chartered accountant, I am doing training and lecturing in various institutes, and this is happening because of my personal individual qualification and personal capacity. And now I cannot tell the training income that I get or the teaching income that I get will be income of HUF. Because it is happening through my personal capacity and it should be taxed in my individual name, and I cannot shift that income to the HUF. HUF should become a collective business, and it should become, or if there are any ancestral property which is coming to the HUF, and in that capacity, if HUF is running any business of letting out of the premises for rental income or running any business, and then that becomes the joint business, then it becomes the income of the HUF.
Should we declare share of income received, even though not received, share of income every year in IKEA as exempted income? Should we declare like how we do for partnership firm? Share of partnership firm, we declare in IKEA as exempted income. Should we declare it as for HUF also, even though we don't receive it every year?
So it is receipt or not, it is because of the accrual concept that you follow. It is suggested that you declare, but many of them are not declaring it or not showing it. The moment your HUF has already paid the tax and it is the share of each member is determinable, it becomes the income of the member. So there is no receipt basis taxation, it is the accrual basis that we look into it. It is the disclosure wise, definitely it is required. Whether in practice it is happening or not is the practical issue, but the law wise it becomes the income of the member and it needs to be disclosed in the exempt income schedule.
But generally the share is not determined, right? At the end of the day, it's the karta who will decide who to get out, traditionally speaking.
But in today's thing, Hindu Succession Act says that it is the equal share of all the members, 4 persons. Correct, if there is no written document. But if there is a written document, then and if HUF does not prescribe the share in the written document, then again it becomes equal. Otherwise, if there is specific mention in the HUF formation deed where that so and so person gets 30%, so and so person gets 70%, then it will be. It is not correct, but that does not happen. That is what I am telling. But that is some cases we have seen that is happening, but which is not correct.
So if it is not determinable when the karta is alive, let's say, it is not yet determined in writing.
It will be equal.
So should we still, do you recommend that we still declare in the individual return?
Yes. Now, when will it get accumulated? That is the time of approval versus receipt. The kind of the confusion or the ambiguity that is there. Few people follow on the distribution only when I receive I will show it. That can be done.
This partial what you call distribution.
It is like a simple example like the FD interest that is getting accumulated on a 5-year FD. The bank gives it to me at the end of the 5th year. But should I declare that income that is getting accumulated every year, or should I show it at the end of the 5th year when I redeem the FD? So practically speaking, if I am following cash basis of accounting, I can show at the end of the 5th year. But in today's world, because of TDS provisions, in 26 days it gets disclosed for the period of the first year how much TDS is getting deducted on the accrued interest. Then obviously I have to show it. Or in other words, I can also postpone that instead of not claiming TDS, and I can postpone that and claim it. So it depends upon the basis of accounting and how you disclose it. Okay, so this is on 10-to-A, the profit sharing ratio. We were discussing about the different types of receipts that the partner gets. Now let's take an example of the partnership deed says that 15% interest on capital can be given to the partner's capital, and as per Income Tax Act, they say only 12% is allowed as interest on capital. What happens to this 3%? In the computation of partnership firm, 15% is debited to the P&L account, and what is received by partner is also 15%. Entire 15% is taxable in the hands of partner, or what is the stand?
3% will get taxed. In the partnership firm, you disallow the 3%.
Right. So I will repeat again. So I think there is some bad jumping into the conclusion, but you have jumped into a wrong conclusion. So I will give you an example again. So 15% is the interest on capital prescribed in the partnership deed and debited to the P&L account of the partnership firm, and the same income is transferred to the bank account of the partner. Okay. But in the income tax provisions, only up to 12% interest income is allowed as an expenditure in the partnership firm. So now, whether entire 15% is taxable in the hands of partner was the question. 3% is taxable. How many of you say 3% is taxable? Okay, I will make it more specific. I am only talking from the partner's perspective. So from the partner's perspective, how much is taxable? Question was, in the hands of partner, entire 15% is taxable. First question. Yes. So yes, people, I believe it. Those of you are telling no. The next question is it 12% or 3%? How many of you say 12%? How many of you say 3%? 12%. Okay. Is there anybody saying 3%? No. Okay. So 3% is definitely not the correct answer. 12% is the correct answer. So those of you said 15%. Ideally 15% would have become taxable if the entire 15% is allowed as an expenditure in the hands of partnership firm. Since partnership firm is enjoying only 12% of expenditure, the other 3% is not allowed as an expenditure, thereby the tax is already paid by the partnership firm to the extent of 3% of interest on capital. Hence, that 3% will again not get taxed in the hands of the partner, and therefore only 12% is taxable in the hands of partner. Okay. Similarly, the salary also. We have this section 40 clause B giving the maximum remuneration that can be drawn by the partners. There is a formula. I think when you go into the income from business or profession, you will learn more into it, where it says book profits 90% of the first 3 lakhs plus 60% of the balance book profits is the maximum remuneration that can be allowed as an expenditure in the hands of partnership firm in terms of overall remuneration for all the partners. If there is any remuneration which is paid in excess of this limit, that will not be allowed in the hands of the partnership firm. Thereby, it will not get taxed in the hands of the partner. The logic here is that if it is getting taxed in the hands of partnership firm, it will not get taxed in the hands of partner, though it is received by the partner. And if something is allowed as an expenditure, then it should be taxed in the hands of the partner. That is the whole logic here in terms of partner and partnership firm. So this is again similar example. I think this is more or less. In the last example, we did a slab basis taxation, but in case of partnership firm, it will be 30% flat. There is no slab basis. So 6 lakhs earlier, it was only 32,500. Now it becomes 1,80,000 as the tax. So balance 4,12,000 is left. As against what was left there was 5,66,000, but now only 4,12,000 is left, which is divided to 3 partners. Next provision, section 10, subsection 4C, interest from masala bonds. So this is popularly known, I think, in the Finance Act also. The Finance Minister also said this as masala bonds, or the budget memorandum also speaks like this. what is that? They wanted to give this flavor of Indian currency to the bonds. So whenever a foreign person is investing into India, he invests, if he says that he is investing in masala bond, that is nothing but a rupee denominated bond. So even if he transfers 1 lakh USD as an investment into India, then that gets converted into INR. So equivalent of 8 lakhs or 80 lakhs or whatever INR, it gets converted and rupee denominated bonds will be given. And any interest that is paid on these bonds will also be paid in the INR, and this interest will be exempt in the hands of the person who is investing in India. Ideally, any investment in India and interest on non-resident will be subject to tax at 5%, and TDS also will be done under section 194 LC. So, but this says there is an exemption and there is no requirement of TDS and there is no taxation of the interest on this masala bonds, provided the bonds are issued between the prescribed period, that is 17th September 2018 till 31st March 2019. If a bond is issued on 10th of April 2019, which is outside the date of the prescribed dates, then it becomes taxable and TDS under section 194 LC at 5% will be applicable. So there was a committee meeting that happened with the Prime Minister's office on 14th September based on the recommendation and the guidelines or the inputs received from the committee. They brought up on 17th September 2018 for getting more inflows to the India during this period. So they wanted to attract more inflow of foreign currencies and investments into India. In order to promote the investments, they exempted the interest on the investments made during this period of 17th September 2018 till 31st March 2019. Then comes the popularly called as leave travel allowance, section 10, subsection 5. So this is more likely applicable to most of the employees. Basic condition, let's say I'll give you a scenario before getting into the exemption directly. Okay, let's take 1 lakh as my salary, gross salary. Out of that, it says 50% is basic salary, 50,000 is basic salary every month, and 40% of basic salary, that is around 30,000. Okay, 50% of 40% is 20,000. Okay, so 20,000 is my HRA, and the balance, what is left out? 50 plus 20. 50 is basic, 20,000 is HRA, and balance is 30,000. 30,000 is other allowances. Okay, now my components of salary is 50,000 basic, 20,000 HRA, 30,000 is other allowances. Total 1 lakh. This is my salary structure. Remember this salary structure, we'll come back to this a little later. Okay. Now we'll understand leave travel allowance. Do you remember this salary structure? Yes. 50,000 basic, 20,000 HRA, 30,000 other allowances. Now what is leave travel allowance? It is an allowance given under the income tax as an exemption that if any expenditure spent on travel, then that allowance is exempt under section 10 subsection 5. Okay, any allowance given for the purpose of travel, that allowance spent for the purpose of travel is exempt under section 10 subsection 5. There's a lot of other conditions, we'll quickly run through all the conditions, but the overview of the section is that it is the background. When we see they wanted to promote the travel industry one, and also give the benefit to the employees to travel back to their hometowns, to promote their travel or go back to their hometowns and come back is what they wanted to promote. Travel industry is the first objective, and the second objective is to promote the lifestyle, personal life balance in terms of allowing employees to go to their hometown and come back. Okay, so this is the objective behind this exemption. So whenever I spend any money for traveling, then that expenditure is allowed as an exemption under section 10 subsection 5. Now let's see into certain aspects of the practical issues or practical aspects that needs to be remembered. If I travel to, let's say I travel to Dubai. If I travel to Dubai, is the travel allowance allowed?
No.
Travel allowance exempt.
Not
Is it exempt or not exempt?
Not exempt.
Okay. So very clear that we all know that the travel should happen within India. Okay. So that means the objective of promoting travel industry in India is what the main objective of the Income Tax Act. Point number one. Point number two. If I travel alone, let's say I want to go to Delhi. Okay. If I travel alone to Delhi and then come back, is it allowed or not allowed?
It doesn't differentiate.
Pardon me?
It doesn't differentiate whether you have to travel with a family.
And I will come back.
Families.
But component is not there in the salary.
Interesting point. We'll come back. So he is connecting to the illustrations that we had in the initial part, 50,000 of basic salary, 20,000 of HRA and 30,000 of other elements. So we'll finish this part. So interestingly, when there is no component of leave travel allowance in the salary, the allowance cannot be claimed as an exemption, first and foremost thing. Many misconceptions that happen in the practical turnaround is that I have traveled, my friends are claiming leave travel allowance, I also went on a vacation with my family, I also want to claim this, I have train ticket, I have flight ticket, I have petrol bill, can you kindly consider this and ensure that I get a higher refund is what most of the time that the employees will jump into that conclusion. Immediately, first and foremost, the question from our side should be that do you have a component in your salary structure as to is there any specific leave travel allowance? If it is there, then it can be reviewed further in terms of the other conditions. If it is not there, then full stop, no exemption will be allowed under section 10 subsection 5 if there is no component specifically mentioning the leave travel allowance. So let's add that allowance here now because you have got that interesting point. So 50,000 is my basic salary, 20,000 is HRA, 10,000 rupees is LTA, 20,000 is other allowance. That means on a full year basis I have 1,20,000 of leave travel allowance. Monthly 10,000, full year 1,20,000 of leave travel allowance. Now can I claim? According to sir it is yes. Yes or no?
Yes.
Okay. My question was, alone I am going to Delhi. Should be allowed. Okay. Any other views? Yes sir?
The word used is and not
The word used is?
Himself
And his family, okay. So that means to say if I travel alone it is not allowed and it should be only allowed when my family comes along with me. But my objective is to go to my hometown. When I am working alone here, first I will ask them to come here, then I will go along with them. Okay. So there is a contrary between this. So the words that they use is that you should travel along with your family. So when they say travel along with family, if employee himself travels, ideally leave travel allowance exemption is not allowed under section 10 subsection 5. So probably they meant your parents are living in Delhi, when you yourself and your spouse and children are staying here, when you, your spouse and children along with them go to your hometown to meet your parents, then that is allowed. So probably they meant that, but the objective again there is a conflict. Apart from that, they wanted to promote the tourist industry or vacation and all of that. Then if we see from that perspective, it is permitted. If I alone go and enjoy and come, it is not allowed. I go to Disney World and come back.
Always we need to go and hometown we have to go or somewhere
Anyway. I said the objective is to ensure that they get the personal life balance by going to their hometown and coming back. But again there I have to alone go if I am working in a different city and if my family is staying in the hometown. So that's why I said there is a disconnect.
He applies in
He's
not married.
Not married, then family consists of parents also, sir, not only spouse and children. Okay, so then again, good question. They mean to say, we assume generally family means everybody, brother, sister, parents and spouse and children. But fortunately or unfortunately, LTA is available only for self, spouse and children and not for parents, brothers and sisters. If I am unmarried, then I cannot claim this benefit, basically. Okay, we can construe the meaning of family including our parents, brothers and sisters, but then technically when we get into the depth of the section, it very clearly says that exemption is allowable for self, spouse and children.
Isn't it for dependent parents or sister mothers?
No, it's not there.
Brothers and sisters. Brothers.
Is it there? It says what?
purpose of this clause family means spouse and family relationship and the parents, brothers, sisters of the individual only or being dependent.
Okay. So it is there as a provision if it is only dependent. So if they are not dependent, then it is not allowed. If they are dependent, it is available. But then most of the cases, in the kind of setup that we have, parents are sometimes the probability of both the cases happening, dependent and not dependent. So then that accordingly has to be seen in terms of but primarily it is self, spouse and children most commonly used. Parents is how many of us or how many of them practically include the parents also in their family planning. But parents go separately, children go separately, isn't it?
Yes.
Only one yes. What about others?
Others are not taking vacations.
Pardon?
Others are not taking vacations.
Not taking the vacations.
Sir, that Vasudeva Kutambakam, even I will go with my friend, they also are.
But income tax does not recognize. Okay. So let's. So ideally, it says family along with the members.
You will have to go along with everyone in the family. For example, one person is excluded. You are
Not
not going to
required.
it.
Not required. Not specifically giving any exclusion, telling that you have to go up with all the members of the family. It says family members. So husband and wife going, leaving children back is also allowed. Or husband and children going, leaving wife back is also permitted. Practically not possible. Possible? Not possible.
Only wife.
So that limit is not there, sir. It is possible.
So, one question. LTA allowance is available in the pay structure,
Hmm.
but employee failed to submit the proofs.
Hmm.
While filing the return, he can still claim the LTA.
He can still claim, but it could be subject to verification by the tax authorities, and he should be able to produce those documents at the time of
Now,
verification.
assessors are more smart that the moment we say that they are ready to get the bills also, whether they travel or not.
That's what the income tax authority is also very smart. Just booking the ticket is not sufficient, but boarding pass is required to ensure that they have travelled. And only travel ticket is not sufficient, but they'll have to also establish that if they've actually travelled, if there is some hotel bills or if there is some stay hotel food bills or some tourist places which they have visited, if they have tickets of that particular date substantiated to prove that they have actually travelled, will be asked by the tax authorities in order to allow these claims.
Petrol bill is not allowed, right?
Petrol bill is not allowed. If they are travelling by car, then they will have to claim only to the equivalent fare ticket of the train, first class AC train.
And is there any maximum limit for the salary component? Like maximum this can be given as a
No, there is no limit. It can be anything. Usually they follow 5% or 1 lakh limit or something like that. It can be anything. There is no limit. So the quantum again depends upon the rule B. So the depends on the modes of the transport. It can be airfare, the economic airfare, and it can be the first class AC train fare, and the bus if there is a bus connectivity, and the first class bus fare. Now the next thing is to see the shortest distance. How do I travel? If I have to travel to Delhi, I cannot go to Hyderabad from Bangalore and then go to Delhi. So I cannot claim this distance fare. I have to claim the direct flight fare. Okay. The longest distance cannot be opted. The shortest distance should be opted for the purpose of exemption. And this exemption is available twice in a block of 4 years. So I cannot keep on going every month to vacation and I will enjoy this exemption. But income tax allows only for 2 times in a block of 4 years. Okay, the current block that is in run is 2022 till 2025, and it runs on a calendar year basis. It is not on a financial year basis. 1st January 2022 till 31st December 2025. In any financial year, I can claim only twice in this block. Just in case if I have not claimed in the particular block, I can carry forward this to the next block. Only one can be carried forward, and that one carried forward trip can be claimed in the first year of the next block and not in any of the subsequent year. Let's say I had the 2022 till 2025, I did not travel and I did not claim all the 2 allowances. Then from 25 onwards till 26 or 2025, the first year, I have to claim one additional carry forward benefit. So in the next block, I will get 3 travel allowances. First one being claimed in the first year, otherwise that also gets lapsed. Is that clear?
Yeah.
Okay.
when I saw one time from Bangalore to Kolkata flight, so it showed me something Malaysia, via Malaysia if you go, the ticket flight fare is lesser. Say actually for climbing an exemption, if I travel for that route, then whether it will fall under outside India and then I cannot take the exemption, something like that.
They see shortest distance, sir. If you have gone to Malaysia and come back to Kolkata or Bangalore to Kolkata, then it is not allowed literally, technically. Though you have proved that the amount of travel fare is lesser, when taking flight directly from Bangalore to Kolkata is higher and going to Malaysia and coming back to Kolkata is lesser. So they say take shorter distance.
One of the link is outside India, so it
But there are a lot of challenges. Which fare I have to take? It is a dynamic fare pricing. If I book at the earliest, it is lesser. If I book on the immediate date for next day, it is higher. So there are a lot of challenges, but it is the actual fare that you have booked is what is allowed.
So sometimes unavoidable circumstances, like recently most of the flights landing to Bangalore, they landed in the Chennai airport. So the circumstances, what is
There it is because I have booked the ticket to Chennai, but he is coming to Bangalore and going to Chennai. I am not being charged anything, right? Because of weather conditions, if weather conditions do not allow for arrival at Chennai airport, they divert the flights to the Bangalore airport. So then I will land in Bangalore. I am not getting charged anything. Or if they arrange for any other additional flight after 2 hours of layover in Bangalore, if they allow, they will allow it at a free of cost and I don't incur any cost, right? It shouldn't be a problem. If I incur any additional cost, then that will become a question whether it is allowed or not. It is not allowed because what they see is the direct flight cost. You might have incurred additional cost, but what is allowed as an exemption is the direct flight cost. Okay, moving on to the next section, gratuity, section 10, subsection 10, again very important section in terms of the retirement benefit. So retirement benefit, on retirement, gratuity is exempt. On his becoming incapacitated prior to such retirement, receiving gratuity at that occasion, that is also exempt. On termination of an employee, receipt of gratuity, that is also exempt under section 1010. Received by widow or children of employee on his or her death is also exempt under section 10, subsection 10. The monetary limit given under Income Tax Act as well as the Gratuity Act are now aligned. Earlier it was not aligned, now it is 20 lakh, which are aligned in both the provisions of the Gratuity Act, Payment of Gratuity Act versus the Income Tax Act. When it is not exempt, if gratuity is received during the continuation of an employment, it is not exempted. Very important. Most of the times we come across this kind of situation where employee has worked in a particular organization for 7 years and at the end of 7th year he is quitting that organization, he gets the gratuity and immediately he joins in another organization. When he joins in another organization, that is called as a continuous period of service, and the gratuity received from the first organization in the 7th year is not exempt.
Termination includes this also, no? I mean retirement or when I'm changing the job, that includes retirement. I mean termination or retirement. There is one difference which I said.
Correct. So that's what I'm coming to that part of view. So this is the litigation point of view. Ideally the objective of the section was to allow at the retirement actually when they completely quit the job. But then a lot of arguments happened and a lot of judicial precedents came into picture, and then in the judicial precedents they have come across to state that it should be allowed. But overall limit, then your claim is only 20 lakhs. You don't get 20 lakhs in each of the limits. In the first instance, after 7 years, if I got 13 lakhs of gratuity and I work for another 10 years and I get another gratuity of 14 lakhs. So 14 plus 7, both put together, 20 lakhs is what I get, and not 20 lakhs in first instance and 20 lakhs in the second instance. There are 4 scenarios. One is gratuity received during contribution of service is fully taxable in the hands of all the employees. If there is any gratuity paid for whatsoever manner during the continuation of service is taxable fully. And gratuity received at the time of termination of service by government employees, central government employees, state government employee or local authorities employees is fully exempt. So this is the exemption in the hands of the specific class of employees, that is government employees. Then for others, like private sector employees, it is exempt subject to conditions. A non-government employee is considered as a exclusion from the specific complete exemption. So a non-government employee comes under who is covered under Payment of Gratuity Act and who is not covered under the Payment of Gratuity Act. The calculation mechanism will differ in case of who is covered under Payment of Gratuity Act and who is not covered under Payment of Gratuity Act. So to that extent, the who is covered under Payment of Gratuity Act, the left side gives the lower of the following shall be exempted: actual gratuity amount received, or 20 lakhs of threshold limit, or 15/26 into completed year of service into salary per month is what is exempt. Now what is salary per month? Salary per month is basic plus DA, only basic plus DA has to be taken. DA, whether forming part of retirement benefit or not, entire DA has to be taken, and basic should be taken. There is nothing else, there is no other allowances will be added, only basic plus DA shall be taken. What is completed year of service? If the completed year of service, let's say I worked for 21 years 7 months, then that fraction in excess of 6 months shall be considered as one completed year. If I work for 21 years 3 months, then 21 years. So that is the guidelines mentioned under the Payment of Gratuity Act. And I come under those who are not covered under Payment of Gratuity Act. The small changes are that is the third condition. The first two conditions remains the same. That is actual gratuity amount received, 20 lakhs of the threshold limit. And the third condition goes on to say half salary into completed year of service. What is salary per month? Salary per month, here you need to take the average salary per month at the time of retirement. And how do you arrive at the average? Last 10 months salary drawn will be considered for calculation of the average. And in terms of the number of years of service, here fraction is ignored. Even if I worked for 7 years, 11 months, 20 days. Though I worked almost 8 years, that fraction will be ignored. So only 7 years will be considered if the person is not covered under Payment of Gratuity Act. That's the only difference. And in case of salary, here it will include different definition, which is equivalent to HRA salary. HRA salary and this salary will be same. Salary includes basic plus DA forming part of retirement benefit plus commission which is paid as a percentage on turnover will be included. Commission which is paid as a fixed ad hoc amount will not be considered for the purpose of this computation. Whatever commission is paid as a percentage on turnover will be allowed into computation mechanism. DA forming part of retirement benefit only, otherwise it will not be considered. So this is the mechanism as to how we compute the exemption in case of a non-government employee. Government employee fully exempted. And in case of gratuity received at the time of death, irrespective of the kind of employee, full gratuity is exempted.
So this pay
Here salary
covered in Payment of Gratuity Act. Is there any requirement of registration by a private?
Not required any registration, but the law automatically gets applied if the specific limit of number of employees, if they cross that, then they are considered as they are covered under Payment of Gratuity Act. Automatically it will apply.
Last 10 months of salary drawn means, say for example, last 10 months, because of some issue, 1 month I did not go to the office, I received 0 salary.
Considered zero. It is only to average out if there is any increments that are happened in the last 10 months. If there is no increments in the last 10 months, then the last month's salary will be the same thing. That can be considered. So moving on to the next retirement benefit of leave encashment, which is referred under section 10(10)AA, where there are 3 scenarios. One is in terms of leave salary received during the continuous period of service. When I say continuous period of service, encashment, leave encashment that happens every year. If I am entitled for 30 days of leave and if I utilize only 12 days and the balance 18 days is encashed at the end of the financial year. So that 18 days of leave salary that I get is completely taxable, no exemption under section 10(10)AA. First thing is encash during the period of service is fully taxable, no exemption. Okay. The next thing is in case of government employees, it is fully exempt. So leave salary received by government employees, whether it is central or state government employees, it is fully exempt. So there is no restriction in terms of how much is taxable and how much is exempt. But when it comes to non-government employees, again we have the conditions in terms of the minimum of the following. Leave salary received by non-government employees shall be exempt to the minimum of the following. What are those things? 4 conditions are there. The 4 conditions are the actual leave salary earned or the leave salary encashed and the statutory limit of 25 lakhs. Earlier to 2023 it was 3 lakhs the statutory limit mentioned in the Income Tax Act. Now recently they have increased this to 25 lakhs of the statutory limit, and 10 months average salary per month, 10 into average salary per month, and then average monthly salary into period of leave unavailed in terms of months. So this is the 4 limits. The first 2 is simple, the next 2 is what you will have to compute, that is average salary per month. Here again salary definition remains the same, that is basic plus DA forming part of retirement benefit plus commission, which is considered as a percentage on turnover. And completed year of service, again here fraction is ignored, it is not considered. If I have completed 21 years, 9 months is ignored, 21 years is only considered. Salary drawn during last 10 months immediately preceding the retirement shall be considered. leave salary paid to the legal heir of the deceased employee is not taxable. So then again, at the time of death, any person, the legal heir getting the leave salary, not taxable. Though these limits will not apply for that person, entirely it is taxable, exempt. Now coming to the computation of how do we calculate the unavailed leave period. So as per Income Tax Act, they say maximum of 30 days leave per year is allowed, irrespective of the leave policy of the respective companies. Some companies follow 40 days, some companies follow 45 days. But for the purpose of Income Tax Act, 30 days is the maximum leave period that can be utilized and availed for a particular year. Only that 30 days should be considered. Now let's say for 20 years I have worked. What is the total leave that I am eligible as per Income Tax Act? 20 years into 30 days per year, 600 days. And let's say in the last 20 years I have availed 180 days of leave. 180 days of leave. That means what is my unavailed leaves? Out of 600, reduce 180, the balance 420 is the unavailed leave. Now this 420 has to be converted into months. That is divided by 30. 420 divided by 30, you get 7 months. 7 months?
Yes.
Yes? I wanted to just check if I... 14 months. So I have done 420 divided by 60, then it gives 7. 420 divided by 30, it should be 14 months. So 14 months is considered as the unavailed leave in the equivalent of months. 14 months into average monthly salary is the last limit that I am going to calculate. So this 30 days is very important. Some companies has policy of something called as casual leaves, and then government holidays, and then sick leaves, and then privilege leaves, and then maternity leaves, paternity leaves, many other leaves are there. All put together, if it comes to around 45-50 days in some companies. So then maximum I can claim is only 30 days.
So out of those leaves, only casual leaves are carried forward. Other leaves get...
That depends upon the leave policy of the company. So it is specific to the company. Whatever is the leave policy, what can be carried forward and what can be encashed is company specific. Income tax will not come into that picture. The moment there are companies which says there is no encashment, so that means you don't get any exemption. When there is encashment only you get the exemption. When there is exemption, this is the method in which you compute.
Another question, sir. Practical question. Whereas in Form 16 leave encashment, when an employee resigns the job, they show it under exempted leave encashment. And employee, when SSC comes to file the return, though it is taxable, they say please claim the exemption. How fair or...
If it is given as an exemption, then employer would have reviewed that and then he would have taken it to exemption.
But he falls in the first category where he is going to continue his service in another company. He has resigned the job. He has not retired. He has resigned the job. The leave encashment.
That leave encashment can be claimed as an exemption. What is during continuous period of service is I am in the same company.
Okay.
And for first year I am not utilized 18 days of leave, and for that 18 days I am encashing. That is taxable.
Okay. But if he changes the job, then it is exempt.
So this 10 lakh rupees for the entire lifetime of the employee.
Correct. 25 lakhs.
Sorry, whatever is that. So
entire lifetime.
It's for the entire life. So
Correct.
if you resign for one of the companies, has already claimed 10 lakh exemption, so 15 lakh is already there.
Correct. That's what we said in the gratuity also. Same will apply here also.
Sir, recently this limit is increased.
Correct. 20 lakhs. Budget 2023. Earlier it was 3 lakhs.
Yes, now
25 lakhs. Now moving on to the next retirement benefit of pension, section 10, subsection 10 AA. Here it is very simple. 1/3 of the total pension is exempt if gratuity is received, and half of the pension is exempt if gratuity is not received. So very logical thing that if I am already in receipt of gratuity, the lesser amount of pension is exempt. If I have not received gratuity, then half of the pension is exempt. Half of the pension is what? Total pension. The small catch that we will have to keep in mind is to calculate what is the 1/3 of what? 1/3 of pension. When we colloquially commonly use, we say it is I have received 3 lakhs, 1/3 of 3 lakhs is 1 lakh is exempt, but that is wrong. Okay, I have received 3 lakhs, half of 3 lakh is 1.5. 1.5 is exempt, 1.5 is taxable, that is wrong. Okay, why? Because we will have to see what is the percentage of pension that is commuted. What is commuted? Commuted means what I am receiving in form of a lump sum commission is called as a commuted pension. What is received in monthly basis is called as uncommuted pension, which is not a lump sum nature. So what is uncommuted will be completely taxable, and what is commuted will be exempt. Now let's say I am entitled for 10 lakhs of pension if I take in lump sum today. Okay, but I don't take 10 lakh. I take only 60%. That means I get 6 lakhs. Okay, the 4 lakhs will be available, which I will be entitled for a monthly pension of X amount. So 6 lakhs what I am receiving is not the amount that I have to consider for 1/3 or half of it. Okay, the total pension of 10 lakhs has to be considered for the purpose of computing 1/3 or half of it. So if I receive 6 lakhs and if I am in receipt of gratuity, let's take first scenario of I am receipt in gratuity. What is the amount of pension exempt? 1/3 is exempt. 1/3 of what? Total pension. What is my total pension? 10 lakhs, not 6 lakhs. 10 lakhs. 1/3 of 10 lakh is 3,33,333. So 6 lakhs minus 3,33,000 is taxable. 3,33,000 is exempt. But if I receive the gratuity, then if I not receive the gratuity, then 50% is exempt, half of it. So half of 10 lakh is exempt. That means 5 lakh. So out of 6 lakh, 5 lakh is exempt. Only 1 lakh is taxable. So when I have to consider, when I apply this 1/3 or half into the pension, it should be total pension and not the commuted pension. 6 lakhs is commuted pension, 10 lakhs is the total pension. So if you know only commuted pension, how do you calculate the total pension? Commuted pension divided by the percentage of commutation, that is 60%. 6 lakh divided by 60% gives you the total pension of 10 lakh. Most of the cases, we know that what is the amount received. They say that I took only 40%, the balance 60% I am taking monthly. 40% means, so 4 lakh or let's say 6 lakh divided by 40%, you get the total pension. So that is the main thing that you have to remember. Otherwise, uncommuted pension, whatever you receive in a monthly basis, it is completely taxable. And it takes, in terms of government employees, commuted pension is fully exempt. So in all three what we are observing, gratuity, leave encashment, pension, for government employees no conditions apply, it is exempt. Okay, for non-government employees only this minimum of the following formula, conditions, all of this is what we are looking into it. Uncommuted pension even for government employees it is taxable. Uncommuted pension even for government employees it is taxable. So only for commuted pension government employees it is exempt. Are you clear?
Is it applicable to pension is received from the employer only, or like there are some
like bankers are appointed and bankers are discharging trust.
Some insurance policies are there which will give the pension after some.
Those are coming under the insurance receipts like 1010D and all of that, and NPS 1012, 1013. That does not come under this.
For armed forces also essentially uncommuted.
Correct. Yes, is it interesting? Are you all finding good to proceed? Boring? No. There is voluntary retirement compensation 1010C. So rule 2B gives the retirement compensation if there is any voluntary retirement. We have a scheme that is floated in terms of the scheme prescribed by the government approved plan. Then the exemption is given, maximum of 5 lakhs. Actual amount received or 5 lakh. Threshold limit of statutory prescribed limit is 5 lakh. Even if I receive 45 lakhs of VRS amount, only 5 lakhs is exempt, 40 lakhs will become taxable. So in terms of monetary limit, they need to work around this limit, which was way back, they have kept at 5 lakh. They will slowly do it. They have done gratuity, they have done leave encashment, slowly they will do this limit also. Time is the matter and they will do it. Retrenchment compensation, if there is any fight or if there is any conflict between the employer and employee, if there is any compensation given, that compensation is exempt under section 1010B. Actual amount received or 5 lakh or the amount calculated as per the Industrial Dispute Act 1947, that gives the formula similar to the Payment of Gratuity Act 15/26, but instead of 15/26 it is 15/30 year into average salary for last 3 months into completed years of service.
So VRS amount, government employees also
same.
Taxable.
5 lakhs or whatever it is, the same condition will apply. Now we have completed the retirement benefits. Quickly we will go into other exemptions in case of individual. In case of tax paid on the perquisites by the employer is exempt under section 1010CC. Let's say I give you a perquisite. What is a perquisite? Perquisite is a benefit given in kind other than money. Allowance is a benefit given in form of money, and a perquisite is a benefit given in form of a kind or a facility other than monetary benefit. A non-monetary benefit is considered as a perquisite basically. Any benefit which is in the form of a kind or a non-monetary benefit is a perquisite. Let's say the car facility is given, house facility is given. So which is called as rent-free accommodation or a car facility is given. For all these things, there is a rule under salary provisions. You will learn how to value all this value of the income. So the value of the income, let's say it comes the benefit derived by salary under the head salary under perquisites under section 17(3). Let's say it is 2 lakh rupees. On this 2 lakh, the tax has to be paid by the employee because it is an income in the hands of the employee. So the tax, if paid by the employer on behalf of the employee, that also becomes perquisite, and that perquisite is exempt under section 1010cc. Okay, that perquisite, the tax perquisite or the tax paid on the perquisite is again a perquisite in the hands of the employee, but that will not be taxed because it is exempt under section 1010cc. So any taxes voluntarily paid by the employer on behalf of his employee on the perquisite given to him under section 17(2) of the Act is exempted and cannot be considered as income in the hands of the employee. So here again some courts have held that the above taxes paid is also considered as perquisite received by the employer, which is exempt from tax. So it is perquisite again, but it is tax. The next level of thing is that on that tax which is considered as income, certain times the tax on tax is also perquisite. That becomes the conflict area, whether it is exempt or not. In the first principles, that the tax paid on the perquisite is exempt and not taxable under section 1010c. Okay. Moving on to the next thing, the famous or the very commonly known and the changes that have happened in the last 4 or 5 years in the insurance domain or the investments in the insurance. Any proceeds from LIC is exempt under section 1010d. Now what is exempt under section 1010d? What I invest is exempt or what I get is exempt. What I invest is eligible for deduction under section 80c subject to conditions, and what I receive is what I am talking here under 1010d is exempt. That means the investment amount plus the gains that is accumulated or the bonus or the profits that are getting accumulated is also exempt under section 1010d provided it meets certain conditions. What are those conditions? The premium paid should not be more than 10% of the sum assured if the policies are issued after 1st April 2012. Prior to 1st April 2012, it could be up to 20%. After 1st April 2012, it should be maximum 10% of the premium. That means to say if somebody is investing in insurance as a lump sum amount, then that proceeds from such kind of insurance is not exempt under section 1010d. Somebody who is investing on a periodically year-on-year basis and that payment of periodical or annual premium is less than 10% of the total sum assured of the entire policy, then it is exempt under section 1010d. So the amounts received under life insurance policy including bonus is exempted. The following are not covered for exemption. Any amount received by an individual on death of his independent on his dependent with disability, since it is deductible under section 80dd, and keyman insurance policy is not exempt because keyman insurance policy, when who is taking keyman insurance policy? The businesses takes the keyman insurance policy on the risk to mitigate the risk of the keyman in the business. So when they have taken the policy, the premium paid on the keyman insurance policy is allowed as an expenditure under section 37. Thereby the proceeds from keyman insurance policy, if received by the company, is taxable and not exempted. Okay, it becomes taxable in the hands of the business. If it is received by the family member of the keyman, then it is not taxable, it is exempt. Okay. So that is in terms of the amount received from LIC. So in terms of the premium, any sum received under an insurance policy issued on or after 1st April 2003 but on or before 31st March 2012, the 20% criteria is applicable. If it is after 1st April 2012, the criteria is 10%. And if there are specially challenged people, the criteria of 10% got increased to 15% from 1st April 2013. So 1st April 2012 to 1st April 2013, for all of them it was 10%. And for physically challenged people, they again changed it in 2013. From 1st April 2013, they can pay 15% of the sum assured as the premium. Then they also allowed for claiming exemption under section 1010d. Moving further, amount received on ULIP issued on or after 1st February 2021. So this is the interesting amendment that happened. A lot of people started investing through insurance in the participating plans of the market. So what is a ULIP? Unit linked insurance plan is nothing but the money which is invested in the insurance is participating plans which directly invest in the market in form of mutual funds or participating funds. In these cases, there were a lot of money which was flowing and they were claiming exemption on the 1010D. Thereby, they wanted to curb this. They curbed this in 1st February 2021 and reduced this limit up to 2.5 lakh. Whatever amount you spend in ULIP policy is exempt. Over and above any amount spent in the ULIP policies will become taxable and do not enjoy the exemption under section 10, subsection 10D. Similarly, recently we have got another limit in 2023, that is in the budget 2023, where they said in other LIC policies also you cannot invest more than 5 lakhs. This is a recent amendment which is applicable from 1st April 2023 onwards. Any person who is taking life insurance policy after 1st April 2023 for an amount which is more than 5 lakhs, then the policies that are taken after 5 lakhs, the proceeds from such policies is not exempt. So only policies for which the premiums are paid up to 5 lakhs are the proceeds from such policies are exempt. So similar to ULIP, they brought it into other set of policies also in terms of non-participating savings plans also. So thereby today, life insurance policy should be treated as life insurance policy and not as a dumping mechanism to claim the benefit. Okay? Because a lot of people were planning this with high income category people who were getting 1 crore, 1.5 crore, 2 crore salaries and all. They were routing 30 lakhs, 40 lakhs into ULIPs and they were claiming exemptions. So thereby they wanted to curb this and they wanted to make this as a basic necessity but not as a device of mismanagement. Thereby they brought all these limits. But however, if the insurance policy or any ULIP money received on the death of the person who is the insured person in the hands of family, it is completely exempt. Then moving on to the PF Provident Fund, section 1011 and 1012 talks about the PF provisions. So as per section 1011, any payment from the Provident Fund to which Provident Fund Act 1925 applies or from Public Provident Fund would be exempt. PPF, any money receiving is exempt. Otherwise, any registered Public Provident Fund or RPF, that is also exempt. So, accumulated balances due and becoming payable to an employee participating in a recognized Provident Fund would be exempt under section 1012. So, this is the exemption that they are giving. So, recognized Provident Fund and Public Provident Fund are exempted under section 1011 and 1012, any amounts that are received. In terms of 1011, Public Provident Fund, it is completely exempt, provided you withdraw it after 15 years. They don't allow to withdraw also, but however, any partial withdrawal that is allowed for specified purposes after 7 years, that is also exempt. But in terms of recognized Provident Fund, it is exempt only if the withdrawal has happened after 5 years. After 5 years of service. If it is withdrawn before 5 years of service, it becomes taxable and the TDS will be done under section 194. So any recognized Provident Fund maturity proceeds that happens after a completed 5 years of service, then it is exempt, otherwise it becomes taxable. However, the exemption under section 1011 or 1012 would not be available in respect of income by way of interest accrued during the previous year to the extent it relates to the amount or the aggregate of the amounts contribution made by that person of employee exceeding rupees 2,50,000. That means, we said that there is a limit from 1st February 2021 in ULIP, 2,50,000. That does not prohibit the person to invest. He can invest more. Just in case if he has invested more, the interest that he gets from that, then that will be limited up to 2,50,000. Anything in excess of 2,50,000 will be taxable. If the contribution by such person or employee in a fund which there is no employer contribution, then the limit is enhanced to 5 lakh. So thereby ULIP, PF, both are equalized in terms of limit of 2,50,000. Only enhanced limit of 5 lakh is available in non-ULIP policies, and where employers do not contribute to PF, only employees contributing, only then the 5 lakh limit is available. Now that means to say, those people who have already contributed more money into the PF account, and if the interest is getting accumulated on the higher amount, is it taxable or not taxable? So they said you have to calculate that in terms of the non-taxable contribution account and taxable contribution account. Any accumulation that has happened prior to 1st April 2021 is not taxable, and any interest that gets credited even after 1st April 2021 is not taxable. So only those amounts which are contributed to the PF in excess of 2.5 lakh after 1st April 2021 will come into the taxable contribution account. Thereby the interest getting accumulated on such taxable contribution account will be taxable and do not enjoy the exemption under section 1011 and 1012. Is that clear?
What happens in case of a public provident ETF?
Public provident fund maximum amount allowed to deposit is only 1,50,000. Even if I want to put 10 lakhs, it is not permitted, point number 1. And up to 1.5 lakh I can put and I can enjoy, there is no issues. And entire thing it is exempt. Interest is also exempt, and at the time when I put also it is exempt, and it is getting deduction under section 80C.
So this 2.5 lakh is only for the employee contribution.
Employee contribution, correct. So this is the limit, how it is calculated, and in terms of what is non-taxable contribution account and taxable contribution account. So that has, this is coming under Rule 9D, which was notified in the tax rules. So it may be noted that interest accrued on contribution to such funds up to 31st March 2021 would be exempt without any limit, even if the approval of income is after the date of 1st April 2021. Now this exemption of 1011 and 1012 is available irrespective of the regime followed, old regime or new regime, 115 BAC or not, this exemption is still available. So this is in terms of the PF. Now coming to the NPS pension scheme under section 10, 12A and 12B. So any payment from a national pension scheme trust or a national pension system trust on closure of account or opting out of scheme under section 80 CCD, up to 60% it is exempt, balance 40% is taxable. Now we have Atal Pension Yojana, all of this comes under this scheme, Atal Pension Yojana. There are a lot of life insurance companies which are allowed to run the national pension schemes, and any contribution to that, out of that, any proceeds that is received at the time of retirement, 60% is exempt and 40% is taxable. Partial withdrawal, only 25% is exempt, balance is taxable. Any partial withdrawal from the national pension scheme referred to in scheme 80 CCD, 25% of the entire contributions is exempted. Okay. And in case of approved superannuation fund, on death of beneficiary or refund of contributions on the death of beneficiary, it is exempt. Refund of contributions to any employee on his leaving the service other than retirement is exempt. To an employee in commutation of an annuity on retirement is exempt. These are the three scenarios when it is exempt in case of the superannuation fund under section 10 subsection D. So the last provision 1013A, which we call as the house rent allowance. Popularly, I think most of you would be aware. I will quickly run through. There are three limits. Actual HRA receive 40% or 50% of salary, or rent paid in excess of 10% of salary. 40% or 50% determined based on the city in which the employee is taking the house rent facility. If it is metro cities, that is Mumbai, Kolkata, Delhi, and Chennai, then it is 50%. In all other cities, it is 40%. And the definition of salary for the purpose of this HRA, it is basic salary plus DA forming part of retirement benefit plus commission, which is calculated as a percentage of turnover. There is nothing much in this, it is simple, but there one condition is that in the components of the salary, HRA should be there. If HRA is not there, then HRA allowance is not allowed. Then such person who do not have HRA as a component in the salary can enjoy 80GG rent deduction under section, under chapter 6. Okay? If he is claiming HRA, then he cannot enjoy 80GG.
So that is only maximum to 60,000.
That is maximum only up to 60,000. So it is, for employees it is better to have HRA component and enjoy 1013. Other than employees, salaried employees like business person or who do not have salary income but they have interest income, rental income, capital gain, they can enjoy 80GG but maximum up to 60,000.
I can still claim HRA even if I have rental income.
Yes.
There are no restrictions.
There is no
Even
restriction.
in the same city or outside the same city.
So okay, there is a restriction, right, but they have to practically prove to the officer to state that the own house that I am owning is practically not feasible for me to stay there, thereby I am renting it out and I am staying in the vicinity of my employer place where I have taken it on a rent, thereby I also have a rental income and I also pay rent, thereby I enjoy HRA exemption, and on the contrary I also include the rental income under the income from house property for the purpose of taxation. It is permitted. Now if I have a own house in Electronic City and if I have a place of business in Devnadi, now I cannot daily travel. Own house is in Electronic City, and if I have to come to my office workplace in Devnadi, then I take a rented place in Devnadi, and the house that I own in Electronic City, I give it on rent. That does not mean that I cannot enjoy HRA exemption on the rent paid in Devnadi. Thereby, the income will be taxed separately and HRA exemption can be enjoyed separately.
I think when there is a rental income, clearly shows that okay, that home is not used by me. No. When I'm using for self-occupied only, then there will be issue. No.
Even if it is
self-occupied, for parents can stay and I can stay in a.
Even in case of self-occupied, even if parents are not staying, I can always tell I just kept the house empty. On weekend I will go, or on vacation I will go. Still the HRA exemption can be claimed. But if in Devnadi only I have two houses, one I am renting and one I am keeping, then that will become a challenge to prove that the HRA exemption will not become a valid claim.
What about two houses on rent? One for parents and one for myself?
Only one house is allowed.
One houses are allowed, no? For self-occupied reasons.
That is for house property. He is asking for HRA. HRA two houses is not allowed. Self-occupied two houses are allowed, but not for HRA. So I cannot tell, okay, myself, I am staying in one house, I am paying rent here, and I am having another house in which my parents are staying. So both the rents paid can be claimed for HRA is not allowed. Okay, till here we have completed important sections. Till here we have completed important sections. Now quickly we will run through into different sections which are applicable for non-residents and smaller sections. Some of the sections are not applicable as of today because it was made effective at that point in time on a specific issue. We will run through all of those in the time that we have. So this is important from the perspective of non-residents, not for residents, from the perspective of non-residents. This particular provision was brought way back when the invasion of Kuwait happened, when Iran attacked Kuwait. At that point in time, there was a lot of security issues. What happens if the people are coming from outside India to inside India, whether they can get that money into India, whether the interest income earned on that income is taxable or not taxable. All of that was the issue. At that point in time, we brought in this section to ensure that any person who is coming into India and opening a non-resident external account as per the FEMA guidelines, and the money is parked here which is earned in a foreign source of country, and the interest earned on such account should not be taxable, is the exemption that they get in order to promote a lot of inflow of foreign currency and promote people who are coming into India from the insecurity feelings. They should not get taxed again. So any person who is resident outside India as defined under section under FEMA, that is Foreign Exchange Management Act, or a person who has been permitted by RBI in RBI of India to maintain a such account. What is such account? It is a non-resident external account, and any money that is parked in non-resident external account and the interest earned on such amount is not taxable. Now here the confusion, the NRE account is there, but he is not a person resident outside India as per FEMA. Then it becomes taxable. Just because I have an NRE account and the interest earned on NRE account will not become exempt under section 10(4). It is exempt provided that the person is resident outside India as per FEMA guidelines. The FEMA guidelines has a different residential status, meaning in the previous year in which the computation or assessment is being done, for that previous year, if he has stayed more than 182 days outside India, then he is considered as person resident outside India. So if we are doing it for 23-24, in 23-24, if he has stayed for more than 182 days outside India, then he is considered as person resident outside India. Otherwise, he will become resident. The moment he becomes resident, or person not resident outside India as per FEMA, then this exemption is not available. Okay, so it should not be normally looked from the perspective of characteristic of NRE account. Anybody having NRE account, the interest income is not exempt. Only for those people who are resident outside India, it is exempt. Then moving on to section 10(6), remuneration received by individuals who are not citizens of India. So this is again for a non-resident. What kind of remuneration they can get if they are officials of foreign embassies in India? There is a US consulate in Chennai. US consulate means the US official will come and sit in Chennai and he receives salary from US authorities, government authorities. So then it is the income that is earned in India as per section 5, or he will be sitting in India for the entire year. He will become resident in India for as per the residential status.
Residency is different. Citizenship is matter. As per that. Individual SC who are not the citizens of India,
Correct. He is not a citizen of India. The foreign.
He can be a resident.
And that's what I'm telling. He is becoming resident because he is staying in India. He is located in Chennai and he is performing US official duties in Chennai. By virtue of he being physically present in India for the entire year, he becomes resident. The moment he becomes resident, Section 5 triggers and says that any income earned in India is taxable for a resident in India. Thereby, the US government paying him salary in India will become taxable. Whether US government is paying salary in India or it is paying salary in his foreign account outside India, it becomes taxable in India. To eliminate this or to give the benefit for these kind of officials, they brought in Section 10(6) to state that any foreign officials or government officials working in India and receiving salary from the foreign government is not taxable in India under Section 10 subsection 6. Okay, that is the first thing. Okay, the condition that like the above mentioned member should be the citizens of that particular country. If it is a Canada consulate, Canada person should be there. They cannot hire Indian person. It should be the foreign person itself. And next thing is remuneration received for services rendered in India as an employee of foreign enterprise. If there is any employee who is coming to India from a foreign enterprise and he is getting any salary in India, it is exempted from tax provided his stay in India does not exceed 90 days. That is the condition. If it is exceeding 90 days, then the permanent establishment or personal dependent agent key, all of that will come into picture. So the foreign enterprise is not engaged in any business or trade and the stay does not exceed 90 days and the remuneration is not liable to be deducted from employer's income. So employer is not paying any tax, then there won't be any deduction that he is claiming here. The next thing is in terms of salary received by a non-citizen, non-resident for services rendered in connection with employment on a foreign ship. So foreign ship, if there is somebody working in a foreign ship, then that is exempt under Section 10(6) Clause 7. Another thing, remuneration received by foreign government employee during their stay in India for specified training. If somebody is a foreign citizen who is coming into India for the purpose of specific training and if they are staying in India and if there is any money earned, that is exempt under Section 10(6) Clause 11. So these are specific things that are tax exempted in terms of the non-resident individuals earning salary in India from a foreign enterprise. Okay, then moving on to 10(6)(d, this is in terms of the royalty or fees for technical services received from National Technical Research Organization. Now there is, let's say, any corporate or a non-corporate, a foreign individual is coming here and giving some royalty or training or know-how or some kind of service is given to National Technical Research Organization, and National Technical Research Organization is paying the amount as royalty or fees for technical service. That is exempt as 10(6)(d). This is to promote the national interest or the research activities of the Indian activities. Okay. So income arising to non-corporate or non-resident and foreign companies by way of royalty from or fees from technical services in or outside India to the National Technical Research Organization is exempt under Section 10(6)(d). So this, are you clear till here? Not too complicated, right? Anybody feeling too complicated or not understanding or not relatable? Sir is telling no, nothing is understanding.
One question on that foreign earlier thing. Citizen of non-Indian citizens working for a foreign company, three conditions. The company should not be carrying out trading in 90 days. The third is that it should
the salary paid to such individual should not have been claimed as an expenditure in the computation, if any, in India.
Of employer only?
Of employer.
Because no employer, let's say head office subsidiary kind of like holding company subsidiary kind of setup. Some holding company's employee is being debited to India and the cost is cross-charged to subsidiary company. So in subsidiary companies, indirectly it will become a cost. But subsidiary company is not the employer. So am I still eligible?
So here that becomes very critical in terms of it is a kind of a structure. It becomes that very clearly they have told under the provisions of the Income Tax Act. If you see here, the remuneration is not liable to be deducted from employer's income chargeable to tax under the Act. Literally, when we see holding company is the employer. So when we read that way, it is not. They should be entitled to exemption. Okay, but in substance when we see, it looks like that benefit is claimed in India and the income is not taxed in India. So both way it is escaping. Okay, then we move to 1010BB, where long back when there was a tragedy, victim happened, Bhopal gas tragedy. Any compensation received from any person to the victims of the Bhopal gas tragedy was exempt under section 10BB. So any payment made to a person under Bhopal gas leak disaster, Processing of Claims Act, any scheme formed thereunder will be exempt. So this was specific to the Bhopal gas leak disaster that happened at that point in time. Later on, they felt that anytime there is any disaster, so this section will only cater to such tragedy or disaster that happened in Bhopal gas leak. If there is any other tragedy or if there is any natural calamity or disaster that happens, this section will not give the relief. Thereby, they came with a common section 1010BC telling that any compensation received on account of a disaster. So it can be any disaster. What is a disaster? Disaster is explained. Disaster means a catastrophe, a mishap, or a calamity, or a grave occurrence in any area arising naturally or man-made causes or by an accident or negligence. It should have the effect of causing the substantial loss of life or human suffering, or damage to the destruction of the property, or damage or degradation of the environment, then it is called as a natural calamity. Whether man-made or whether it is naturally that happened, there should be a grave kind of situation or a human suffering or a kind of impact that has destructed a lot of environment in terms of the ecosystem entirely disturbed. Then it is considered as a natural disaster. So this clause says that any compensation received by any government or any person from the occurrence of these kind of natural calamity, it is exempt under section 1010BC.
The train accident recently happened here, so that also will be exempted.
It will be exempted if there is substantial loss and correct. And recently, I think West Bengal, I think 5 people were there, something,
Orissa, when the train is going there.
That was around 2-3 months back. A couple of days back also, some government announced 2 lakhs per person, I think, because of the striking or lightning effect. So due to lightning thing, 5 people died in North Indian.
By wordings falling.
Correct. Because for that also they have announced 2 lakh rupees compensation from the state government. Okay. Then comes Sukanya Samruddhi scheme. Any proceeds that is coming from Sukanya Samruddhi scheme is exempt under section 1011A. So who can have this account? A parent who is having a girl child can have this account open. Is there any condition in terms of number of girl children that they can have, or this benefit is available only when a single girl child is there, or a parent who is having 2 girl children also can enjoy this exemption? Any restriction?
2 girls.
Maximum 2 girls. Okay. So we'll see that. Section 1011A provides that any payment from an account opened in accordance with Sukanya Samruddhi Account Rules 2014 made under Government Savings Scheme shall not be included in the total income. Hence, therefore, the interest accumulated on the contribution made to SSA account is also exempt under section 1011A. So it is limited to 2 girl childs as per the Sukanya Samruddhi rules account here. The rules 2014 you have to refer. Then comes the scholarship in terms of section 10 subsection 16. Any scholarship received or which is granted to meet the educational expenditure is exempt under section 10 subsection 16. Now, is stipend exempt under section 10 subsection 16 for CA students or CA article students who are performing training under chartered accountants?
No.
Okay. Is medical field also they give stipends to doctors when they get trained initially. So, but their stipends are good rather than compared to our stipends. It will be 50,000, 60,000. Okay. Is that exempt?
No.
Huh? So there if you literally read this section 1016, it is not exempt because it should be educational scholarship, but that is based on performance of an activity or a personal capacity. They are rendering some service, then you are earning that money. Either it is CA articleship or doctor stipend. It is based on the effort that is contributed to a particular task or an activity. But few courts have held that the stipend should be exempt if it is given in accordance with the regulations of that authority. Now the Medical Research Organization or the ICRA or all these things, Indian Council Medical Act, all of this give this prescribed stipends. If it is in accordance with those regulations, they say it is exempt. So there is a thin line of difference, but Act says only scholarships. But
and another thing is, in case of stipend, there is the relationship is not employer and employee.
for any exemption for that matter, there is no requirement of employer-employee relationship. The context here is in terms of whether the money given is in the form of scholarship or meeting the educational requirements. The stipend is given, I don't know for what purpose it is given, but it is given. Okay, whether it is to meet the education, there is no directly that we can relate that it is given for the purpose of education. And we cannot also directly tell for the work done we are giving that money because it is not commensurate. Okay, so it is just an aid that is given. It cannot take the characteristic of scholarship, or it cannot take the scholarship of the stipend. So it is like of a financial help or the kind of a small monetary benefit that is given.
So is it
Education
taxable
means,
or
regular course or certificate or any specifications there for education?
That's what it should be prescribed in the curriculum, that the course should be modified and then it should be in terms of that. Like let's say the Ministry of Human Resources, MHRD, Ministry of Human Resources and Development, give the scholarship for 10th and 12th or kind of who are pursuing the graduation. So there is a scheme that is floated which says that if you have scored more than 80% in 12th and you get a scholarship for first year, and the 10,000 or 20,000, I don't know, right? 10,000 per year, and then you will have to submit the first year of your degree thing that you have attended 80% of the attendance and you got 60% of the marks and all of that. Then you get scholarship for the next year. So like that you get for 3 years. So all of that are considered as scholarship and it is exempt under section 10 of section 16. More so likely, students who are getting scholarship will not be more than 5 lakhs or 7 lakhs, so it does not make much difference. Unlikely where we are discussing the point of judgmental view, where they said that the scholarship or the stipend received by medical students are exempt by a court ruling, where the amount is more than 50,000 or 60,000 in a month. So that is the only difference that it makes. Payments to MPs and MLAs, section 10 subsection 17 says it is exempt. So our political friends who are getting any money in terms of MPs and MLAs, that is exempt under section 1017. What is exempt? Entire amount? Whatever they get, it is exempt? Yes? So that is the kind of reference that we draw, but they say only allowance is exempt. If there is any salary paid, that is not exempt. Only daily allowances received by any member of parliament or any state legislature or any committee will be exempt. Or constituency allowance. So if there is they are taking care of any constituency and they give some allowance for maintaining that constituency, that allowance is exempt. Apart from that, any other money that they receive, it does not fall under exemption under section 10 subsection 17. Thereby they root every amount under this heading and not any other heading. Okay. So this comes majorly they receive only daily allowance. There is no employer-employee relationship for them to get any salary. The Lok Sabha or the Rajya Sabha do not pay any salary because Lok Sabha is not the employer, Rajya Sabha is not the employer, and the representative member is not an employee. It is out of social service kind of thing that they want to represent and do it.
What about the bribe?
That is on records.
Bribe.
If it is proven, then it is taxable. Because illegal income is also taxable under the Income Tax Act.
Right, so they will not disclose, so automatically it will be undisclosed, so automatically it will be 60% plus.
Thereby, if it is noticed, then section 68, 69, all of that will come into picture. 78% will become taxable, and in some cases it can go up to 100 plus percent also.
So in which head they do they disclose, sir? Whatever money they get, MPs and MLAs?
Other sources, income from other source. If it is not falling under daily allowance and constituency allowance, any other amount that the MPs and MLAs get that does not get characterized under salary, thereby it does not get taxed under income from salary, it goes to the income from other source.
Sir, they will receive pensions after
It's
that
taxed.
will be taxed under salaries.
Income from other source. So then comes awards for literary, scientific and artistic works and other awards by government So these kind of defense people or military people or any kind of government services where they have done any service, and if they get recognition by way of reward and award by central government or state government, if there is any monetary benefit that comes through, that will enjoy an exemption under section 1070A. Anything, it can be central government recognition or state government recognition, that will be exempt under section 1070A. Then comes 1018, pension received by recipient of gallantry awards. So pension, we said it is taxable, correct? Commuted pension, government employees fully exempt. Uncommuted pension, government employees fully taxable. But if they are government employees and recipient of gallantry awards, uncommuted pension also will become exempt under section 1018. So any income by way of pension received by an individual is exempt from tax if such individual was an employee of central or state government, has been awarded as Paramvir Chakra or Mahavir Chakra or Veer Chakra or such other gallantry awards notified by central government in this behalf, will be exempt under section 1018. In case of death of such individual, any income by way of family pension received by a member of the family is also exempt under this clause. Family in relation to an individual means the spouse and children of the individual, the parents, brothers and sisters of the individual, or any of them wholly or mainly dependent on this individual. So this is in terms of gallantry award. They said uncommuted pension received by government employee is fully taxable. But if they are recipient of these gallantry awards, uncommuted pension also will become exempt under section 1080. Okay? And let's say a person died in the war field and he is awarded some award. Let's say he is given Paramvir Chakra. Once he is given Paramvir Chakra, the family member will, the person is not there, the person has died. The pension is received by the family member. Once the family member starts receiving this pension on behalf of the gallantry award winner, in the hands of family member also, that pension is exempted under section 10 subsection 18. Then move to 1026 scheduled tribe. I think more likely a member of a scheduled tribe residing in the area of certain specified districts, any income earned is exempt provided they have income arising from that particular state. Okay. That is income from any source in the areas of the state aforesaid by way of dividend or interest on securities is exempt. So this is specifically for specific states, not for the entire country. Sikkim is individual, again it is in the state of Sikkim, and the income from interest on securities is taxable only if it is after 1st April 2018, but before that it is not taxable. However, this exemption will not be available to a Sikkimese woman who on or after 1st April 2008 marries a non-Sikkimese individual. So otherwise, every person of Sikkim will enjoy this exemption under section 1026 AA. Then moving to tea board subsidy, this is exempt under section 10 subsection 30. There are certain conditions that they should use this for rejuvenation of the cultivation of tea plants and all of that, and they should maintain an account for where the subsidy is being used, and if they meet all those conditions, then they get this exemption under section 1030. Similarly, tea board subsidy, they gave the other commodity subsidies also in terms of rubber board, coffee board or commodities board, all of that came under. First they gave specific to tea board under section 1030, then they made generic subsidy section 1031. So the subsidies have been received from the specific board, that is rubber board or coffee board or spices board or any other board in respect of other commodity. Assessee should furnish a certificate from the board as to the amount of subsidy received by him to the assessing officer along with the return. And he should use it specifically in India for the purpose of that particular commodity, rubber or coffee or tea. So these were the important sections. So we have completed the majority of the sections. There are few more sections. We do not have time to cover those sections, and those are all small aspects of section. I stop here. If we have any questions, we'll take for a couple of minutes. And it's already time. If you want me to continue 10AA, we'll continue. Otherwise, any other presentation will come through. You can go through it.
In terms of education, scholarship for education, cost of education, if it is notified, say for example, if it is notified to the government, some course, and if my employer uses scholarship for employee, then it is exempted.
Correct, that is
exempt.
That's why if, say for example, a person who is giving scholarship to pursue MBA or any other course or higher education course by employer, it becomes education scholarship. Any other questions? So we'll have this presentation circulated. The 10AA part is simple. Quickly run through. Any individual or any business who is set up in a special economic zone will enjoy a 15-year period of tax holiday period. For the first 5 years, 100% of the business profits is exempted or tax-free. And for the next 5 years, 50% of the income is tax-free. And for the last 5 years, 50% of the amount or an amount equivalent to that transfer to the special economic zone reserve fund account is exempt. This is the overall broad view of what the exemption is all about. Second thing is the quantum of exemption is purely available for export sales or exports. Any domestic sales that are there, proportionate exemption is only available. Out of my turnover of 100%, if I made 90% exports and 10% of domestic sales, then the exemption is not 100%. 90% of my profit is exempt, 10% of my profit is taxable. Okay, so this is the broader perspective. What happens to the special reserve that I transfer in the last 5 years? That reserve should be utilized for the purpose of reinvesting on the plant and machinery in the special economic zone. If it is not spent, then the exemption is withdrawn. Okay, and the activity should be completely within the special economic zone, and it should be out of the new plant and machinery setup. It cannot be old plant and machinery, and the business should not be split of the existing business. It should be of a new business, and it should be specific unit can claim SEZ unit and a non-SEZ unit. There is no requirement that I should float a new entity for that matter, but of an existing entity in a non-SEZ area, setting up an SEZ unit in an SEZ area is permitted to enjoy the SEZ exemption under section 10AA under the SEZ provisions. All of that is more detailedly explained. What is SEZ, what is the business that are permitted, who is an eligible assessee, what is the mechanism in which the computation is made. You can run through that.
So what if the employees are working from home?
Okay, so what is the question?
If outside the SEZ?
That I think they have given the SEZ rules have given permission to work from home allowed for 1 more year. I think till 31st March 2024 or 23 it is allowed. But after that, if the exemption still continues or not, we have to wait for it. From the pandemic period, they have allowed a certain relaxation. If they are working outside, it is allowed. Startup exemption gets covered under Chapter 6 as an 80 IAC. It does not come, it comes as a deduction and it is not an exemption.
This is I heard something time 31st March 2024, whether it is there or not?
31st March 2024, correct. Any business set up on or before, from that period, 15 years.
Okay. If I set up now, I will not get.
No. Any other questions? So thank you all for patient listening, and thanks Bangalore branch for providing me this opportunity to present my vision.
Welcome back to the next session on reinvent income tax. For next session, we have Bharadwaj Sheshadri. May I request Shivraj to welcome the speaker onto the dais and welcome him with a floral bouquet. Bharadwaj Sheshadri is a qualified chartered accountant. He has a bachelor degree in commerce and law. He practiced as a chartered accountant between 2015 to 2018. He enrolled as an advocate in April 2019. and has been practicing advocacy since then. He began appearing before the Commissioner of Income Tax at the age of 21 and before Income Tax Appellate Tribunal at 23. He presently practices before those authorities and tribunals: the Appellate Authority under the Indirect Tax, the SESTAT and the High Court of Karnataka, and has briefed eminent senior counsel. He has reported orders of the High Court of the Karnataka and the Income Tax Appellate Tribunal to his credit. His area of practice extends to drafting as well as consultancy in the matter related to commercial contracts such as the income tax law, the service tax laws, the GST, company law, FEMA, etc. He has a keen interest in writing and speaking and has multiple published technical and non-technical articles to his credit. He is an assistant editor for the Company Law Institute of India Private Limited and authors endnotes for their journals of Income Tax, GST and Companies Act. He has co-authored the third edition of the book Trust by C.R. Rao, published by Messrs. Pulani and Pulani. He has been a judge for various moot court competitions. Outside the profession, he has deep interest in Carnatic music and is generally curious about Indic field of knowledge. With this brief introduction, I present to you Bharadwaj Sheshadri. Over to you.
Namaskara. My thanks to the Bengaluru branch for having invited me to speak today. My thanks in particular to Mr. Kota Srinivas for having given me this opportunity. He has kept me quite busy. Yesterday he took me to Chikmagalur to speak for the Udupi branch, and now he has me here speaking today. I will not admit to being tired, but I am a little tired. I also will not be surprised if all of you are a little tired, considering that you have just come after lunch. Having said that, the subject of charitable trust you need to be a little crazy to enjoy it. If you enjoy it, there is much to be enjoyed. On the other hand, if you don't, it can be quite drab. When he invited me to speak, I was given very strict instructions that I must not go into things in great depth. In fact, he went so far as to say that I should not refer to too much case law. This is all much against my instinct, but I will do my best to restrain myself and to honor his request. Feel free to intervene at any time with questions or also correct me if I am wrong. This income tax law and charitable trusts is a little problematic because the foundational first principles that you need to be conversant with to understand the law are neither clearly in the accounting realm nor in the taxation realm. It is not like the computation of income under the head business or profession, for example, where you begin with the profit as per the profit and loss account and make adjustments for all the allowances and disallowances that the Act contemplates. That is ordinarily how you compute taxable income under any head. On the other hand, it is not like accountancy either, where it is only commercial principles that dictate what goes to determine your profit or loss. It is somewhere in the middle. To give you an example, there is a long line of decisions, including of the Supreme Court, holding that the word income for the purposes of Section 11 is not the same as total income for the purpose of the other provision of the Act, and that it is not the same as total income as defined in section 2. Having held so, the courts have gone on to hold therefore that income under section 11 is to be computed as per commercial principles. The law has gone so far down this path to hold in Jaslok Hospital's case an unreported order of the Mumbai Tribunal that even provision for doubtful debts can be claimed as a deduction in computing income under section 11. This is of course now subject to various other caveats which we'll go through in the course of today's seminar. Similarly, the computation of income under sections 11 and 12 does not particularly respect the difference between capital and revenue items. This also we will see a little later, but to give you one example, until subsection 6 of section 11 was inserted, you could claim both the capital expenditure as application and also the depreciation on the asset, on the same asset of which you claim the capital expenditure. So the distinction between capital and revenue is also sort of blurred. So any mature understanding of the law on this subject can only begin if you clean the slate as to your instincts, both in terms of accounting instincts and income tax instincts. With that review, let me begin. There are about 10 sections in the Income Tax Act which deal with the subject of charitable trusts. Section 11 is the foundational section which confers the exemption. Section 12 deals with particular kinds of incomes or receipts, for example, voluntary contributions and certain non-cash or non-monetary incomes. Section 12A, this sets out the conditions subject to which you are allowed exemption. That is, if you do not satisfy the conditions in section 12A, you will not be entitled to exemption. Section 12AB deals with the procedure for registration. Registration itself being a condition under section 12A. Section 13 deals with the cases in which you will lose exemption. These are the five or six principal provisions. Besides this, there are certain special subsequent provisions such as 115 BBC dealing with anonymous donations and 115 TD, TE and TF which deal with the subject of accreted income. Finally, subsection 15 of section 2 which defines the term charitable purpose. It therefore makes sense to begin by reading section 11 subsection 1 clause A and consequently the definition of the term charitable purpose. Section 11 reads, income derived from property held under trust wholly for charitable or religious purposes to the extent to which such purposes are applied, such income is applied to such purposes in India. These are words which are absolutely pregnant with meaning. There is not a single word in this sentence, in this passage, that has not been the subject of considerable judicial interpretation. I have already dealt with the word income to say that it is not the same as total income and so on. Property, the Supreme Court considered what is property in P. Krishna Warrior 56 ITR, in which the Supreme Court said that the term property is so wide that it will include even businesses held under trust. Therefore, the term property is of the widest import. Under trust, the phrase under trust, oddly enough, finds a definition and an explanation below section 13. And there trust has been defined to include a legal obligation. Let us take the instance of a mutt, for example. Under the Hindu law, a charitable or a religious endowment is established by two processes. The first is sankalpa and the second is utsarga. If you perform these two processes and set apart some property or dedicate some property for certain purposes, in the Hindu personal law, an endowment is thereby created. Now, had explanation to section 13 not defined trust to include a legal obligation, Hindu obligations or endowments settled through the Hindu personal law would not have come within the scope of these provisions. It is to facilitate this that definition exists. Therefore, the term trust is not to be understood as only meaning English trusts, but also any other obligation, any other property to which there is a fiduciary obligation of some kind attached. Wholly for charitable or religious purposes. The term religious purpose is not defined in the Act. that is to be determined as per the principles of the relevant religion. Therefore, if the trust or institution in question is a waqf, then you will appreciate the Sharia law governing waqfs to determine whether it is a religious purpose or not. And if similarly in the case of Hindu law, I already dealt with that example. Charitable purpose, on the other hand, is defined in the Act, and there has been considerable dispute on that definition, including two very important recent decisions of the Supreme Court in Ahmedabad Urban Development Authority 449 ITR 1 and New Noble Educational Society 448 ITR. So this is clause A of subsection 1 of section 11. Clause A, most importantly, states that it must be held under trust wholly for charitable or religious purposes. Clause B deals with cases where a property is held under trust only in part for charitable or religious purposes. I will not go into that because there are very few instances of that today, and the law on that is again quite complicated. Clause C deals with certain specified charitable purposes that are prosecuted outside India. You will note that clause A says that the purposes must be prosecuted in India. Clause C deals with cases outside India. That requires the approval of the board. So once again, you will not see too many cases of that. I won't deal with it. Clause D is particularly significant. Clause D says deals with voluntary contributions with a specific direction that they shall form a part of the corpus of the trust of the institution. If I make a donation of 100 rupees to a trust today, most of you will be aware that the gross receipts of a trust or the income of a trust, there is a distinction between these two terms I will come to later, but 85% of the income of the trust is to be applied to charitable purposes. But that requirement for application applies only to clause A of subsection 1 of section 11. It does not apply to corpus donations falling within clause C. This is why it is relevant to know how a donation is constituted to be a corpus donation. We use the term corpus donation colloquially, but clause D states, the language of clause D is voluntary contributions with a specific direction that they shall form a part of the corpus of the trust. So first, the contribution must be voluntary, and secondly, the contributor must direct that it is attributable to the corpus. A simple letter or any written communication would suffice. There is nothing in the law to suggest that even an oral instruction is not sufficient, but it is hard to evidence in the course of proceedings. The written communication is better. Various recent amendments have been brought about which will affect the position of corpus donation, but I'll be dealing with that at a later stage. Now we come back to the foundational question of what is a charitable purpose. Subsection 15 of section 2 is on your screen. Let us read that. Charitable purpose includes, therefore the definition is inclusive, it is not exhaustive. There is a logical fallacy here in the statute, but again we will ignore that. Relief of the poor, education, yoga, medical relief, preservation of the environment including watersheds and wildlife, forests and wildlife, and preservation of monuments or places or objects of artistic or historic interest. There are 6 limbs which I have read, and then there is the 7th limb, the advancement of any other object of general public utility. These first 6 limbs, colloquially we have been referring to them as the main limbs, and the last limb we have been calling the residuary limb. The Supreme Court in Ahmedabad Urban Development Authority has called the first 6 limbs as being per se charity and the last limb being GPU charity, GPU standing for general public utility. The importance of the distinction between the main limb and the residuary limb is to be seen from reading the proviso. Provided that the advancement of any other object of general public utility shall not be a charitable purpose if it involves, so it says it shall not be a charitable purpose, so the proviso is creating an exception to the general rule. If it involves the carrying on of any activity in the nature of trade, commerce or business, or any service in relation to such trade, commerce or business for a cess or fee or any other consideration, irrespective of the nature of use or application or retention of such cess fee or other consideration. Let us stop there. The ingredients for the proviso to apply can thus be summarized as follows. First, you have to fall under the residuary limit. If you fall under the main limit, it will not apply. Second, there has to be some activity in the nature of trade, commerce or business or service in relation thereto. Third, that activity must be for a consideration, cess or fee. And fourth, it is not relevant how that consideration is ultimately applied. The Supreme Court in Tandi Trust's case was dealing with a case where the trust was carrying on the activity of running a newspaper, that is the Tamil daily Dinatandi, and the terms of the trust were such that the profits generated out of such activity were to be applied exclusively for the purposes of education, for funding an educational institution. The question before the Supreme Court was that the trust was carrying out commercial activity in substance. It is just that the income or the profits ultimately were being utilized for charitable purposes. The Supreme Court held, in my view, with deep respect, correctly, that the relevant factor is the purpose for which the activities are being carried out and not the activities themselves. And since the profits are being applied for education, Tandi Trust must also be held to be prosecuting the purpose of education. The implication of this decision is that indirect charity, that is, if I am carrying out a business, the profits of which are appropriated to charitable purposes, would also constitute the prosecution of a charitable purpose. Similarly, if I am a charitable trust carrying on charitable activities myself, and I choose to donate or pass on some of my monies to another charitable trust, that too would be a charitable activity. There are some caveats to this which again we will come to later in dealing with the computation of the income of a charitable trust. Now, this view in Tandi Trust was expressed in the context of education, which you will appreciate is a main limb and does not fall within the residuary limb. The question now is whether the same logic will apply for the residuary limb. The answer is no, because of the last few words of the proviso, which says that irrespective of the nature of use or application or retention of the income, the advancement of any other object of general public utility will not be a charitable purpose. So you cannot carry out an activity whose object falls within the residuary limb, say that the profits therefrom are only being used for charitable purposes, and get away from the applicability of the proviso. By and large, therefore, if you fall within the residuary limb, it is very, very difficult for the proviso not to apply. And this conclusion that one charity feeding another or business feeding charity is not charitable in the context of a residuary limb charity has been upheld recently by the Supreme Court in Ahmedabad Urban Development Authority. Now, if we look at how when section 215 was originally enacted, it read, charitable purpose includes relief of the poor, education, medical relief, and the advancement of any other object of general public utility, not involving the carrying on of any activity for profit. In this context, there are three decisions of the Supreme Court, one in Sole Trustee Loka Shikshana Trust, the second in Indian Chamber of Commerce, both of which are not particularly relevant. The more relevant decision is the decision of the Constitution Bench in Surat Art Silk Cloth Manufacturers Association, I believe it is 127 ITR. My memory is not very good, so my citations may be wrong here and there, but all judgments are only one Google search away, so I suppose you will excuse me. The Supreme Court in Surat said that not involving the carrying on of any activity for profit, the words for profit the Supreme Court held means that what is the test? The test is whether there is a profit motive or not. So, if I am carrying on activities within the residuary limb, and as per Surat, if I do not have a profit motive, then I will continue to be charitable. It is this judgment that the legislature sought to overrule by inserting this proviso, although it was inserted in a few avatars before this, there have been subsequent amendments too. In the proviso, therefore, the words for profit or any suggestion concerning profit motive are completely absent. The words used are any activity in the nature of trade, commerce or business. Now our common understanding, including for example for the purpose of what income will be charged under section 28 as opposed to 56. Our common understanding of what constitutes business is that there must be profit motive. Our common understanding of what is commercial is the existence of profit motive. Therefore, when we see the words trade, commerce and business, our first instinct is to test whether there exists a profit motive or not. And if there does not exist a profit motive, we reach a conclusion that it is not trade, commerce or business. In fact, even after the proviso attained this form, various high courts and also various benches of the tribunal have been applying pretty much the same test. This, in my respectful submission, is an incorrect statement of the law, which has been corrected now by the Supreme Court in Auda's case. In Ahmedabad Urban Development Authority, the Supreme Court impliedly observed that when the legislature omitted the words for profit and instead inserted the words activities in the nature of trade, commerce or business, the intention of the legislature was to remove profit motive as a test to determine whether the proviso will apply. So therefore, today, if you want to find out whether the proviso applies, the test of profit motive is wholly irrelevant. The question then is, if you take profit motive out of trade, commerce or business, what remains? The Supreme Court in Auda has gone on to clarify that. Supreme Court has observed that trade, commerce or business means that there must be frequency, volume, continuity and regularity of activities. Therefore, if you carry out activities in a systematic manner and in a regular, frequent, continuous manner, even if the activities are not with a profit motive, they would constitute trade, commerce and or business within the meaning of the proviso. Now, there is hardly any trust which will not satisfy this requirement, because virtually any organized activity will constitute trade, commerce or business. Now, the Supreme Court in Auda, when you read the judgment, you can see how the judge was thinking. This much reasoning was laid out, and then the judge discovered that if you do this, trade, commerce and business will become so wide that it will become all encompassing and every trust will be carrying out trade, commerce or business. Then to correct this problem, the Supreme Court, when it was interpreting the term fees, cess or consideration, also dealt with trade, commerce or business again and said that ultimately to constitute trade, commerce or business, there must be a substantial markup. It actually said it negatively. It said that if there is no markup or if the markup is marginal, the activities cannot be said to be in the nature of trade, commerce or business. There is another bit of reasoning the Supreme Court used. The Supreme Court said that what is contemplated by the proviso is not trade, commerce or business, but activities in the nature of trade, commerce or business, and in the nature of X would be X plus something. That is the reasoning that the Supreme Court used to remove profit motive as an ingredient. Therefore, the test to determine today whether there exists trade, commerce or business is whether there is a marginal or no markup on the one hand, or there is anything else. If there is a marginal markup or if there is no markup, you can safely conclude that there is no trade, commerce or business, and vice versa. Your natural follow-up question ought to be, what is marginal? The Supreme Court has not gone ahead to clarify that, in my opinion wisely, because it is impossible to lay down one plimsoll line across all charitable purposes or activities to say that something is marginal and something is not marginal. The effect of all this is that the law has become a little more complicated. If both you and the assessing officer will admit that your margin is 10%, assessing officer will say that 10% is not marginal, you will say that 10% is marginal. The dispute will be resolved at the minimum at the tribunal. One member of the tribunal will think it fit to say that 15% is marginal, anything above 15% is not marginal. Then there will be 25 judgments following that order of the tribunal. One of that will go to the High Court and that will get disturbed. So there is no end to this. If any of you are familiar with transfer pricing and the application of the turnover filter in the software development services segment, this is precisely what is happening, whether you should apply the 1/10 to 10 times or the range basis. So this is the litigation that I foresee. In fact, we have dealt with cases where this question of whether my surplus was reasonable or not has already been, the assessing officer has already said that it is unreasonable and therefore denied exemption to a trust which is functioning under the main limbs. Which is quite ludicrous because where is the question of reasonableness of profits under the main limbs? And anyway. So this is what AUDA has held.
A question, sir.
Yes, sir. Yes, ma'am.
Wherein it is in the main limb, the charitable trust is in the main limb, and they are doing the commercial activities also. For example, they are self-help women group who are into education, main limb of educating the women group and getting their surveys, selling the articles manufactured in that work. Does it fall under the trade and business activity, or it is since it is in the prime limb, it will be ignored as charitable?
I would dispute the premise that that is under the main limb at all. Because I was going to deal with this later, but I'll deal with it now since you put the question. The question is what constitutes education? You tell me any given activity, I can give you case law for and against it saying that it is and is not education. There is a lot of judicial confusion also. There is Mr. S. Rajaratnam's book, Landmark Cases, one 3-volume book. In that Justice Krishna Iyer has written a foreword saying that in India there is case law which cancels each other out. And Mr. Narendra Jain's book on case law and transfer pricing, Mr. G. Sarangan, senior counsel, has written a foreword saying that India is the largest exporter of case law. But nevertheless, on this question of what is education, there is a lot of confusion. In one of the decisions which I refer to, Locus Shikshana Trust, Justice H.R. Khanna, in a separate opinion, in one opinion in that case, said that education must be interpreted only as scholastic education. That is, either you are in school, affiliated to a university, college, etc., or you are not education at all. Because Justice Khanna's reasoning at that time was, if you are walking on the street and somebody picks your pocket, you learn a lot about life from that experience, can that be considered education? So, this, of course, I must point out that Locus Shikshana Trust was overturned in subsequent decisions. But broadly, if I will not trouble you with all the case law, broadly the principles are this. There is no need for the institute to be affiliated to any board or university for it to constitute education. 1. 2. The most important test is whether there is control of the teacher over the taught. For this reason, private coaching classes do not constitute education. Because as a CA student, I voluntarily pay the fee and go and attend there. If I choose not to go tomorrow, I am not affected by that. There is no control of the teaching over the taught. In my view, this is the strongest test. Then, it is not only scholastic education that constitutes education, but it is very difficult to say that these things constitute education. You have to evaluate it on a case-to-case basis. Yes, one thing, one more tiny point. There is a judgment of the Bombay High Court in Hale Consultancy Services, Justice V.C. Dada. He was dealing with the question of what is capital and what is revenue. He said there are many tests to determine whether an item is properly attributable to capital or revenue, but most of those tests are faithful servants, but as masters they can be over-exacting. That is precisely the problem here. You cannot say this is the test, this test is passed, or the case passes the test or fails it, therefore it is education or not education. Fundamentally it is very subjective and abstract. In my view, I am familiar with the SHG kind of operations. Most often, it is very difficult for me to conclude that it is education. So it will fall under the residualism. And consequently, this could be in the nature of trade, commerce or business. I assume that the products are being sold to third parties or only within the groups?
Third parties or...
The SHGs produce and it is
sold. For example, even corporates get the products. For example, reusable sugarcane waste and all will be used for the paper manufacturing or dairy they make, which corporates they buy it as part of their social.
So each group is registered as a trust?
No, this is just one of the examples which I...
No, so this, it's very hard to
say.
So
it will come under the second...
Broadly, yes. Yes, ma'am.
So what about vocational training?
No, there is case law both ways. In my view, it is not education. That question has been considered. On the other hand, you need not be carrying out education to come within the limit of education, funnily enough. Tandi Trust is an example which I gave earlier. There are also a couple of Delhi Assam textbook association or something like that. Various charitable trusts which print and publish textbooks for schools, they have all been held to be the nature of education. Vocational training, most often it is not education. Since these questions are coming up, if you look at the extent of the compliance burden on charitable trusts registered under Section 12AB today, there are more situations in which we advise clients to simply set yourself up as a for-profit enterprise rather than claiming an exemption. There are some theoretical obstructions to that, but you should be able to deal with it properly. If you're earning a substantial surplus, then probably you aren't managing your affairs well enough, because the gross receipt ought to be applied anyway. What are you doing with the surplus? So most likely you will be earning not too much of a surplus, in which case simply pay tax thereon. If you're running a deficit, there is no difficulty. So considering the compliance burden and also the attitude of the department in assessments of trusts in the last 6-7 years, the justification for registration under 12AB is becoming less and less advised. Now we were considering AUDA. Now then AUDA goes on to record various findings concerning various specific classes of entities. The ICI was one of the parties to that case which has been dealt with. All that is a matter of detail which, as I said in the beginning, as per Mr. Kota Srinivas's instructions, I will not be going into. Now charitable purposes. Traditionally both in India and in England, charity and religion are virtually inseparable. Charity and religion are almost always the same thing. And there is quite some very interesting discourse on how Section 215 came to be what it is from, say, 1601 British Statute of Elizabeth and so many other things. We won't get into that. But so I have already discussed the subject of the main and residual events. I have already touched upon very briefly the evolution of Section 215 and the relevance of the profit motive and the decision of the Supreme Court in AUDA. What remains is the last point of this slide, which is the eleemosynary element. When Justice M.C. Chhabra wrote a judgment, the judgment is timeless until the law is amended. And very often, even once the law is amended, the judgment still sheds light on the law. One such judgment is Commissioner of Income Tax versus Breach Candy Swimming Bath Trust, 27 ITR 279. There, Justice Chhabra stated what was already well known in the British law and in India, that the eleemosynary element is not necessary to constitute charity. Eleemosynary element means giving something for nothing. To be charitable, it is not necessary that you give out free dole of any sort, or that you conduct whatever services you render for a discounted price or for no consideration at all. This is not a test of charity. The only test of charity is the absence of private gain. This is what Breach Candy has held, and our High Court recently in the sense 7 or 8 years ago in CMR Jnanadhara Trust's case has also followed Breach Candy. So this is very important, because some of us have the misconception that if you are doing something, only if you are doing something for a subsidized rate is it charity. This is a misconception which we must be disabused of. Now, education I have already dealt with. Relief of the poor. This is the first main limit. The only important point to understand here is that there is no plimsoll line to say that these people are poor and these people are not poor. Under the Income Tax Act, there is no need, in order to establish that you are doing charitable activities exclusively for the poor, you do not need to establish that all of them have BPL cards, for example. Now, I do not recollect immediately if there is case law to this effect, but this appears to be the proposition in law. At the same time, you must be able to evidence somehow that there is the people you are serving are not well to do otherwise. I know the example of one charitable trust which operates in various states, which again operates on the basis of the SHG model, in which each member of the SHG is classified into 3 economic classes: subsistence, sustenance, and something else, S1, S2, and S3. And once they graduate from level to level as they are relieved of poverty, and once they climb out of the last stage, the charitable trust no longer does work for their benefit. So we must also remember that the test for whether you are entitled to exemption is not the nature of your income but the application of your income. So if you are tomorrow in an assessment proceeding asked to demonstrate that you are charitable, you should be able to show how you applied your income and where. And if you claim to fall under relief of the poor, there must be substantial evidence to demonstrate that your beneficiaries broadly are poor. So this is one important dimension. Next, you see campaign organizations, research organizations, etc. If you look at activities like preservation of the environment, that these objects are typically prosecuted by activist-minded organizations. And many of these activist-minded organizations' primary operations is not, for example, planting trees, but say raising awareness on environmental issues. The question therefore is whether preservation of the environment would or education or relief of the poor would extend to activism, campaign organizations, raising awareness and activities like that. Broadly, the answer is yes. There are instances where exemption has been granted to according to such organizations. The last aspect is the funding of charity, which I have already discussed, which is indirect charity. The question is whether if one charitable trust funds another charitable trust, can the first mentioned trust be held to be charitable? The answer is yes. This was originally clarified by the board in a circular in 1978, where the board said that donations in favor of another charitable trust would constitute application of income for charitable purposes. There are also decisions of various high courts and the tribunal supporting this proposition. Importantly, there are now a lot of NGOs which carry out, which are funding NGOs. They are fundraising NGOs, they are intermediaries. So there is a website, I want to make a donation, and the charitable trust which is in need of donations does not have access to the donation market. So the charitable trust empanels itself on this website. I make a donation through the payment gateway to the website. The NGO running the website takes this donation from me, issues an ETG receipt to me and passes on the donation to another trust. All this is charitable. And very significantly, there is a decision, there are two decisions there is one decision of the Delhi High Court and a couple of decisions of the tribunal. The Delhi High Court in Hamdard Laboratories has held not just that this would be charitable, but also that the donor organization's classification would be based on the recipient organization's classification. Therefore, if the recipient organization was carrying out education and the donor organization donates to the recipient, the donor would also be held to be in the nature of education. I agree with this reasoning of the Delhi High Court, but this has various practical limitations, particularly if you are a funding organization. Because you may be donating one sum to education, one sum to medical relief. Therefore, you must be able to have sufficiently sound systems to demonstrate that none of those other NGOs are under the residuary limit, so as to protect yourself too. There are practical limitations here. There is also in this context an amendment with effect from assessment year 24-25, which stipulates that where I donate 100 rupees to another charitable organization as a charitable organization, only 85 rupees thereof will be treated as application in my hands. This provision is simple enough to understand when you read the law. However, the CBDT has chosen to issue a circular clarifying this position. As you are all aware, when the CBDT issues circulars, some of them serve the purpose, but they are mostly the exception. Most circulars of the CBDT perform two functions. One is they state the obvious of which none of us had a doubt, and the second is they clarify something which only expands the scope of the confusion and does not actually clarify. Let us find out what has been achieved with this circular. I meant to deal with this a little later, but since the subject came up in the flow of things, I deal with it right now. The first 3 paragraphs are completely irrelevant. Let us read paragraph 4. So, let me repeat. The section 11 now provides that if a trust registered under section 12AB makes a contribution or donation to another trust so registered, only 85% thereof will be treated as application. The matter has been examined with reference to the issues raised in paragraph 3, and it is reiterated. See, when the statute says something, why would you reiterate it in the circular? You must trust the words of the legislature. If you reiterate it here, and there is one grammatical mistake in the circular, it can have disastrous consequences. Anyway, it is reiterated that eligible donations made by a trust or institution to another trust or institution under any of the 2 regimes, the 2 regimes is 1023C and 12AB, referred to in para 2, shall be treated as application for charitable or religious purposes only to the extent of 85% of such donations. So in this sentence, objective number 1 has achieved, which is stating the obvious. It means that when a trust or institution in either regime donates 100 to another trust or institution in either regime, it will be considered to have applied rupees 85 for the purpose of charitable or religious activity. So again, it is an even more eloquent statement of the obvious. But let me tell you how, if you really look at it under a magnifying glass, it will be considered to have applied 85 rupees for the purpose of charitable or religious activity. Which section of the Act says my activity should be charitable or religious? Let us not confuse ourselves. We need not be confused, the board can be confused. It is clarified, this is the clarification. It is clarified that 15% of such donations by the donor, trust or institution shall not be required to be invested in specified modes under section 11(5) of the Act. Let us stop at that point. This is now most of you will be aware that a charitable trust is permitted. Microsoft has very interesting ways of working. I was very afraid that would be Windows update, then the entire thing, I don't know how many of you have faced that difficulty. So, charitable trusts are required to invest their monies in the mode specified in section 11(5). The clarification in this sentence is saying that if you have donated 100 rupees and only 85 rupees is treated as application, you are not required to invest that 15 rupees in 11(5). If I don't have it, how can I invest it? Who asked for this clarification? Now, let us go further. Shall not be required to be invested in specified modes under section 11(5) of the Act, as the entire amount of rupees 100 has been donated to the other trust or institution. Obvious. Now here they have ruined things. And is accordingly eligible for exemption under the first or second regime. What is he saying? He is saying that the 15% need not be invested in the modes. Accordingly, it is entitled for exemption. What is the Act saying? Only 85% will be treated as application. Now, what is entitled to exemption? Only something can be exempt only when it is chargeable to tax. Is my expenditure exempt or is my income exempt? So at what level is the conceptual difficulty of the man who drafted this circular? Now, let us read the circular literally. 15% is not required to be invested in the mode specified in 11(5) and it is accordingly eligible to exemption. He has completely reversed the effect of the statutory amendment. If it is entitled to exemption, then why was the amendment made? Now, since we are now very worried after reading this paragraph, we will see the illustrations clarify anything. I can give you a spoiler and tell you that you can be rest assured they do not clarify anything. I have created illustrations of my own to presumably arrive at the correct position. I mean, this illustration, I cannot imagine that somebody came up with these illustrations in all seriousness. It is quite comical. There are 3 illustrations, we will go one by one. Let us start with trust number 3. 100 rupees is the gross receipts. Therefore, 85 rupees is required to be applied, no difficulty. 100 rupees is donated to another charitable trust. Therefore, 85 rupees of that is treated as application. Therefore, the whole of the income is exempt. Would anybody have had a doubt about this? Answer is no. Trust number, that is trust number 2. Trust number 2, I apologize. Trust number 3 is an even more ludicrous example where there is no application in favor of another charitable trust at all. 100 rupees is the income, 85 rupees is required to be applied. Serial number 7, application other than in favor of a trust is 85 rupees, therefore it required to apply 15. This has been the law since 1961, except that 15% will be 25%. So trust 3 has nothing to do with the question at hand, not relevant. Trust 2, I have already dealt with, I made a mistake. But trust 2 is very clear. All my income of 100 rupees has been applied, 85% will be treated as application. I am entitled to accumulate 15% under 11.1, no difficult. So we must hope that trust 1 gives us some clarification of views. 300 rupees. Now, this is the trust 1 is the example which is actually the most relevant, even though it also does not clarify anything. They could have used 100 rupees in all three. 300 rupees is the income. Out of that, 85% is to be applied, which is 255. 100 rupees is donated in favor of another trust, which means 85 rupees is treated as application. 255 minus 85, 170 is the balance which is to be applied. We would have hoped that something less than 170 was applied, but no, 170 has been applied in the normal course. So our application requirement is satisfied. No question is answered in this illustration also. So we have concluded that the circular does not substantially add to our knowledge. Let us see what we can do with the circular. Gross, I must begin by saying that I use 300 because the circular used 300, otherwise I would like to use round figures multiples of 10. So please don't hold that against me. We can look at only one of these two illustrations. We'll start with 300, 85% of that is 255, normal application is 170, application in favor of a trust is 80, application allowed is 85% of 80, which is 68. The total application is 170 plus 68, which is 238. But 255 ought to have been applied. Therefore, there is a shortfall of 17 rupees. Now, how much have I actually received? 300. How much have I actually applied? 170 plus 80, 250. Which means I have 50 rupees of cash in my hand. 15% accumulation under 11(1)(a) of 300 will be 45 rupees. Which means out of the 50 rupees of cash in my hand, accumulation to the extent of 15% is covered to the extent of 45 rupees. I have only 5 rupees left. Which means out of 17 I am able to accumulate only 5. 12 would be taxable. This is my understanding of the statute. What is the circular saying? This 17 need not, this 12 need not be held in the mode specified in 11.5. Therefore, it is entitled to exemption. So, if you apply the circular, this 12 would also be entitled to exemption. It is my function in sessions like this to clarify things and presumably enlighten you on the courageous presumption that you are not already enlightened as to the law. But I am a servant of the law. This is what the law says, so I leave it to you to understand what the import of the provision is. So this addresses that last point of funding charity. There is some typographical error in the heading. Anyway, no, there is no typographical error. There is some. Grant of exemption, basic principles. So we have already discussed the concepts of income, property, trust, and wholly for charitable or religious purposes, what is income and how income is computed. On how income is computed, I wish to deal with it in just a little more detail. I have already referred to the decision of the Supreme Court in Breach Candy Swimming Bath Trust. There is also a decision of the Madras High Court in Rao Bahadur Kannan Chetty Charities. I have forgotten the citation. It is a judgment of Justice Setu Raman, who was earlier a member of the tribunal. I think it must be in the late 70s or early 80s. That is a beautiful judgment to read if you are a student of the income tax law and want to understand how to compute the income of a charitable trust. Because first the judgment explains it in prose, and then it actually sets out illustrative computations of how it is to be done. And there is absolutely no error in that judgment. One does not expect that. And the only difference is there have been some amendments in the statute since then. To that extent, the judgment may not be of assistance. But overall, to understand the structure of the provisions, it is a good idea to read the judgment. One of the amendments, for example, is what we know now as 15% and 85%. Earlier used to be 25% and 75%. So that is recommended reading. Rao Bahadur, Kandan Chetty Charities. Now, this is broadly the mode of computation. This term gross receipts is not actually used anywhere in the statute, but you will find it appearing in the income tax return form. It is also a term that we have been using and the courts have also been using to deal with this computation. One of the most fundamental questions that was repeatedly arising is whether this 15% accumulation would, or the 85% application would be computed on gross receipts or income. So what is the difference between gross receipts or income? There are various stages in the computation of the income of a charitable trust. When you are computing the income of a charitable trust, you are not in fact computing the income, you are quantifying the exemption. There is 100 rupees which I receive as donations. I have incurred administrative costs to collect those donations. Those administrative costs are therefore expenditure incurred for earning income, which is a phrase we are all familiar with both in section 57, section 29, etc. In any computation of income for tax purposes, you will deduct expenditure. Income is net income, that is all fundamental principles. Once you arrive at this income, you have to apply this income to charitable purposes. This application is what we would call a below the line item. It is appropriation of the income, it is not. So if I was talking in commercial principles, it is an appropriation of profits and not a charge on profits. Now, the question is whether you will compute this 15% accumulation or the 85% application on the gross receipts or the income after deducting the expenses incurred on earning the income. Now, this gross net issue has arisen in a number of cases. There was a period of time, I think from assessment years 11, 12 to 14, 15, in many cases this was picked up. And the assessees ultimately succeeded in saying that 85% must be on the net income. So there is a problem here. There is a judgment of the Supreme Court in Program for Community Organization which answers this question. I do not want to comment on exactly what it says. It's only a 3-paragraph judgment. I would request you to kindly read the judgment. Everybody has been following that judgment to say that the 15% 85% should be computed on net income, but that is not exactly what the judgment says. There is some confusion. But this issue exists. However, these days the assessing officer is not, at least in the last 5 or 6 assessment years, I have not seen this issue being picked up. So, gross receipts, expenditure on earning income, then 15% accumulation, then disallowances. In view of certain recent amendments to section 11, 2 disallowances which govern the computation of profits and gains of business and profession, namely disallowances for under section 40A3 and 40A1A for non-deduction of tax at source and for payments otherwise than by account paid. Yes, sir.
So the 85% definitely it should be on the gross receipts. Why? Because if you take net income, the capital expenditure will not be taken. Actually, capital expenditure is also included in that 85%. Or no?
Okay, so I have understood your point.
Yeah.
There are 3, 4. Yes, sir.
No. Basing on that only the 85% because the capital expenditure, how can we treat it as net? For net income, we cannot carry it as a capital expenditure.
So, Program for Community Organization said exactly what you are saying, Supreme Court. They did not refer to this capital expenditure reasoning. That reasoning is incorrect, as I will point out just now. The problem is, the words used in section 11(1)(a), are income to the extent it is applied to charitable purposes of India to the extent of 85%. Madras High Court, in my view, correctly has held that income is income after deducting expenditure on earning income. And in the illustration in Condensity Charities case, 25% at that time, which is now 15%, was computed on income and not on gross receipts. In my view, that is correct. But the Supreme Court has held that gross receipts are, you have to compute it on gross receipts. But even that, the Supreme Court has not held very clearly. Department has been agreeing with the assessee's view now on the basis of program for community organization. On your specific point on capital expenditure, you are right in saying that capital expenditure would constitute a part of the application, but now subject to 11(6), either you claim depreciation or capital expenditure. So subject to that one write-off. But irrespective of whether you compute it on gross receipts or on net income, you will be treating capital expenditure as application, assuming you are not claiming depreciation. Then from an assessee standpoint, presumably you stand to benefit if you compute it on net income, because then the 85% is met at a lower level. Conversely, if the 15% is also computed on a lower level, so there is no, what benefits the assessee and what goes against the assessee here is not very clear. But everybody is now computing on gross receipts, as you have pointed out.
So the net income, what will be 85% again you have to net income?
Right. So, sorry sir, I have now understood your confusion as to what is net income. Is net income what you arrive at as the surplus in the income and expenditure account? Theoretically, there is a huge gulf between theory and practice. Theoretically, you have to consider all your outgoings and separate what is expenditure for earning income with what is application for charitable purposes. So, in an educational institution, the salaries you pay to teachers would be application for charitable purposes, but the salary you pay, for example, to a chief executive officer for administering the organization may be expenditure for earning income and not application for charitable purposes. This is the level of theoretical complication which the Madras High Court has appreciated. But neither the departments nor the assessee look at things in this depth. So, today, in practice, there is no distinction between expenditure on earning income and application. And probably practically it is safer to proceed on that basis. So, as I said, have I satisfied your question? So, as I said, now two disallowances which are applicable in computing business income, that is 48.3 and 48.1a, are now applicable to charitable trusts too. Until assessment year 2021-22, there were various orders of the various judgments of high courts and orders of the tribunal holding that where you had excess application in earlier years, that is where your application exceeded your income, that deficit can be brought forward and claimed as application in the current year. With effect from assessment year 21-22, the statute has been amended to prevent you from doing this, so there is no question of bringing forward a deficit. For what it is worth, my view is that the statute is correct, because if you look at the benefit of set-off and carry forward of losses under the section 70, 71, etc., all 72, all those provisions, all those benefits would not have existed but for the statutory mandate. The benefit of setting off a loss is not something which you see in computing income or commercial principles or in even for accounting purposes. It is an artificial benefit which the statute must confer. Therefore, in my view, the decisions in favor of the assessee before this amendment were incorrect. But anyway, now the law is clarified. So you are obliged to apply 85% of, consequent to sir's question, and just to make things simple, gross receipts to charitable purposes. What happens if you don't apply? Now we will see how the bureaucracy makes the law more complicated. You have two options. One is accumulation under section 11(2), for which you must file Form 10. Form 10, earlier, there was a time limit prescribed in the rules. The Supreme Court in Nagpur Hotel Owners Association, this is the Santosh Hede's judgment, said that there is no provision in the Act which empowers the rules to prescribe a time limit. Therefore, Form 10 can be filed until the completion of the assessment. Then the statute was amended to provide that Form 10 must be filed at or before the due date for filing the return of income. Now it has been amended to say that it must be filed 2 months before the due date for filing the return of income. If you file Form 10, you are permitted to accumulate for 5 years. That is only now. Earlier, so your accumulation is under section 11(2). If you accumulate and then you don't use it for the purpose for which it is accumulated, or there are certain other violations specified in subsection 3, then it will be brought to tax in the year in which such violation occurred. However, the subsection 3 used to say that if you have accumulated it and not spent it in 5 years or in the immediately succeeding previous year, it shall be brought to tax. Which means 5 years was effectively 6. It was not actually 5. Now that has also been amended to say that 5 years is only 5. I don't really have a complaint with any of these amendments. Why do I not have a complaint with an amendment that everybody is complaining about? Which is, why is Form 10 now required to be filed at least 2 months before the due date of filing the return? Because until now, 11(2) accumulation was used as a balancing figure. You will draw up your income and expenditure account just before filing the return, discover that this much has not been applied, and then say that no, I have accumulated that much for application in future years. I wonder if there was a single board resolution for accumulation under section 11(2) which was not antedated. The intention of the provision is that if you are accumulating, he will give you the benefit. It is not that I want the benefit, therefore I will accumulate. This is presumably the justification for advancing the due date to 2 months before filing the return of income. But I have a broader problem. See, I can deal with the statute all day, but for my own pleasure, you must permit me to express some opinions here and there. Not that I haven't been doing it this far without your permission. Now, I have a broader problem with the entire structure of things. I have to apply 85%. If I am not applying, I am entitled to accumulate. Why should you just not allow me to accumulate? You anyway have control over it, because in every year's return of income, the amount is shown for the past 5 years. I have to spend it and you bring it to tax later. All that is happening is that you are deferring the tax incidence by a few years. Why should I file a separate form? And why should there be a time limit for that form? And everything that is done to, most things which are done only increase complications. I don't know if you have read orders of the Supreme Court granting and declining to grant special leave to appeal under Article 136 of the Constitution. 8 out of 10 orders you will read will say delay condoned, leave granted. Only 2 out of 10 will not condone a delay, because in 8 out of 10 cases there will be a delay. So when this 2 months time period was stipulated, immediately all Form 10s were belated. Once it is belated, there is no specific dispensation for condonation. So everybody filed applications under section 119 to the board. Now the board is sitting at the top most level of the hierarchy, so they have to do the least work. So then immediately they discovered that there is too much piling up on their table. So they issued a slew of circulars. You could have issued one circular and said that condonation of delay in filing Form 10 shall be decided by the commissioner up to an amount of this much and chief commissioner up to an amount of this much. So they issued a circular after circular, one each for every form. I mean, there were multiple circulars for delay in filing audit report, multiple circulars for delay in filing Form 10. Each circular was for 1 assessment year, 2 assessment years, 3 assessment years. And I think I have a slide later on. In fact, the number of circulars did not fit on one slide. I had to put them on 2 slides. So finally now you have to see which circular applies and find out before whom you have to go to file the application for coordination of delay. There is a similar comedy of incompetence, not a comedy of errors. Similar comedy of incompetence with respect to the applications for a final registration or approval under 80G or 12AB, which also we will deal with later. Now, this is accumulation under section 11(2). There is also deemed application under clause 2 to explanation 1 to section 11(1), for which you have to file Form 9A. Why do 2 dispensations exist for this? Why would somebody choose Form 9A over Form 10 when Form 10 gives 5 years and Form 9A gives only 1 year? The answer actually is a answer with some historical perspective. When 11.2 originally came into the books, it granted accumulation for a period of 10 years. And clause 2 to the explanation, to explanation 1 to section 11.1 was only for 1 year. And if you look at it, there are 2 subclauses, and one of those subclauses is relevant. Where you have accrued income, but you have not received it, then you are permitted to postpone its application until the year of receipt. This was why there are 2 different systems. I think that necessity for 2 different systems is obviated. You can either restrict clause 2 to say only cases where there is accrual but not receipt, or you can altogether bring that 2 under 11.2 and deal with things. For many years there was a situation where 11.2 required filing of Form 10 and explanation 1 did not require filing any form, so some people would choose to go for that when they were confident that they would apply it in the next year. If you will notice, we have not yet reached the stage of application of income. This is the extent of the complexity in the law. And the joke is that true test for whether you are entitled to exemption is application. Hopefully, I don't remember how the slides go. Hopefully the next slide deals with application. Right. So this distinct gross receipts I have dealt with, distinction between expenditure and application consequent to his question I have dealt with, income we have dealt with. Oh, I understand. There is some problem with the resolution of the screen, so half of it. Anyway, so mode of computation where exemption is denied, section 13, subsection 10. I will come to that a little later. It is easier to understand this provision with the help of an example. Now, this example, first of all, as you must have already see, one of my objectives of speaking until this point was to convince you that the law is extremely complicated. Because if I make a mistake in this example, I can fall back on that complication in the law and say it is not my fault. But if there are mistakes, I would like to know. I also did not spend enough time on this example. I drew it up in the last moment. So the first column here deals with the first column here shows the figures as they would appear in the books of account. It has nothing to do with your computation for the purpose of income tax. Computed 1 and computed 2 are 2 columns where I am showing 2 alternative methods of arriving at the income. This corpus donation, as I have said earlier, you are not required to apply 85% of your corpus donation within the meaning of section 11(1)(d). Therefore, in computing your income, that will come under a completely separate category and it will not appear in this computation. Next, sale consideration for capital asset transfer. Subsection 1A of section 11 prescribes the method of granting exemption in the case of capital gains. The method prescribed deals with how much of the net consideration you invest. It is something similar to section 54F. But, they say brevity is the soul of good writing. Brevity is not the soul of the income tax law. The computation under subsection 1A is not the same as the computation under section 54F. 54F, it is a simple computation which is proportional. That proportion of the long-term capital gain, as is proportionate to the investment of the net consideration will be exempt under section 54F. That is not the formula here. There is no multiplication, division, there is only addition, subtraction. So much of the capital gain as exceeds the amount of the net consideration invested or something of that sort. I don't want to go into it in detail, but please be aware that this is the position. If you look at the 2 alternative modes of computation, in one I have considered the capital gains here, the sale consideration here, and in the other I have not. There are various decisions of the tribunal. I don't think of the High Court. The most recent one is a decision of the Bangalore Tribunal in Al-Amin Educational Society or Foundation or Trust or whatever. I think 2013 or 14 or 17 decision, where the tribunal held that you have an option either to treat sale consideration from capital gains under subsection 1 of section 11 or under subsection 1 and subjected to the same 85% application requirement, which sort of confirms the point that he made, which is that he dealt with capital expenditure, but capital receipts also come into this computation, which goes to the point I made right in the beginning, that this computation is somewhat agnostic to the distinction between capital and revenue. Anonymous donations under 115 BBC, this is subjected to a flat rate of tax of 30%. It is not, I think maximum marginal rate. It is not, you cannot claim application out of it and then claim exemption out of this. This will just be taxed automatically. So, I mean, at this level. So, I deduct expenditure and I derive at the income required to be applied. 85% of this would be the income I would have to apply. Now we come to application. So this is normal operating expenditure. Under any circumstances it will be treated as application, there is no doubt here. Now accrued expenditure. There has now recently been an amendment to the Act under which application can now be claimed only on cash basis and not on accrual basis. Our advice to charitable trusts has always been that do not follow accrual basis of accounting, because there could be a situation, let's assume you are the recipient of a CSR grant, under which in software service companies you have this concept of unbilled revenue, because the revenue has accrued but you are not allowed to raise an invoice, it has not fallen due, so you credit it to the profit and loss account and debit it to unbilled revenue. The same thing could arise in the context of a grant under an agreement, where some portion of the grant could have accrued but not been received by you. In that situation, you will not be able to accumulate or apply that amount. You can go under explanation clause 2 to explanation 1 to section 11(1)(a). But the best thing to do is to simply avoid all this chaos and follow the cash basis of accounting, except of course in the case of a section 8 company. Now, as I've said, even application has to be computed only on cash basis.
Excuse me, sir.
Yes, sir.
Since we are on the subject of application, we have a section 8 company, which is an NGO. It's in promotion of sports development.
Yes.
And they have undertaken various activities of taking deserving people from rural areas and taking their, making them to international sprinters.
Okay.
So there is a likelihood that they have participated in the Asian Games. Also they are targeting the Olympics. This foundation, because in the initial stages you mentioned, applied in India at the beginning when you discussed. That's the issue. What has happened, what will happen is that they have been incurring the expenses because they have to travel to various countries, send the competitors for foreign training, buying equipment from abroad, and all this is incurred in dollars, foreign exchange. Whether such expenditure will tantamount to application in India?
In fact, a similar question has come to us two or three times before. If your charitable purpose, say, so for the benefit of, if there is anybody on VC, the question posed is, in the case of a Section 8 company registered under 12 AB, which is engaged in the promotion of sport, which inter alia involves the coaching or training of the wards, where expenditure is incurred in that respect outside India in foreign currency, would it constitute application to charitable purposes within India? Sir, my answer is a qualified yes, because it is possible to take either view. Let us ignore this example for a moment. Let us say that I am engaged in relief of the poor. I am registered under the Foreign Contribution Regulation Act, and there are a lot of corporate CEOs these days who in their late 40s leave the corporate world and join or set up charitable non-profit entities. They are typically extremely skilled in securing large quantums of donations from corporate houses both in India and abroad. This this CEO of the charitable trust travels outside India, undertakes meetings with various donors, and secures donations of large quantums, which come to me in foreign exchange and which are duly compliant with the FCRA. His expenditure which I incur there on his travel, stay and other things, or such proportion of his remuneration as is attributable to this foreign trip, would you consider it application for charitable purposes outside India? My answer is no. Merely because some portion of the activities are rendered outside India, you cannot say that the purpose is being prosecuted outside India in its entirety. So my answer to your question is yes, that can be treated as application to charitable purposes in India, but this is subject to considerable dispute. If the AO picks up this issue in 1 year, there is no judicial precedent at this point, and arguments on either side are possible. But if the sports academy in your case is funded by CSR, you have a bigger problem, because if you note Schedule 7 to the Companies Act, promotion of sports there is only within India. Or Rule 4 of the CSR rules, there is a restriction under company law in the context of the CSR for the promotion of sport, where the activity must be in India. So,
the activity is in India. I mean, they have been trained, they have been promoted, but we are taking training from coaches from abroad. We are sending the incumbents for training. So their boarding, lodging expenses, they went to Korea, they came back, all that expenses will be incurred, plus capital expenditures of training equipments and all that. But everything is being conducted and done in India.
Yes, so the argument in your favor can be that expenditure is spent abroad to prosecute charitable purposes in India. The argument against you can be that so I'll tell you the reason the difficulty arises. If you read section 11.1, this is 11.1a. Income derived from property under trust, held under trust wholly for charitable or religious purposes, to the extent to which such income is applied to such purposes in India. The question is whether the words in India qualify applied or purposes. My prima facie view is that it will qualify applied. But to say then that every single rupee of expenditure incurred by a trust carrying on its activities entirely within India, outside India, would not be application in India is a hyper-technical view. So you will appreciate why I am unable to give you a clear cut.
So, thank you very much.
But it can be argued that expenditure is incurred to procure the
Yes.
or which is applied.
No, this is not, you have not, so you are arguing on the basis of the distinction that I drew between expenditure and application.
Because of that only he is going to get the donation.
No, that is not correct. This follows the donation. My purpose itself is to train students, and I am prosecuting that purpose. So it is application to charitable purposes. I don't think that argument can be made. There are very few things which I can answer with certainty. So when I receive a question for which there is a certain answer, I am very relieved.
Take it forward, sir.
Yes.
I mean, what could be the probable preventive steps to be taken when the return is filed in such a situation?
There is. So let me begin this answer with a qualification. There are two kinds of questions: questions of law and questions of strategy. Questions of law require knowledge of the law. Questions of strategy require experience, of which I am very deficient. So I am hesitant to give you an answer to that question, but if I won't be held to it. At the stage of filing the return of income, there is no risk. Even at the stage of the assessment proceeding, it is only the question of whether this issue is raised. Even if this issue is raised, it is a question of how the officer looks at it. It is not a clear-cut answer where the officer will take a view against you or will take a view in your favor. If this issue is actually litigated, it is even possible that a high court will take counter reviews. And so in situations like this, upon a thorough analysis of the facts of that particular case, you can formulate some view. And this question of risk, as a practicing advocate, I have been trained to never answer what had happened in the proceeding. If the question, one very senior lawyer, I don't want to take his name, he was asked, is this man a good lawyer? He said, he is a good man. I said, no, that's not my question. Is he a good lawyer? No, he is a good man. So when somebody asks me the question, will I win? I will say, no, you have a good case in law. If the judge has woken up on the wrong side of the bed that morning, nothing can save you.
Thank you.
Then capital expenditure. So the position now is that you cannot claim depreciation under section 11(6). You cannot claim depreciation on an asset in respect of which you have already claimed the capital expenditure as application. So you could do an asset-wise decision making, claim capital expenditure in respect of some assets and depreciation in respect of some assets. Theoretically that is possible, practically also it's possible. Do I recommend it? No. Because when you do anything out of the ordinary, it sort of comes to the attention of the department. Better to avoid this kind of offences. I will deal with this line item. I understand there is a break between 4 to 4:30. So I will deal with this line item and then pause. As I said, only 85% of donations to other trusts are treated as application to charitable purposes. So where I have donated 10,000 rupees only, 8,500 will be claimed as application. I will deal with a couple of more because at least on this computer I have 2 more minutes. I'll stick to it. Expenditure in favor of related persons under section 13 subsection 1 clause C. Section 13, as I said earlier, deals with cases situations in which you will lose exemption. Now 13(1)(c) states that where you have incurred unreasonable expenditure in favor of a related person, that expenditure cannot be treated as application. The tests for invoking, the procedure or the test for invoking section 13(1)(c) is identical to the procedure or test for invoking section 48(2)(b). And in my considerably limited experience, I have scarcely read an order of a tribunal or high court where a disallowances under 48(2)(b) has been upheld. Mainly because it requires a lot of effort on the part of the assessing officer. He must first identify, it is effectively a mini transfer pricing exercise. He must first identify other similar transactions to determine what is a reasonable amount and establish that this is unreasonable. We do have cases where 13(1)(c) additions have been made. We'll have to see how that turns out. But the point of law which is to be understood here is that if expenditure of say 120 rupees is incurred in favor of a CEO as his remuneration, if 100 is reasonable, only 20 will be disallowed. The whole sum will not be disallowed. Expenditure, now in earlier years you might have accumulated sums, accumulated your deficit of application or resorted to deemed application under clause 2 of explanation 1 section 11(1). Application out of these earlier accumulations, you obviously cannot claim as a deduction in the, I cannot claim as application out of current year's receipts. Brought forward deficits of earlier years, also you cannot claim. With that I'll pause. I suppose we'll reassemble at 4:30. 4:30 now, am I right? Yes. Thank you. I don't think I have a specific, I don't have a, this line. So, as we have seen, the computation of income, that is the quantification of exemption, in respect of which you compute the 85% requirement, accumulation under section 11(2), etc., is one computation. The other is in respect of corpus donations under section 11(1)(d), because they are not required to be applied to the extent of 85% at all. The question that had arisen before these amendments is whether where you had applied sums out of corpus donations, you could treat them as application to charitable purposes to satisfy this 85% requirement. There was, to my knowledge, there is no case law on this proposition, but the answer to my mind is obviously no. Because what section 11(1)(a) says is that it must be application of income to charitable purposes, and that income there refers to income under clause A and not income under clause D. In fact, clause D does not use the word income, it says voluntary contributions. However, some trusts were nevertheless making these claims and somehow it went unchecked. Therefore, the law has now been amended to say that where you have applied monies to charitable purposes out of corpus donations, you can treat them as application only in the year in which you replenish the corpus with other donations, provided that is within 5 years of such application. Sir, I promised to start at 4:30. I started a few minutes early. If you want me to repeat, I will. So, to repeat, in where amounts are applied out of corpus donations, they can be claimed as application only in the year in which that corpus is replenished, if such replenishment is within 5 years of the application of the income. This is alongside another amendment to section 11(1)(d) itself, which now says that all corpus donations must be held in the modes specified in 11(5) in investments held specifically for corpus donations. Therefore, if you have fixed deposits or mutual funds, you must hold, let's not deal with mutual funds, fixed deposits and savings bank accounts. You must hold fixed deposits separately for corpus and non-corpus, fixed deposit and savings bank accounts separately for corpus and non-corpus. And that should be replenished within 5 years, and you can claim it as application in the year of replenishment. Most people saw this amendment as an amendment against the interests of the SSE, because the contention, but my view is, since you are not allowed to claim sums expended out of corpus as application, and now you are allowed to do it, albeit with some restrictions, it is in fact an amendment that helps the SSE. A similar amendment, I came to this because I was dealing with expenditure out of borrowings. A similar amendment has been brought about to in respect of expenditure or application out of borrowings. The law now stipulates, so earlier, so as much as the department is often rather harsh or unjust against the assessee, the assessees also very often tend to play the fool with the law. One such example is the judgment of the Bombay High Court in GKR Charities, in which the question was whether where the assessee had acquired a capital asset out of a loan and claimed that capital asset as application at the time of its acquisition, he could once again claim the repayment of the loan as application. The Bombay High Court said yes. So effectively you are claiming application twice where application has taken place only once. I mean broadly, you could argue either way, but this is the broad consensus. In order to prevent this, now the law says that where you are making application out of borrowed funds, you can claim that application only in the year in which the borrowing is repaid, provided that the borrowing is repaid within 5 years of the application being made. Therefore, if the borrowing is disbursed to you or received by you in year 1, the application is in year 2. Within 5 years of year 2, if you repay the borrowing, in the year of such repayment, you can claim it as application. It is necessary to appreciate the conjoint effect of these two amendments together. Effectively, it appears to be the endeavor of the department now to attempt to identify a one-to-one correlation between receipts you earn and the application of those receipts or the application of income. Because for corpus now you need to have separate investments, and for borrowed funds too, in order to claim the application, you need to be able to prove that the application which you are claiming in the year of repayment was actually made out of borrowed funds. If I make application to charitable purposes in year 2, I repay the borrowing in year 4, I claim year 2's application in year 4, I must prove necessarily that the application in year 2 was made out of the borrowings. Otherwise the claim would not be sustainable. So there is a necessity now to establish one-to-one correlations broadly between receipts on the one hand and application on the other. Corpus donations to other registered trusts or institutions. There is a mischief that was practiced by various assessees. Let us say that I receive 100 rupees of income. See, again I keep hesitating between gross receipts and income. So let us just call it gross receipts. Let's say I receive 100 rupees of gross receipts. I take 85 rupees of this and transfer it to another trust as a donation which is registered under 1280. So I claim 85 rupees application. Here that other trust receives 85 rupees as gross receipts, transfers 68 rupees which is 85% of 85 and claims that as application. This process is repeated in a round tripping kind of fashion. So, I mean, it does not even have to be a round tripping because it can be a linear, so to speak. So, if this process is repeated, ultimately there is no actual application to charitable purposes, but the entire income is exempt in everybody's hands. There are various now anti-avoidance measures to combat this mischief. One of them is to say that you cannot make corpus donations to another trust. That is, you can make it, but you cannot claim it as application. This is for the reason that the other trust will claim the whole of that corpus donation as exempt without any obligation to apply it at all. So you cannot claim as application something which is a corpus donation in the hand of the recipient trust. There is an amendment made with effect from assessment year 2003-04 if I remember correctly. When I say I remember correctly, I mean I remember from reading. It's not as if I was around in 2003-04 in practice. So under that amendment, it provided that application in favor of another charitable trust registered under 12AB out of accumulated funds under section 11(2) would not be treated as application. So now these two bars exist. That is application of corpus donations, making of corpus donations to another trust and making of any donation to another trust out of either accumulation or later on deemed application also. In respect of all other applications for which you can actually claim credit when it is in favor of another trust, only 85% will be allowed as the application, subject to whatever your construction is of that circuit. As I have already mentioned earlier, expenditure out of corpus receipts cannot be claimed at all. This results in the amount which you have applied. Income, that is row number 10, minus application, that is row number 25, yields the income which will be brought to tax. The application is the income which will be exempt. Now, you will also have situations where you have either accumulated sums under section 11(2) in earlier years and failed to apply them or otherwise violated section 11(3). Those will be brought to tax in the current year. You may also have similar cases in respect of deemed application under clause 2 to explanation 1 section 11. All those amounts will also be brought to tax in this year. Therefore, the exemption will be quantified as the amount of the current year's application plus this 15%. That is the 15% plus the amount you have actually applied. This is the breakup of that sum. This is broadly the computation of income under sections 11 and 12. I have earlier, before the law was amended to this extent, in some other context, I have prepared a computation with 6 or 7 cases, because on this computation alone there can be 3 or 4 hours of a seminar. But this is a broad strokes, just in case you aren't particularly familiar with it. So all of this has been dealt with. Failure to apply, that is, if you are required to apply 85%, if you do not apply 85% to the extent of 15%, anyway to the extent of 15% you can accumulate without any conditions. Deemed application is form 9A for 1 year, accumulation is form 10 for 5 years. I've already dealt with 11.3, which is the circumstances in which accumulation under 11.2 will be brought to tax. There's one important provision here. Well, it's not so important, but it sort of hides in the shadows and sometimes you don't notice it. Subsection 3A of section 11 provides that where you have accumulated sums under section 11.2 and for a particular purpose, and for whatever reason you have not been able to, or you are not able to apply the sum for the purpose for which you had accumulated, you can file an application before the assessing officer seeking an order that the purpose be changed. In one case we have done it and we have got an order. It's of course subject to the officer, but it's not a particularly complex procedure. There is no particular form for the application either. It can just be in the form of a memorandum. And then they will pass an order and it will be deemed to have been accumulated for the purpose stated. It is also important that the law does not contemplate that you set out any specific purpose. Generality of purpose of accumulation is also permissible. You could also accumulate under section 11.2 for just for the purposes of the trust. Even that is permissible. There is nothing in the law, at least now, which says that the purpose must be specific. The reason the law does not say this is because, as I said, 11.2 is not meant to be a balancing figure. You are supposed to have a purpose in mind and you are supposed to have accumulated it for that purpose. Capital expenditure and depreciation, section 11.6 has been inserted. I believe it is with effect from assessment year 1920, although this is subject to correction. With effect from assessment year 1920, subject to correction, you can only claim depreciation in respect of assets of which you have not claimed the capital expenditure application. The Supreme Court in Rajasthan and Gujarati Charitable Foundation has held that this provision is prospective. Therefore, until that point, you could concurrent claims for capex and depreciation were permissible. I mentioned the decision of the Madras High Court in. I'm referring to all this case law in the confidence that Mr. Kota Srinivas is not here. I mentioned the decision of the Madras High Court in Rao Bahadur Kannan Chetty Charities case. This is another judgment where the Supreme Court has quite simply explained the computation of the income of a charitable trust. But again, this is before a few amendments took place. But this is another good source to learn about it. Inter-trust donations, 85% restriction, circular of the board, we have already seen. Illustration of computations is the Excel book that I have already showed you. Treatment of capital gains, again I have dealt with. There is an interesting order of a Chennai bench of the tribunal, in which I apologize, I don't remember the citation, in which it has been held that capital loss can be treated as application of income to charitable purposes. I am not entirely in agreement with due respect with this ruling, but it is there. So there are two classes of claims. The first is a class of claim where you can advise the assessee at the time of making the claim that you can go ahead. The second is post-mortem, where the assessee has already made a claim, you can defend it. So I think this falls in the latter category. A defense of a claim already made can be aggressive. But at the stage of making a claim, aggression is a bad idea. I am not here to increase my professional practice. If aggressive claims are made, my work increases. Exemption when lost. This is section 13. Subsection 1 of section 13 contains a list of circumstances in which you will lose exemption. Section 13(1)(a) deals with private religious purposes. If any portion of your income is applied for private religious purposes, you will not be entitled to exemption. What is a private religious trust versus a public religious trust? I don't want to go into it in depth, but broadly, who has access to the temple? Or who has access to the mosque? There are various family deities, for example, which are private religious trusts. So, recently the Supreme Court answered the question of whether the Padmanabha Swami temple in Thiruvananthapuram would be subjected to the charitable and religious endowments law in the state of Kerala, that question was answered in the negative, effectively restoring the control over that temple to the royal family of Travancore, who are the Dharmakartas of that temple. There are various observations there on the question of what is a private religious establishment and what is a public religious establishment. Might not be entirely relevant, but that is, it makes for good reading. Section 13(1)(b) deals with cases where a trust operates for the benefit of a particular religious community or caste. The Madras High Court has held that a linguistic community is not a community for the purposes of Section 13(1)(b), because the word used in 13(1)(b) is religious community. There is a very interesting decision of the Nagpur bench of the tribunal in Bharatiya Utkarsha Mandal, where the tribunal held that the Hindu community cannot be considered a religious community for various reasons. There are decisions in the Supreme Court which hold that Hinduism is not a religion, etc. This is mostly for recreational value. You cannot make such claims in the course of daily life. And in any case, if you are operating for the benefit of a religious community, you might as well constitute yourself as a religious trust and not a charitable trust, in which case these problems do not arise. The exception to this rule is that any income applied in favor of members of the scheduled caste, scheduled tribes and backward classes will not be subjected to this restriction. There is a decision of the Supreme Court in Palghat Shadi Mahal Trust, where it was operating a Kalyana Mandapam, and the question there was whether it is for the benefit of religious community. Again, that is recommended reading. 13(1)(c) is the most significant amongst these restrictions. It deals, as I said, it is in parimateria with the provisions of Section 40(a)(2)(b), except that the term related person is defined. I think it is called specified person. It is defined in Section 13(3). One of the two subsections, 2 or 3 of Section 13. It includes various persons, including the author of a trust, a trustee or manager of a trust, any person who contributes more than 50,000 rupees to the trust in a previous year, etc. And additionally, any relatives of such person and any concern in which such persons are substantially interested. The term substantial interest is defined here as it is defined for, I think, in 222(e) of the Act in the context of deemed dividend 2, it is defined. Substantial interest means you must hold, in the case of a company, shares equivalent to 20% of the voting power of the company, or in the case of other entities, 20% profit share. Now, there is one exception to this rule. Let us say that the author of a trust holds more than 20% of the equity share capital of a private company, and some portion of the trust's income is applied in procuring services rendered by that private limited company. This would be a violation of it's not a violation of 13(1)(c). You will have to see whether it's reasonable or not. If it is unreasonable, there is a violation. But where that holding of the author of the trust in that company does not exceed 5%, then the restriction does not apply. So these are the broad contours. There is much more to go into this in detail. Then clause D. Clause D deals with cases where the assets of a trust are not held in the mode specified in section 11 subsection 5. So now these are the 4 clauses of section 13(1). Some questions had arisen as to how much of the income would be exempt. If you look at clause A, 13(1)(a) says such part of the income as is applied to private religious purposes will not be exempt. 13(1)(b) said if you are carrying out activity for the benefit of a particular religious community, any income of the trust will be exempt. Therefore, 13(1)(a) applies only to the quantum of the violation. It deprives you of the exemption pro tanto, to the extent of the violation. 13(1)(b) will deprive you of exemption in toto, for the whole of your income. 13(1)(c) and D are also phrased, the plain words of the statute state that any income of the trust will lose exemption. Therefore, if there are various extremely large, professionally managed, corporatized non-profit organizations today, in which CEOs are often paid salaries to the tune of, say, a couple of crores a year. In these circumstances, if the total application of the trust is, say, 50 or 100 crores in a year, and the managerial remuneration to the CEO is treated to be unreasonable to the extent of 50 lakhs. For the violation of that 50 lakh, I will lose exemption for the whole of the income. These were the words of the statute earlier. But this was per se unreasonable, and therefore various high courts, despite these words, various high courts held that only that part of the income which is violated 13(1)(c) would lose exemption. The similar issue arose in the context of clause D2. In that context too, the High Court judgments are pretty much along the same lines. Rather, you can follow one for the other. Now the law has been amended. There was also the CBDT circular and all that. But anyway, now the law has been amended to say that only that part of the income will be exempt. So now there is no longer any controversy. For any of the clauses of subsection 1 or section 13, the exemption will be lost to the extent of the violation of that clause. This is so far as section 13(1) is concerned.
Sir?
Yes, sir.
Nowadays also you see a lot of trusts exclusively for particular religion and all, but the trusts, they are not having this body or what?
They might be religious.
They may register as religious.
Yes. So, that benefit to a particular religious community you are not allowed to do if you are a charitable trust. If you are registered as a religious trust, then you can do that, but you will not be entitled to ATG.
For like TTD, what do you mean?
I'm sorry?
For a exemption can be there.
Yes, yes. Yes, ma'am.
Elaborate on anonymous donations.
I'm coming. Yes, ma'am.
So, with regard to the previous slide where you were mentioning about the capital expenditures, so now is there any conditions to which what constitute your capital expenditure, as in if you buy a land or something like that, you have to directly, I mean, is there an onus of proving that it is towards your charitable activity?
You are asking in the context of whether it will be treated as capital expenditure or
Then
application.
you will get the benefit of application.
Accounting principles, ma'am. Whatever, there is no.
So if they buy a land as an investment, even that.
You can treat it as capital. You have to follow what. So all these questions on capital and revenue, whether in charitable trusts or in business income, are answered only on accounting principles.
Should that be asking whether the capital expenditure also should be for the objects of the trust?
Yeah.
That's what I think that's the question.
Yeah.
It is very hard. So it is very hard to say that. So remember that what is you are exempt because your object is charitable, not because your activity is charitable. It is very hard to say that you will ever buy an asset which is not for charitable purposes. If you do that, you will be in breach of trust because you are violating your trust deed. So, additionally, so I don't think that confusion needs to arise. Any asset you buy will be for charitable purposes. This is further sanctified by the position that subsection 5 of section 11 restricts what you can invest in anyway. So it's not as if you are going to do some innovative, for example, shares in a private limited company, you cannot hold. So I don't think a situation will arise where it is not for the purposes of the charitable trust. Nevertheless, I want to answer the question that you did not ask, which is how do you determine whether a particular item of application of income is attributable to capital or revenue? As I was just saying, the tests are tests of accounting principle. The tests are the same as they are under the head business or profession to determine whether it is 37(1) or 32. And for that, this is a judgment I recommend reading the most. Head Consultancy Services, which I referred to earlier, HEDE Consultancy Services, Panditji bench of the Bombay High Court, Justice V.C. Dara's judgment. Outstanding exposition of principles on how to determine what is capital or revenue. As it is a lesson in accounting, it is not a lesson in law, on the distinction between capital and revenue. I think it would not be inappropriate for me to point out that I was told that before Justice Davak started sitting in the bench which heard tax matters, he had never dealt with a single tax matter in his life. And somebody who appeared before him, he's long retired now, I think he retired in 2011 or 12. Somebody who appeared before him told me that it took him only 6 months to pick up the tax law and understand it fully. And then you see judgments like this, which are just very beautiful. I practice the law only for that beauty. Anonymous donations. So anonymous donations I would have dealt with later in the context of section 115 BBC, but it is dealt with also by section 13. The reason, so the law on anonymous donations is this: anonymous donations will be taxed at the rate of 30, at the maximum marginal rate, at the rate of 30% under section 115 BBC. You will not. And had that provision been there, and had the amendment to section 13 not taken place, then you could have said that I would have applied out of that anonymous donation and claimed application. But anonymous, that you cannot do. 115 BBC also says that no deduction or allowance can be claimed under any other provision of the Act. So you cannot even treat it as a receipt under section 56 and claim 57 deductions. Essentially, gross anonymous donations will be brought to tax. That is clear. Question is, what is an anonymous donation? Section 115 BBC says that a donation is anonymous if it does not, if the recipient organization does not maintain with it particulars of the name, address and such other particulars as may be prescribed in respect of the donor of that donation. To the best of my knowledge, there has been no prescription in the sense that name and address is there in the law, but there has been no rule framed or notification or anything promulgated so as to list any other particulars. And my suspicion is that there should not be any other particulars also, because you cannot insist on PAN, Aadhaar, etc. from smaller donors. So the law now is if you have name and address, it will not constitute an anonymous donation. The question then is, can I just put a name and address against every donation? You can't, because if you are granting the benefit of ATG, then there is a limit up to which you can accept donations in cash. And if you are accepting by bank transfer, the identity of the donor is fairly easily established. And secondly, this is why assessment proceedings exist. The Income Tax Department will send an inspector to the, what should he do? He should issue either notices under 133(6) or he should send an inspector to 5 of the addresses mentioned in the thing, and it is fairly easy to figure out. In fact, I suspect that he will do this, and even where they are genuine, he will say that I did not. What is happening in many cases in assessments these days? For example, since section 68 and 69 ABC are the favorite provisions of the department because of 115 BBE, in all cases where there is any money credited into your bank account, they will issue 133(6) notices. They will issue the notice only about 20 days before the period of limitation expires. There will be 5 days for that noticee to respond. The noticee will not even have realized that the notice has come, and he will not respond. The assessing officer will issue a show cause notice, and you can address arguments, he will not accept, and he will add it back. Then you will, in some cases, in large cases, you will go to the High Court and the order will get stayed. This process is, rinse and repeat. It has been happening in a number of cases. And similar thing can happen here too. Any other question on anonymous donation?
What happens in case of a religious trust?
Yeah, section 115 BBC doesn't apply to religious trusts.
Okay, so religious trust can have n number of anonymous donations.
Yes.
Alright.
Yes.
So all my temple trusts will get covered there.
Yes.
So it's okay even if they do not maintain any kind of register for any amount. Even if it's a bank transfer, I have skipped.
I knew you were asking this question when you began. So, since we are talking about charitable trust, the law has always been very charitable to religion and politics. Section 13A exists in a silo of its own for political parties. So the question being posed is, if religious trusts are not subject to anonymous donation, can the trust just not maintain records for any donors? The answer is yes and no. Theoretically you can. You will not be subject to tax under this. But you can never restrict the power of the assessing officer to conduct an inquiry. And so these kinds of questions often come from chartered accountants who have not studied the Code of Civil Procedure and the Indian Evidence Act. And I think that should be a part of the curriculum to some extent. Not that our curriculum is not big enough anyway. So in tax proceedings are civil proceedings. Although the tax law is not strictly either civil or criminal, tax proceedings are civil proceedings. In civil proceedings, the standard of proof is preponderance of probability. Therefore, what a judge or officer should do, he should take all the facts which suggest that a fact exists, all the evidence which suggests that a fact exists, all the evidence which suggests that the fact does not exist, and put them on a weighing scale. Whichever side the scale tilts, that is the conclusion. So, the Evidence Act, please read section 3 of the Evidence Act. It beautifully defines the terms proved, disproved and not proved. A fact is said to be proved. I am stating this from memory. I can assure you I am wrong, but you will condone my incorrect statement. A fact is said to be proved where any reasonable person will say that it is more likely, more probable that it occurred, that it exists than that it did not exist. This is the test of preponderance of probability, which we know in accounting standards reasonable certainty. Anything more than 50%, it is the same test. If I am today before an assessing officer as a religious trust, saying that I am not maintaining records of any donations, he will ask the question that he will first issue a 142.1, at least he ought to. He will first issue a 142.1 and say, what are these donations? You say, I don't have records. Then he will see, he knows that he cannot tax on 115 BBC. Why is it not an unexplained cash credit? Why is it not any of those other provisions under section 69? And let us assume that 68, 69, all those provisions did not exist. Let us say that you are a large religious trust which is closely associated with a politician. That politician has been found in the possession of assets disproportionate to the known sources of his income in cash. Is the question in this case whether the preponderance of probability is that these amounts which are discovered to be in your possession are in fact his. So then the probabilities will have to be weighed and the evidence will have to be weighed. So to suggest that the absence of a requirement in the law to do something frees me from the requirement to do that thing in general is a little rash. So that's why I said the answer is yes and no. And we must all remember this test of preponderance of probability. A lot of assessments go wrong because the submissions are not all right. Somebody asks, you have claimed, the assessing officer issues a notice under 142.1. Actually, this should be a separate seminar on assessment. Assessing officer issues a notice under section 142.1 saying that these amounts have been credited to your bank account. Please establish their genuineness. You will say the bank statement says that it is not cash deposit, it refers to a UTR number, therefore it is genuine. Has this passed a test of preponderance of probability? The answer is no. It only shows it has come from some other bank account. So who is the identity of that person? Why did you receive that amount? How did you treat it in the books of account? Is there any service rendered in that context? So the whole of the transaction has to be appreciated in its totality to establish that the evidence proves what you claim to be the fact. You must also, in dealing with assessments, appreciate the helplessness of the position of the assessing officer. He only has papers. He has no idea whether it's all a sham in its entirety. So you have to go the extra yard to ensure that he is satisfied. Okay, I will stop with that, otherwise that tangent is too long to go down. But all this has become significantly more relevant after the faceless proceedings have come into play. And faceless proceedings therefore are a significant opportunity for us because it is no longer a negotiation that I will tax this and I will not tax that. It is now an actual assessment. There will still be perverse orders, there will still be wrong orders, there will still be cases where the submissions are not good, but at least the rules of the game are a little narrower. And I can tell you that in our practice we have had cases where an addition of 100 crores has been proposed in the show cause notice under 144B and ultimately the addition was not made in the order because of submissions advance. Things happen, bad assessment orders are passed, good orders are passed. Anonymous donation, trade, commerce and business. Trade, commerce and business I have dealt with. Level 2 delays. Anyway, that also I have dealt with. Who are related persons I have dealt with, what is benefit I have dealt with. Subsection 3 of section 13 lists a series of transactions which will be deemed to be transactions within the meaning of section 13(1)(c). So please read subsection 3. Now taxation when exemption is lost, who is the assessee? This is a very interesting question. I will go only a little bit off topic, but I think it is relevant. There are broadly three kinds of entities which are registered as charitable trusts. The first is a Section 8 company. By virtue of the provisions of the Companies Act, a Section 8 company has corporate personality independent of its shareholders. Therefore, it is a person. The second is a society. Whether a society is a person would depend on the structure of the Societies Registration Act of the relevant state or the Indian Societies Registration Act where a state enactment does not exist. Broadly, let us just assume that societies are, more often than not, they are persons. What then is a trust? This is a concept that most practitioners unfortunately do not understand, and this is for various reasons. It is incorrect to presume that all law is statutory law. The law extends far beyond that which has been passed by Parliament or the state legislature into what is known as the common law and what is known as the English common law. The English common law continues to apply in India to the extent that it has not been modified by subsequent statutory law. To give you an example, let us say that tomorrow the Sale of Goods Act is repealed. Can you therefore say that no sales of goods can be made? Or another example, say the Indian Contract Act was never enacted. There was a long period of time in England where there was no statute on contracts. Is that to say therefore that contracts until the law came into force were not enforceable? The answer is no. The broad principle is a citizen or a person can do anything which the law does not prohibit, whereas the state can do only such things which the law permits. Therefore, if there is no law prohibiting the entry into a contract, you can certainly enter into a contract. Let me give you a curious case of this from Indian constitutional history. In Article 21 of the Constitution of India says that no person shall be deprived of his life or personal liberty except in accordance with procedure established by law. In the course of an emergency, as the Constitution stood when the emergency was declared, fundamental rights stand suspended. A Constitution bench of the Honorable Supreme Court in ADM Jabalpur vs Shivkant Shukla by a majority of 4-1 held that since in an emergency the fundamental rights stood suspended, Article 21 was the sole fount of the fundamental right to life and no person had a right to life in an emergency. This was the reasoning of the Supreme Court. Now, is this a reasonable construction? The answer is no. So to understand what a trust is, we can certainly read the Indian Trusts Act, but section 1 of the Indian Trusts Act states that it does not apply to public, charitable or religious endowments. At least 2 high courts have therefore held that the Indian Trusts Act does not apply to charitable trusts. There is a problem. So I made this point just yesterday at Chikmagalur for the Udupi branch, and somebody asked me in the return form, under which law am I registered? There is a question. And in that, if I am a charitable trust and the Trust Act doesn't apply to me, what do I put? I don't know the answer to that question because the form is a law unto itself. So please comply with that law for the satisfaction of the form, and the real law we will deal with here. So Indian Trust Act doesn't apply. What does the Indian Trust Act do? It codifies and modifies the common law relating to trusts. So what is the common law of trusts? Salmon on Jurisprudence is a book all of us should own. If you want to know, if you wake up one morning and have this question, something is wrong with you. But if you are working on something and you suddenly have a very fundamental question as whether this entity is a person or not, whether I in fact own this property or somebody else owns this property, what is the nature of my right? These kind of fundamental first principles of the law are addressed in Salmon jurisprudence. The subject of trusts is dealt with under the chapter ownership. A trust is a form of ownership. Let us assume that I am an individual. I don't think that requires assumption. I am an individual. I purchase immovable property. Somebody else unlawfully takes possession of that immovable property. So that person has to be sued so that I can secure possession. So I file a suit for possession. Who will file the suit? I will file the suit because I am the owner of the property. Why will I file the suit? Because I am the legal owner of the property. In law, you are either person or property. There is nothing else. If you are a person, you have the right of ownership. If you are a property, you are the subject matter of ownership. So everything else, rights, obligations, etc., relations between persons inter se or persons and property or property inter. Property inter se is no relationship. So I have to sue because I am the only person who is in charge of that property, therefore I am its legal owner. I succeed in the suit. I thereafter let out the property and earn rent. I am entitled to earn that rent. That is because I am entitled to the benefits of that property being its owner. So there are two kinds of ownership, legal ownership and beneficial ownership. Salmon says a trust is a curious kind of dual ownership where the legal ownership and the beneficial ownership vest in two different people. This is all a trust is. The trustee is the legal owner of the property, the beneficiary is the beneficial owner of the property. So now I am coming to who is the assessor. So if you look at all decisions of the Supreme Court and High Courts before the 70s or 80s when people forgot these principles, you will always say that the name of the decision is not locus sectional trust. It is sole trustee locus sectional trust. Because locus sectional trust does not exist as a person to present a petition before a court. Now the GST law gets over this difficulty by defining the term person in section 2 to include trust. But if you see section 231 of the Income Tax Act, it does not include trust. It only includes in the residual limb artificial or juridical person. There is nothing in the law to render a trust a juridical person. So who is the assessee when a trust loses an exemption? The trustee is the assessee. When a charitable trust loses the exemption. For this, we must go back to section 164, which deals with representative assessees. You might already be familiar that in the context of private trusts, there are two kinds of trusts. There are discretionary trusts and trusts which are non-discretionary trusts. I will call them specific trusts, so that nomenclature is not very accurate. A discretionary trust is a trust in which the shares of the beneficiaries are unknown. If there are 5 beneficiaries of the trust, there is one trustee who is a legal owner, and he has discretion, for example, to say that A will get this much, B will get this much, C will get this much. That is a discretionary trust. In the case of a discretionary trust, the Income Tax Act cannot assess the trustee, cannot assess the beneficiary, because if the income has not reached the beneficiary yet, and the income tax law does not know which beneficiary earns which income or how much income, because the shares are unknown. It cannot tax the beneficiary. So 164 says that in the case of a discretionary trust, the trustee will be taxed. But in the case of a trust which is not discretionary, the taxation can be either on the trustee or the beneficiary. In the case of a charitable trust, the beneficiary itself is unknown. It is an unknown body of people. Therefore, where exemption is lost, the trustee will be taxed. Now, what is this? Now, considering that a trust is not a person under section 231, what is the status of a trust? Will it be taxed as an individual, a company, an association of persons, a body of individuals, a firm, etc.? The status of a trust is defined by the status of the beneficiary. In the case of a public, charitable or religious trust, the beneficiaries are the public at large or some substantial portion of the public. This is considered to be an association of persons. It is for this reason that the rates applicable to AOPs will apply to a charitable trust in the event that you lose exemption. The trustees will be taxed in as representative assessees under section 154. You know how much we have forgotten this law? At this point, PAN is issued in whose name? Trustee's name or trust's name? Fundamentally, that is incorrect. Assessment in the name of Supreme Court judgments are there. Assessment in the name of a wrong person is fatal. So if I am assessed in the name of the trust, is that not automatically fatal? Theoretically, yes, but there is a principle called stare decisis. which says that even if the law has been misunderstood for long enough, that misunderstanding is the correct law. Otherwise there will be disorder, there will be chaos. Yeah. Now on the question of registration. Until the insertion of section 12AB, section 12AA applied, and until sometime in 1996, if I remember correctly, section 12AA did not apply, section 12A itself applied. Now, until 12AB came into force, registration was a one-time affair.
Sir,
Yes, sir.
which act applicable to public charitable trust? If it is not private,
No act. There is no law in government public. Common law. In certain states, there are some laws under which you are required to be registered. In the states of Maharashtra and Goa, there is a Bombay Public Charities Act under which you have to register. Similar law exists in Andhra Pradesh. But in Karnataka, Tamil Nadu, Kerala, there is no such law. This is the point I am trying to make. There need not be an act for everything. A trust simply exists because the English common laws existed, and we have inherited the English common law. There is a provision in the Constitution, Article 370 something, 372 or something, which says that unless, so all laws existing before the commencement of the Constitution will continue to exist unless they are contrary to the Constitution. This is how all the acts which were enacted pre-Constitution still apply today. Sale of Goods Act, Partnership Act, Contract Act, Transfer of Property Act, Trusts Act. So there is no law there is no enactment which governs charitable trusts. Let us understand why. Charitable trusts were trusts, not charitable trusts, trusts in general, were a concept which the British evolved much before the enactments came into force. Can you say the same thing about company? If there is no Companies Act and 7 of us get together, execute a memorandum of association, articles of association, there is no registrar to register it, but registration is a procedural requirement. Can you say that when we create that MOA and AOA, that automatically the group of us will attain separate legal personality? No. The law has to say that. Therefore, a company can only be under the Companies Act. And there can be no company without the Companies Act. But you cannot say the same thing of a contract or of a partnership or of a sale of goods or of a trust. Forget about this. I sell you immovable property under the registered sale. Under which act am I selling it to you? Transfer of Property Act. If the Transfer of Property Act, until the Transfer of Property Act was enacted, no sale is valid. So it's the same logic.
So the Indian trust type is charitable.
Private trusts. The Indian Trust Act applies to private trusts, where the beneficiaries are known and identified. It is not the charitable trusts. Section 1 says it. And in fact, if you read the Indian Trust Act now, the modes of investment specified in that act are much more restricted than Section 11(5). It is never the intention of that act. If that act applied, then you will have to comply with all those requirements, which is not possible. The act does not apply to charitable trusts. So when everybody puts up a board saying registered charitable trust, it means registered under 12A. There is no law under which you register it. What you register in the case of the trust is a trust deed. That is a registration of a document, not the registration of a trust. Because a trust is not a thing which can be registered. It is an event. It's not even an event. It is a phenomenon. You can, so that registration of the title deed, of the trust deed, is under the Indian Registration Act 1998. This, I can go on this tangent for a few hours, let us not, it is very interesting, but we have a syllabus. So, now registration under section 12AB. So, until the introduction of section 12AB, registration was a one-time affair. You were registered once and you would remain registered until registration was cancelled. There is an interesting order of the Mumbai bench of the tribunal in one of the Tata Trusts groups, where the harassment of the income tax authorities of charitable trusts is well known. Tata Sons Limited, which is the ultimate holding company of the Tata Group, most of the shares in the group are held by a charitable trust. Now, that trust was registered under 12AA and it was claiming exemption under sections 11 and 12. At one point, the assessments and appeals and all that became so many that the trust decided, listen, we don't want exemption, we will just pay tax. So they wrote a letter to the commissioner saying that please, we are surrendering our registration under section 12. What will the commissioner do? He will do nothing. Because if he rejects it, then the trust can challenge it. If he accepts it, then he loses some rights. So he did nothing. When 115 TDTF on accredited income were introduced, at that point he cancelled the registration. He said, in response to your application, I am cancelling the registration now. And then he levied a tax under section 115 TD. Obviously the tribunal said that this is complete nonsense. So registration was a one-time affair until cancelled. The reasoning in that order is significant, which is that no assessee can be forced to claim a benefit that they do not seek to claim. So even if there is no express statutory provision saying that you can surrender registration, if you have the benefit, you have a right to surrender it. But this rule is also not without exceptions. For example, section 32 on depreciation says that depreciation shall be claimed. So you don't have the option not to claim depreciation when you compute business income. With the insertion of section 12AB, registration is no longer a one-time affair. A new trust will be provisionally registered for a period of 3 years. Upon the completion of the 3-year period, you will get registration. And for the sake of simplicity, I will call it final registration, but there is no word final in the law. That final registration is for a period of 5 years. So a new trust will first have to get provisional registration for 3 years and then final registration every 5 years. The position is the same in respect of approval under section 80G. Existing trusts who were in existence before the commencement of section 12AB will get final registration of 5 years with effect from the date of commencement of section 12AB upon filing an application. Therefore there are various situations in which you may have to file an application. You could be an existing trust filing an application directly for final registration. You could be a new trust filing application for provisional registration for the first time. You could be a trust who has served the period of provisional registration and is seeking final registration, etc. All of these cases are dealt with in this table. The first case, the application is made under clause AC of subsection 1 of section 12A. Each of the subclauses deal with various cases. The first case is where a trust was registered earlier. You ought to have filed the application before the 1st of July 2021. This date, as usual, everybody filed belatedly. There were application for continuation. They issued multiple circulars extending notifications, extending the date to some extent. Now, I think circular number 7/2024 dated 25th of April 2024 extends this due date up to 30th June 2024. Now, let us say I am a trust registered earlier. I am a trust registered earlier, which means that when my registration was originally granted, the commissioner would have examined my trust deed and my other factors to determine whether I am entitled to registration. Therefore, at this stage, there is no need to once again examine all those factors. Therefore, where you are registered earlier and you file an application under subclause 1, the commissioner has no power to conduct inquiry or reject the application. He must grant the registration. This is what the law provides. He has to pass this order within 3 months from the month in which he received the application. The registration will be in continuous effect from when you originally obtained it. Next is where you are provisionally registered. That is, you have already filed an application for provisional registration. You have secured provisional registration. Now you want to secure final registration at the time of expiry of the provisional registration. You have to file this application at the earlier of 6 months before the expiry of the period of limitation, a period of the provisional registration, or 6 months after the activities commence, whichever is earlier. This is for one reason. Let us look at the last two line items in the table. There are two situations where you will seek provisional registration. This is, in both situations, you are a new trust seeking registration for the first time. You may have commenced activities and then you may be seeking registration,
or your activities may not have commenced at all. If your activities have not commenced, then you have to file the application 1 month before the previous year for which you seek registration. This is a bit of a problem because we are now in May 2024, and if I file an application now, I will get registration only with effect from previous year 25-26, assessment year 26-27. This is something you should be conscious of. So if you are a new case, you have to file 1 month before the previous year for which you seek registration. In this situation, since your activities have not commenced, the commissioner has no power to conduct any inquiry or reject, he simply has to accept. This I think is problematic. The commissioner has to have the power to examine the trustee to determine whether it is a charitable trust or not. The law doesn't really confer that power upon him, but if the matter gets challenged in court, they will say that he is permitted to do it. But please correct me if I am wrong, I understand that these applications are now processed electronically. So if you file the application for provisional registration, you attach the relevant documents, you just get the provisional registration. So for 3 years, you essentially get the benefit of exemption, even if you don't strictly comply with the various conditions which you are supposed to comply with. Then, if you are a new case but your activities have commenced, you can file an application any time after the commencement of your activities. This is for obvious reasons. Let us say I am a charitable trust in operation from 1980 and I have never chosen to claim exemption under section 1112. I can now file an application and seek registration to claim exemption. But in this case, since activities have already commenced, the commissioner has the power to inquire into the matter and determine whether to grant registration or not. This brings us back to the second line item where you are provisionally registered and seeking final registration. You have to file the application for final registration at the earlier of 6 months before the expiry of the provisional registration or 6 months after the activities commence, whichever is earlier. This is the relevance of the commencement of the activities we have now understood. Then the commissioner can inquire and choose whether to grant registration or not. The remaining cases are fairly easy. Where you are finally registered, you have to file the application 6 months before the expiry of your final registration. Where 11.7 is a case where you have to pick between approval under section 1023C or registration under section 1280. You can't do both. May not be relevant, I won't go into it. The next is a situation where you modify the objects. See, earlier under 12AA and under 12A, whenever the objects in the trust deed were modified, you would simply furnish a copy of the trust deed to the commissioner, essentially as a matter of courtesy because the law did not require it, but the commissioner was granted registration on the basis of some objects. So it would be his right to know whether you are still carrying on activities in that manner. In fact, we would do that in any situation where you amended the trust deed, whether that amendment was to the objects or otherwise. Now, the law itself requires that where you modify your objects, you have to file an application for registration once again. That is so far as registration, application for registration.
Sir,
yes, ma'am.
Is 07/2024 applicable for all first two cases or only for the first case circular? The
I'll show you, sir.
extended due date.
It is applicable for the first two cases, clause 1 and clause 3.
Yeah.
I'll just show you the circular, just to ensure that I'm remembering it correctly. In case of application under subclause 1 of clause AC of subsection 1 of 12A or subclause 3 of clause AC of subsection 1.
It applies to clause 3.
So provisional registration, when you want final registration after provisional registration, the circular extends. Or when you are an existing trust registered under the old regime, the circular extends the due date. Only for these two cases.
Only for these two cases.
Yeah.
Like I have missed applying for final registration.
When you have provisional registration.
Yeah. So that due date, extended due date applies to me.
Yes. If you think about it, there is no other case for which there could be a delay now, because 5 years have not elapsed since the commencement of this section. So your final registration, if any, could not have expired already for you to file an application. So at present, only two forms of application require this delay condition.
you already have a 3 years time, you can apply again, come with the last 6 months there.
Yeah, there is a problem there. Let us go to the section.
They are not, they are deeming this is as minimum registration.
They are deeming?
it, they are not getting provisional registration. They are treating same as final registration.
No. So there is a different issue here. For existing trusts who are registered under the old regime under 12AA or 12A, you are entitled to registration for a period of 5 years, not for a period of 3 years. All those registration orders which were passed when the applications were filed in 2021 wrongly stated that you are provisionally registered. CBDT then issued a circular saying that in all those cases wherever we said that it is provisional registration, it is not provisional registration, it is just final registration. So therefore registration is for a period of 5 years. In that situation, you don't have to go within 6 months before 3 years. That is the reason. But there is another problem there because where the trust or institution is registered under section 12AB, this is final registration, and the period of such registration is due to expire at least 6 months, prior to the expiry of the said period. That means there is nothing that prevents me from going on day 1 of my final registration, applying for the next final registration. I cannot come less than within 6 months of that date. So even that argument of theirs is wrong. But nobody thought about this when drafting the law.
There is no need to inform if management committee changes.
Only under FCRA, sir, not under income tax. More than under FCRA, I think if there is more than 50% of change in the managing committee, some form is to be filed. Unless, of course, the trust deed has to be amended for that purpose. If the trust deed says that trustees can be appointed by election, etc., then there is no problem. There are some trust deeds which say that this person shall be a trustee for life. If you are amending the trust deed, then you may have to inform the commissioner. There is another problem here. Earlier we used to intimate the commissioner for any amendment of the trust deed. Now it says, the section says that only when you modify the objects you have to file an application. But there is in the registration, so the question is, if I modify something in the trust deed other than the objects, do I have to file an application? Strictly speaking, no, because the section doesn't say it. But the registration certificate or order by which registration is granted, these days impose a list of conditions. And you have to see whether those conditions are complied. There is an order of the Bombay Tribunal saying that the commissioner does not have the power to impose conditions. But after that the law has been amended not for this purpose but for something else, and by mistake I think they conferred this power also, but there is some confusion there. So in all this confusion, the simple solution is where you undertake any amendment to your trust deed, please intimate the commissioner and please comply with the conditions stated in the order or certificate of registration. Where you change the managing committee and that is not occasioned by any amendment to the trust deed, there is no need. But that also please check if there is any condition mentioned in the certificate of registration. Then in that email you have to record that you were told by the commissioner's office that it would suffice for the purpose to inform you by email. You have to ensure that everything they say is put in writing. This is how assessment proceedings also have to be done. There should be a reference with every earlier response and notice, so that you cannot deny that you did not do something. Now, so we have dealt with all this. Now on the question of cancellation. I have about 20 more minutes. I will take those 20 minutes. Earlier, the number of grounds on which registration could be cancelled was very limited. If your activities were not in accordance with your objects, or if your activities were not genuine. This genuineness is a very subjective test. So now commissioners say everything which they don't like is not genuine. So somebody has to lay down the law on what genuineness constitutes. Now the entire dispensation is very different, because the basis on which you can cancel registration under section 12AB is not merely genuineness, it is a list of events which are all called as specified violations. Section 12AB contains an explanation in which the term specified violation is defined. Specified violation is therefore an essential ingredient for the cancellation of registration under section 12A. There are 8 specified violations. The first is where any part of the income of the trust is not applied for its objects. The second, this I think is unduly harsh. Anyway you are denying exemption, why would you also cancel registration? Second is, section 11(4) says that a trust may carry out a business, but it must maintain separate books of account and the business must be incidental to the objects. If you are carrying out a business and you are not meeting those 2 conditions, that is also a specified violation. Third, there is any private religious purpose, that is there is some religious purpose which is not inuring for the benefit of the public, that is also a specified violation. Fourth, you have applied any income for the benefit of a particular religious community or caste. So you will start seeing similarities between section 13(1) and specified violations in 12. Fourth is your activities are not genuine. Fifth, your activities are not carried out as per the conditions of registration. So there is no provision which empowers the commissioner to actually grant registration subject to conditions. So the question is whether the word conditions here refers to some statutory conditions, or whether this phrase must be construed as indirectly conferring upon the commissioner a power to impose conditions. That is subject to interpretation. The seventh is any other law which is relevant to the activities of the trust has been violated, that would also be a specified violation. To give you an example, if you are an educational institution and you violate the Capitation Fees Act, then that could result in the cancellation of your registration. Finally, if you file an application for registration under section 12A subsection 1 clause AC, and any particulars in that application are either false or incorrect or incomplete, I think this is very harsh. If there are false particulars, that is, if you are able to establish that the applicant was knowingly making false statement in the application, there is a justification in cancelling registration. But if it is merely incomplete or incorrect, I don't see the point in cancelling. But you will also note that if the application is incomplete, false or incorrect, and they want to cancel registration for that, it means they are admitting that they have been incompetent at the time of granting the registration. If the application was deficient, they ought not to have granted the registration in the first place. These are the specified violations. Now what happens if there is a specified violation? A specified violation from the list that we have just seen could occur in this year, or it could have occurred in an earlier year. What are the powers to cancel in this respect? There are 3 manners in which the specified violations may be invoked to cancel registration. The first is, the commissioner may notice the occurrence of a specified violation during any financial year. In that case, he may cancel registration from that previous year and for all subsequent previous years. My contention is that this word during means that the commissioner, the act of noticing a specified violation must be during a previous year. Therefore, he can only notice a violation in the year in which it occurred. My contention therefore is, where the commissioner has to notice the occurrence of a specified violation during a previous year, the word during qualifies the act of noticing and not the occurrence of the specified violation. So my contention is, if a specified violation has occurred in the financial year 21-22, the commissioner cannot notice its occurrence now and thereby cancel registration. He ought to have noticed it then. What then is the remedy for the department where a specified violation has occurred in an earlier previous year? In that case, in the course of assessment proceedings, the assessing officer can refer the matter to the commissioner saying that a specified violation appears to have occurred. You may choose to cancel the registration. Sir, ಒಂದು 5 ನಿಮಿಷ ಮುಗಿಸ್ಬಿಡ್ತೀನಿ. So you may, so where a specified violation has occurred in an earlier year, the AO may point it out in the course of scrutiny proceedings, and thereupon the matter will be referred to the commissioner will cancel registration. You will note that in both these provisions, the registration can be cancelled for that previous year in which the specified violation occurred and for all subsequent previous years. Therefore, conceivably, registration can now be cancelled retrospectively, because if hypothetically reassessment proceedings are initiated in 2029-30 for assessment year 2023-24, and in those reassessment proceedings the assessing officer notices specified violation, registration can be cancelled from assessment year 23-24. So retrospective cancellation is possible, but my contention, and this is subject to judicial consideration, is that when the commissioner initiates the proceeding, he can only be cancelled from the year in which he has noticed the specified violation. There is also a third scenario where the case may be selected for cancellation on the basis of the risk management strategy of the board. Practically, I have not seen that scenario occurring. Next, we come to application of income. Basics: no distinction between capital and revenue, repayment of loan, inter-trust donations, depreciation and capital expenditure, disallowances. All this we have already dealt with. ICDS applicability. ICDS has been prescribed under section 145 capital A, which applies to income under the head business and profession, and also income from other sources. If a trust loses its exemption, its income will be brought to tax under section 56. Therefore, if you follow the accrual system of accounting, ICDS could apply to you. This is another reason to follow cash basis and not to follow accrual basis. Next, we come to accreted income. This is a provision which has caused quite some controversy, as it is being interpreted as being extremely anti-assessing. I respectfully disagree with that view. The provision, the philosophy of the provision is this: if you are a charitable or religious trust, and at some point you cease to be so, that is, either you deprive yourself of the right to be registered under 12AB, or you convert into a non-charitable organization. Say you surrender your license under section 8 of the Companies Act. Then all the income for which you have enjoyed exemption in all these years, now we will bring to tax. This is the principle, this is the broad policy behind the provisions of section 115 TD, TE and TF. Now, how does the mechanism of this charge work? Effectively, what is being taxed is net assets which have enjoyed exemption. Therefore, you consider all the assets which have been acquired out of exempt income, reduce from there all the liabilities, and then the remaining, the net figure is treated as your accreted income, on which you have to pay tax at the rate of either 30% or whatever. Taxes payable at the maximum marginal rate. Now, how then do you, more precisely, how do you compute the accreted income? Each of the assets is to be computed at its fair market value, that is, and that is prescribed by Rule 17CB of the income tax rules. For most assets, the value of the asset is the fair market value. In the case of immovable property, it is the higher of the fair market value and the stamp duty value. So this is something you should be able to establish tomorrow. It is better to get a valuation report to ensure you are protected. Liabilities, of course, there is no question of valuation. Now, in what circumstances does the levy of accreted income tax arise? First, there are three circumstances. First is where you are converted into a form in which you are not eligible for registration under section 12A. This conversion could be either because your registration was cancelled, or because you modified your objects in a manner not in conformity with sections 12AB and 1023C, or because you did not file an application for registration within the period prescribed. The second ingredient is where you merge with an entity other than an entity registered under section 12AB or 1023C with similar objects. And the third is where you dissolve, but you do not transfer your assets to an entity with similar objects registered under 12AB or 1023C. The levy will arise as on the date of this event resulting in the taxation, and the tax is payable within 14 days of certain other dates which are set out in the section. Then after that 115TE deals with interest and 115TF deals with the declaration of an assessee in default for non-payment of tax. These provisions are somewhat in pari materia of subsections 1 and 1A of section 201 dealing with TDS. Broadly the same principles apply. The only other relevant point on accreted income tax is that the tax can be collected both from the trustee and from the trust. This in my view is extremely harsh, and in my view it merits amendment. Anonymous donations I have already dealt with. With that I come to the end of today's session. I thank you for your patient hearing. I don't have to, with judges also I expect patient hearings. With audience, they are more at my mercy. So it is not easy for me to say that a patient hearing means a good hearing. Therefore, I will courageously presume that this seminar has added value to you. I am open to taking any questions, and my thanks to the Bangalore branch once again. Yes.
Regarding cancellation.
Yes.
Cancellation, if auditor is not submitted some form 10B and 10BB, some relating to audit report.
No, that will not.
Yes, that same also they can cancel the registration.
No, sir. There is no provision for cancellation of registration. You will lose exemption. You will not lose registration. Yes, sir.
In case of cancellations, you can still reopen the assessments which are closed and the time limit has expired.
Yeah, so I am presently in the tribunal and in the High Court, because I am in the tribunal against the cancellation order under 12AB and in the High Court against all the reassessments for all the earlier years. The statute does not provide a mechanism to prevent the officer from reopening assessments for all the retrospective years for which the registration has been cancelled. There is no mechanism in the statute to prevent this. There is a problem. The question then is, let us say I pay accredited income tax, and then the tax is levied in the reassessment provisions on that, then you end up paying tax twice.
I would still pay it up to 2 times.
Yeah, because if in the reassessment, he will say that registration has been cancelled, deny exemption and levy tax. And then in the cancellation, you have to pay accredited income tax. Effectively, the same income is being taxed twice. So there is a problem here. There is actually a constitutional problem here. But we are examining. I am in the High Court. We have taken these grounds. But if we can win on some shorter point, we will not. Yes. A cooperative society is not subject to the provisions of Section 12. I am not answering questions on 83, sir. Yes, sir.
Sir, just the meaning of corpus. Does it come with specific direction of its how it should be used?
How it should be used? There is no need for a direction that a corpus should or should not be used in one way or another. It is that it should go to corpus. There is a need for a definition in the statute. I would not say that. But the thing is, in accounting parlance, we understand what a corpus is. That is all. There is nothing beyond.
No, if I have deficit.
Right. There is a decision of the tribunal in a 1985 order called Dharma Pratishtana, in which the question posed was whether you can utilize funds out of corpus or not. The tribunal said it very beautifully. They said that corpus is maintained for a dark day. When the dark day comes, you cannot be prevented from utilizing it. There is nothing in the law that says you cannot utilize corpus. There is one more complication. I have seen the books of a charitable trust audited by the Big Four, in which it was prepared on accrual basis. It's the first error. In this case, there was a deficit in the income expenditure account. For some reason, they did something called corpus drawdown, by which they reduced corpus to that extent and transferred to the income expenditure account. It baffles me why you would ever do this. What promptly happens, the assessing officer says that in your computation of income, corpus drawdown is shown to the credit side of your income expenditure account. You are not offered to tax, but you added that back to tax and added that back to the income and levy tax. So please don't do such foolish things. And also, I'll come to your question. The other funny thing is, after doing corpus drawdown, the income expenditure account still shows a deficit. So why did they do it? Yes, you have further questions?
No, relating to that only.
Yes.
My income and expenditure has a deficit. that will go to
Yes.
reserves and surplus,
Yes.
and it will reduce my corpus
Yes.
under reserves and surplus.
Yes.
That's it.
Yes,
That is the right treatment.
that is what we should do.
Yeah.
The corpus drawdown is complete. I mean, it is ridiculous.
How does a trust decide what is a corpus donation and what's my change? Unless the donor himself tells that it's a corpus, only then it becomes a corpus, or it is at the decision?
The trust does not get to decide, the donor gets to decide. Let me give you an example. There is a decision of the Kerala High Court in Mata Amritanandamani Trust, where a donation, a voluntary contribution was made, and there was a written instruction that it is towards corpus, and the donation further said that the interest or any income earned from investing this fund will also form a part of corpus. The Kerala High Court said that in view of such a direction, the interest received from the savings bank account to that extent would be corpus donation. With great respect, I disagree with this decision. The words are voluntary contribution with the direction that they shall form a part of the corpus. Is the interest a voluntary contribution? No, it is consideration paid by the bank. Secondly, there must be a direction. Who must give the direction? How can the donor of the sum say that the bank should pay that sum towards corpus? So, in my view, notwithstanding the Kerala High Court judgment, the only way to determine whether a donation is towards corpus or not is whether there is a direction to that effect given by the donor. It is a different matter that you can still choose to credit a sum to the corpus account in your books, but it will be treated as 11-money income and you have to apply 85%. Yes, somebody else said that.
Now the form also need to be filed for receipt of donations. 10B.
Right, yes.
Where we have to mention what is the purpose of the donation.
Corpus or general.
Purpose or
Right, okay. So there are two kinds of practitioners. One set know the law and do not know the forms, one set know the forms and do not know the law. I belong to the former. This is more true in GST actually. Any other questions? Thank you very much. I hope.
Thank you very much, sir. But I would like to ask one question, sir. How can you remember so many cases, sir? Wait. I remember in so many cases, sir.
The question posed is how I remember so much case law. The answer is actually that I have quite a poor memory, much poorer than you would suspect. There are two ways I do it. One is I have a cheat sheet with me, and the second is I am given lectures on. See, I'm a little frightened that I am being typecast. Whenever anybody calls me to lecture on something, it turns out to be on charitable terms. So effectively, I have given similar lectures at least 4 times, and at least 3 times in the last 3 months. So at this point, if I do not remember case law, it is quite embarrassing. But my memory is poor.
Thank you very much, sir. Sharing your valuable inputs on charitable trust, sir. You can get the very good knowledge in this area, sir. Thank you very much, sir. Please, present moment to make. I would like to invite the next to present moment.